Bye. Okay, okay, okay. Mm, mm, mm. Okay. അപ്പോൾ ക്ലാസ് സ്റ്റാർട്ട് ചെയ്യാം. ഓക്കെ ഓക്കെ ഫൈൻ ഫൈൻ. സോ ഇതിന് സ്റ്റാർട്ട് ചെയ്ത് സംസാരിച്ചാൽ പോരെ? ഇത് റെക്കോർഡിംഗ് ഓക്കെ ഓക്കെ ഫൈൻ ഫൈൻ. So good morning students. So now we are here to take a quick revision on our PM subject. So as you know that our exam will be in first week of June. So we will be looking at the important areas and also covering the major parts of the PM syllabus. So first let's start with the type of costing method. Okay, so this is just a basic of management accounting as you have studied in the knowledge level papers. So as we know that we have two types of costing methods. So the one is marginal costing and one is absorption costing. So the main difference between this marginal and absorption costing is the treatment of fixed overhead. Alright, in marginal costing the fixed overhead is considered as a period cost only. Okay, so in marginal costing cases we don't allocate our fixed cost to each unit. Okay, we will look at the fixed cost that we are incurring at the end of the year and we will just deduct it from the our revenue and we get the profit. Okay, so there is no allocation of fixed cost arising in the marginal costing method. But in case of absorption costing method, we will allocate our total fixed cost to each unit. All right, we will allocate our total fixed cost to each unit based on the budgeted overhead. All right, so we will be allocating that at the start of the year only. At the start of the year, we will allocate these overheads. Okay, so at the start of the year, like we will not be incurring any of the fixed cost. So we will just budget the overhead. All right, we will just budget our overhead and will also budget our units. We will also budget our units, and on that basis we will allocate each of the budget overhead to each of the unit. Okay, and at the end of the year, we will look at the actual unit sold. We will look at the actual unit sold. All right, we will be looking at the actual unit sold and the actual cost incurred. We will be looking at the actual unit sold and also the actual cost incurred. All right, by comparing that, we will be getting if we get more cost, like more revenue than we allocated or less revenue that allocated. All right, so that will be leading to under absorption and over absorption of overhead. All right, absorption means that how much fixed cost I get back by charging to the unit, all right, than the actual cost. So if my actual cost was $10,000, all right, and the amount I absorbed was $11,000, it means that it is a over absorption. My absorbed amount was 1,000 more, so the amount will be 1,000 over absorption. And in the same case, if the if the fixed cost I got back back was $9,000, then it will be considered as an under absorption only. All right, so this will be considered as an under absorption. So that's the basic thing that we need to know about this marginal costing and absorption costing method. All right, so next we will be moving to activity based costing method. All right, so basically we are allocating overhead. So basically we are allocating the overhead on the basis of budgeted overhead. All right, budgeted overhead and comparing the actual overhead. So basically in absorption costing, we will be allocating the total overhead only. We will be allocating our total overhead to each of the units. All right, but in activity based costing, we will be allocating this on the basis of the activity only. All right, as you know that there are different types of fixed costs that we have. Okay, so the different types of fixed costs that we that a company would incur is, let's say, rent, electricity, supervisor cost. All right, so these three type of costs are incurred due to three different reasons. So it will be more accurate if we allocate those costs on the basis of the reason for incurring. All right, that reason for incurring is known as the cost driver. All right, so in activity based costing, we will be allocating cost on the basis of the cost driver only, not not blindly based on the unit or some other methods such as machine hours or labor hours basis. So that's what activity based costing means. So now we'll be looking at the steps to allocate overhead using ABC costing. What are the steps that we should do in order to allocate those overheads using ABC costing? So the first step would be identify major activities within each department which create cost. So what are the reason that is creating cost? That is the first thing that we should be noted. And the next thing is that create a cost center or cost pool for activity, the activity cost pool. It means that the cost which are incurring due to similar reasons. Let's say we have three production department and these three production department will have a rent. Okay, so we will allocate those rent as a single one. So that is a cost pool. So like that, the similar cost driving activities are pooled into a single thing. And so that what means activity cost pool. And after that, we will determine what is the reason for the cost. All right. So what make this cost to be incurred, that is known as cost driver. The reason for the cost, the reason for this cost is the cost driver. All right. And the next we will do is that calculate an absorption rate for each cost driver. It means that on the basis of the cost driver, let's say if the cost driver is the labor hours, so we will be allocating those labor hours allocated overhead on the basis of labor hours. All right, so that what we will do. And after that we will calculate the overhead cost for manufacturing each product. Okay, after that we will be allocating the allocated overhead to the each unit so that we can make a margin and sell it after that. All right, so and finally we will get the overhead cost per unit, right? So that's how we allocate overheads to each unit on the basis of activity based costing. All right, and the next is what are the advantages of activity based costing? So the obvious advantages is that it helps in better decision making, because we will be allocating cost on the basis of the reason for the cost to be incurred, not on a blind basis. So it will be help in better decision making, so that company will be All right. Does it make an intro? So the advantages of ABC costing is that, so the first advantage is that like it will helps in better decision making, so that the company will have more and accurate knowledge of cost and profit per unit. We will get a clear cut idea on what are the what are the cost incurring for each product and the profit like that we are getting per unit. And the next advantage is that when cost plus pricing is used, the applying ABC means that the price will be more likely to achieve the desired margin. It means that based on ABC costing principle, if we are allocating a cost, that cost is considered as accurate. So if we put a profit on it and sell, the customers will be more reluctant to buy that. All right. So that's the second advantage. And the third advantage is that there is a better understanding of what cost resulting in identifying the cost driver. And next is that control of overhead is more straightforward. By using ABC costing, we know that like which thing have more cost. All right, so which area like is incurring more cost, so we can better control the cost, as responsibility for incurring cost must be established before ABC can be implemented. All right, so before implementing ABC, we didn't know that like which what are the reason for like what are the reason for increasing fixed cost and all. But using ABC, we can like we would get a clear cut idea on what is the reason for cost to be incurred, and we will be like we can make better steps to improve the cost. I mean, like we can reduce the cost by like that. All right, and next is that more accurate performance measurement leads to better performance management. It means that using ABC, we'll be using a better performance measurement, like getting the cost, like getting the reason for the cost and managing it. So it will result in a better performance management. All right. And the next is, obviously there would be disadvantage for everything. So the first disadvantage is that ABC is still based on budget overhead only. We will be budgeting overhead at the start of the year and allocating it to each unit. So there is a chance of under absorption or over absorption of overhead, which may be unsuitable for future strategic decision. Okay, still the future is uncertain, so we cannot completely rely on ABC costing also. So that's the main disadvantage. The second one is that it is more complex to calculate, as you know that we would need to get the cost driver for each cost pool. So it is not an easy task for a company to get what are the reason for the cost to be incurred. All right, so it may be challenging, or there may be multiple cost drivers for a single activity. So that's a difficult task. And the next is that additional time and cost will be incurred, obviously. So using absorption costing, we will be getting a total cost and we will be allocating on the basis of labor hours or units. But in ABC costing, the administration need to sit and think about the cost that we are incurring and the reason for the cost, and we would be required to allocate that. So it will take additional time and cost. So here we would be required to make a cost benefit analysis. All right, here we would be required to make what? Cost benefit analysis. Cost benefit analysis. All right. All right, so these are the disadvantages of an ABC costing method. And next we are discussing about the service industries. All right, so what are the characteristics of service industries? All right, so like as we know that the service industries are obviously different from the production industries. So the examples of service industries may be hotels or hospitals and all. Okay, so the service industries can be distinguished from manufacturing by the following characteristics. So these are the characteristics that make service industries different from our production industries. So the first will be simultaneity, also known as inseparability. This means that the service is consumed simultaneously as it is performed. All right, when treating a patient, if a doctor is treating a patient, it is like as soon as it is converted to service only. So that's the first thing. It is simultaneity, like it is happening after finishing only, right? And the next is heterogeneity, also known as verifiability. Like it means that different people will be getting different services based on the requirement. Okay, if a patient goes to hospitals on fever, the doctor will be giving a medicine. If the same patient go for a cough or other health condition, he will be getting another medical treatment. So it is heterogeneity. It means that no service is same for everyone. And the next is intangibility. It cannot be seen. The service cannot be seen. It is just provided. And the next is perishability. Okay, the services cannot be stored. It can only be provided and it will be used as soon as they are provided. That's it. And transferability of ownership. It means that often there is no transfer of ownership when a service is provided. All right. So when a service is provided, if I am providing the service, the person will be getting the service. There is no transfer of my service to one another to provide. So that's what. So these are the main characteristics of service industries that make them different from the production industries. All right. That's it. So the next we will be looking at the specialist cost method. All right. The like ABC costing is also considered as a specialist costing method. And the next specialist costing method we will be looking at is the throughput accounting. All right. So this specialist costing is something that we use based on certain situation. Okay. So we will be using ABC costing like at the time when we have certain like doubt or something. I mean, like if we have more overheads. All right. If the like marginal cost is less and overhead cost is more, then the company will be having more fixed cost. In that case, ABC costing is advisable because that so that we can allocate the like more fixed cost on a more accurate basis. All right. And the throughput accounting also there is a reason, so we will discuss that later. So there is a through two aspect in modern manufacturing include the total quality management and just in time. It means that like these are the assumptions or method used while calculating throughput accounting. So the first is that total quality management. All right. So the total quality management means that recognition of the need for continuous improvement. It means that the production department should continuously improve their production by quality, by service, by the time taken. It should be continuously improved. And the next is that recognition of the vital role of customers and suppliers. All right. So the customers and suppliers plays an important role in getting the total quality management. And the next is that commitment of senior management to the cause. All right. So the senior management should all be reluctant to like involve in these things and to improve the total quality of a like production we are providing or the service we are providing. And the next is that prevention of error before they occur. So the company should foresee the future issues that may have arise while production and they should solve it immediately. So that's what total quality management means. It's not after getting into the error. It's before getting into the error we should foresee and solve it immediately. And the next is that importance of total quality in the design of systems and product. All right. It means that the total quality should be provided on the design. Okay, on the design of the like system can be considered as machines and all. Okay, so the total quality should be maintained in both systems and the product. So the machine should have the quality and also the product that are manufacturing in that machine should also have that quality. So that's what the like the characteristics of total quality management. And next is that real participation of all employees. It means that the whole like all of the employees should be participating in this total quality management and should provide to push to like reach the maximum quality that they can attain. Okay, so the next is that just in time. So just in time means that so like previously the company so basically the company will be like buying inventory on a like frequent basis and they will be using that when the demand comes. But in just in time method the company will only order the product when order comes. All right, when order receives. Okay, so only when the order is received the company will be like ordering the inventory also. So the first is low cost through all of the above. Like it means that we will be having high quality. Okay, by using just in time we will be buying the goods are produced only when required. All right, like our goods are like purchased only when required. Okay, so when an order comes then they will like purchase the like inventory and after that only they will be start the production. Okay, like the products are not produced before getting the order. So the first like characteristics that we will be getting high quality product possibly through deploying total quality management system. Okay, and the next is speed, rapid throughout to meet customer demand. All right, so when order is received then the like workers will be working to like complete that order as soon as possible. All right, and the next is that reliability. All right, computer aided manufacturing technology will assist. So these are the characteristics of a just-in-time inventory. So by using this will result in a low cost, and the low cost will be like mainly like achieved due to the reduction in holding cost. We will be getting less holding cost if we are using just-in-time inventory management system. And the next is that flexibility. All right, so like we can use small batch sizes and automated techniques. Okay, so that we can meet our customer demand more fastly. All right, so these are just like theory but only just to know about these things. All right, so we have discussed total quality management and just-in-time system. All right, and the next is the equation for throughput accounting. Okay, so the equation for throughput accounting is sales revenue less direct material cost. Okay, so now like let me say the reason for using throughput accounting. So throughput accounting is mainly used for short-term distance only. All right, so I will say an example. Okay, so currently we are producing at like with 10 labors or something and we are meeting the demand as we receive. Okay, but suddenly a labor strike had occurred. Okay, so currently we have only 5 labors instead of 10 labors. So the labor hours are reduced. So the company would need to prioritize which product need to be produced first. All right. So on that scenario, we will use throughput accounting, because throughput accounting is used for a short-term decisions. All right. So we will be using certain assumptions for this throughput accounting. And the first assumption is that the only total variable cost in the short term will be the purchase cost of raw material. So like in basic case, we will be considering like the direct labor cost also as a variable cost. But the reason is that not all labors are paid based on the unit they produce. Some labors are paid based on the salary basis. So in short term, like the salary is a fixed cost. All right. Like let's say the pay for the 1 week, like 1 week may be fixed. Like they would be required to pay like even if they produce or not produce. But the material cost will only be incurred if we produce the product. So that's the like difference of. So that's the reason for using like raw material cost as only variable cost in throughput accounting. So that's the first assumption. And the next is that direct labor costs are not variable in the short term. Many employees are salaried, and even if paid at a rate per unit, obvious reason, are usually guaranteed a minimum weekly wage. So that minimum weekly wage will be fixed. So that's the reason why we are considering labor cost as fixed cost in the short term. And by applying this assumption, throughput is effectively same as contribution. So what's the equation for contribution? The equation for contribution is sales minus what? Variable cost. But the only variable cost here is material cost. So the equation will be sales revenue minus material cost. So by that we will be getting the throughput contribution. So that's the equation for throughput contribution. And next we are looking at the theory of constraint. Constraint means the like limiting factors. Okay, so like in my example, the constraint was labor hours. We are not getting sufficient labor hours required to meet the demand. So in that case, we will be using the theory of constraint in order to make the best decision upon our situation. So the first is that identify the system bottleneck. All right. So bottleneck means that which resource is limited. So like bottleneck means the resource which is limited. So first we will be identifying the system's bottleneck first, and the next is decide how to exploit this bottleneck. Okay, it means that how can I use this bottleneck at the most effective way or the efficient way. So that's the next thing. I'm going to think about. And the next is that subordinate everything else to the decision in step 2. All right. So I had made it. I made a decision on how to exploit this bottleneck, and the all other steps will be, or all other process will be aligned with the idea that I made on how to exploit the bottleneck. And the step 4 is that elevate the system bottleneck. It means that if I have any possibility to increase the labor hours, I should take that. And so that I can increase the current bottleneck. Okay, so if I increase the labor hours, then my next limitation will be the availability of material. Okay, so if in the previous steps a bottleneck has been broken, go to step 1. It means that after elevating the system bottleneck, I got sufficient labor hours. Okay, but my current situation is that my material is less. Okay, my supplier has changed, and I am getting only less material. Okay, I'm getting only less material. In that case, my new bottleneck will be the material, not the labor hours. So I'll be going back to step 1 and doing all these steps in order to increase the availability of material. So that's how the theory of constraint works. Okay, so here are some equations that we use to make decisions using throughput accounting method. All right, so the first is that throughput per factory hour. All right, throughput per factory hour, or throughput per which is the bottleneck. So the equation is that throughput per unit divided by product time on bottleneck resource. So which is the bottleneck resource and how much time is required for a product to make in bottleneck resource. That's the equation for throughput per factory hour or throughput per bottleneck hour. And the next is cost per factory hour. All right, so if a factory is working for 1 hour, how much is the fixed cost that I am incurring? So the equation is that total factory cost divided by total bottleneck resource time available. So these are just the equation and the throughput accounting ratio. Okay, so mainly we will be making decision based on the throughput accounting ratio. So the equation for throughput accounting is that return per factory hour or throughput per factory hour divided by cost per factory hour. All right. So it's basically by dividing this throughput per factory hour. So it will be basically by dividing this throughput per factory hour divided by cost per factory hour, we'll be getting the throughput accounting ratio. All right. It means that by using this two equation, we'll be getting what? Throughput accounting ratio. All right. We'll be getting throughput accounting ratio. That's it. And we also have to make a decision. like, or we will be getting an information based on this throughput accounting. So if the throughput accounting is greater than 1, if the throughput accounting is greater than 1, okay, so the equation for throughput accounting is return divided by cost. All right, so if the throughput accounting is greater than 1, it means that my profit is more than the cost. All right, so I can produce that product, like, and still I will be getting a profit. But if it is less than 1, it means that cost is more than the profit. It means my cost is more than the profit. So that's the reason. So that's the like lead we are getting by using this throughput accounting ratios. All right, and the next is the the next is the limitation of throughput accounting ratio. The limitations of throughput accounting ratio is that it only concentrates for the short term. Okay, so when a business has a fixed supply of resources or a bottleneck and operating expenses are largely fixed. All right, however, most business can produce product based on their short term only. Okay, so the throughput accounting is only based on making the short term decision. Okay, it is not based on the long term. So that's the like main limitation. So we cannot use throughput accounting for a long term decision. Okay, and there may be like other limitation or like other issues that may arise by using it as a short term. All right, like it means that like we are making decision only based on the variable cost and the sales value. And the next limitation is that it is more difficult to apply throughput accounting concept to the long term when all costs are variable. Okay, so we cannot use throughput accounting for a long term. Okay, so in short term, like only the material cost is considered as variable cost, but like in the long term, like the labor cost can be also considered as a variable. So the throughput accounting cannot be used for decision making in the long term decision. All right, and the next is in the longer term, an ABC approach might be more appropriate for measuring and controlling performance. It means that for the long term, we will be getting the better insights on fixed cost also. So we can control cost more accurately for long term by using ABC than the throughput accounting, because throughput accounting is mainly concentrated on short term decisions only. Okay, so like those are the limitations of throughput accounting. All right, and how we can improve the throughput accounting ratio. So as we know that the equation for throughput accounting is what? Equation of throughput accounting is return. So the equation for throughput accounting is return per bottleneck hour or return per factory hour, right? Return per factory hour divided by cost per factory hour. Cost per factory hour. Okay, cost per factory hour. So in order to improve the throughput accounting ratio, the first thing I can do is increase the selling price. So if I increase the selling price, the return will be improved. Okay, so by that I can improve this throughput accounting ratio. And the next is reducing material cost per unit. Okay, we get the return by reducing material from the sales. So by that also we can improve our throughput accounting ratio. And the next is reduce operating expenses. So if the denominator is reduced, that the factory cost is reduced, like then also I can improve my throughput accounting ratio. And the next is improve bottleneck activity. Okay, so if I get more hours or like less time is required in bottleneck activity, then also my throughput accounting will be improved. So these are the steps or the like things that we can do to improve our throughput accounting ratio. All right, so next is how to make decisions on multi-product. All right, it means that if a company is producing 3 type of product, let's say it's A, B and C. So in that case, so like a labor strike had occurred. So here I want to make a decision whether I should produce A first or B first or C first. Okay, so which should be produced first? Okay, so like here I have 3 product and my question is which to produce. Okay. And here my question is which one to produce. Which one to produce? Which one to produce first? So this is my question. So by using these steps, I can answer this question of which one to produce first. So the first thing is that identify the bottleneck constraint. Okay, so first I will be identifying which is my bottleneck, and the next is calculate the throughput per unit for each product. Okay, so we will be getting the throughput per unit. It's selling price per unit minus material cost per unit, and after that we will be calculating the throughput per unit of bottleneck resource. It will be throughput per unit divided by the time taken for each item to produce in the bottleneck resource. Okay, all right, and the next, rank the product in order of the throughput per unit of the bottleneck resource. All right, so based on the TPAR, okay, if the item is produced in like different factories, then we'll be using TPIR. Okay, so like otherwise the total cost will be same. So like if it is produced in the same factory, the total cost will be same. So we'll be using like using just throughput per bottleneck resource, throughput per bottleneck resource. And based on this throughput per bottleneck resource, we will be ranking the product as 1, 2, and 3. If all products are made in the same factory, then the ranking can be like done on return per hour, as cost per hour will be same. Okay, so as I said, however, if not, the ranking is done on TPIR. Okay, so in that case, like we will not be using TPIR. Okay, we can use just throughput per bottleneck resource and allocate resources using this ranking and answer the question. All right, so we will be looking at which is our bottleneck, and by ranking this, so like if my rank comes as like if A get the rank 1, B get the rank 2, and 3 get the rank 3, the first thing I'll be producing will be product A. Okay, and after meeting the demand of product A, I'll be going to produce product B. All right, because product A will be giving me like more returns than the other two products. Okay, so that's how we rank the product and finalize which item to produce first. All right, so that's how we make decision based on the limitations or bottleneck that we have. And the next is target costing. Okay, so these are different costing method. All right, so throughput accounting used for short term, and the target costing is used if my product is not unique. If my product is not unique, or if my product is already in the market, I'll be using target costing method. Let's say I'll be selling a pen. All right, my product is a pen, just a normal pen. So as you know that the price of normal pen like in market is like let's say between 10 rupees to let's say 15 rupees. All right, so for pinpoint or something, I will be the cost is okay. So let's consider the cost as 10 rupees. Okay, so the price for a normal pen in market is only 10 rupees. So is it possible for me to sell a normal pen for 30 rupees? For 30 rupees? No, because the customers will not buy. So in that case, I'll be using target costing method. So in target costing method, the first thing to do is identify the target price. So here my target price is how much? 10 rupees. I need to sell the pen at 10 rupees. Okay, so after that, I'll be looking the profit margin required for the product. So in order to sell a product for rupees 10, how much profit should I require? Okay, so if I determined that I need a profit of 2 rupees. Okay, so for each pen I am selling, I need a profit of 2 rupees. So deduct the profit margin from target price to get the target cost. It means that if I want to sell a pen for 10 rupees and to get a profit of 2 rupees from that, the maximum cost that should be incurred for the pen is how much? It's 10 minus 2, 8 rupees. It means that the pen should be produced at a cost of 8 rupees in order to get my profit and in order to sell it in the market. Okay, so next I'll be calculating the cost gap. So here 8 rupees is my what? 8 rupees is my target cost. Target cost is my target cost means the cost within which I was supposed to produce, but by producing I got a cost of 10 rupees. Okay, this is in dollars, I guess. Okay, so in 10 rupees, so my target cost was 8 rupees and the cost I calculated was, or the cost incurred was 10 rupees. So the cost gap here is 2 rupees. 10 minus 8, 2 rupees is the cost gap. So here I want to reduce the cost gap. So the cost gap can be eliminated by making steps to eliminate cost gap by methods such as value engineering. It means that which is the like value or so what is the main purpose of the pen here? The main purpose of the pen is obviously to write. Okay, so the main purpose of pen is to write only. All right, so the main value associated with the pen is how smoothly the pen can be used to write something. All right, so like if I made a like design or some like metal like thing on the pen. All right, so like this like design or something, like it's an additional value. Okay, so the customers don't want this steel. Okay, and the steel is incurring extra cost. So if I reduce the if I eliminate the steel on the pen, then I can reduce the cost and I can achieve my target cost of 8 rupees. So that's what value engineering means. So the value engineering means that we'll be looking at the value which the customer wants, and we'll be only providing the service what the customer wants and not the extra thing. Okay, so the features on the pen will be more associated with the purpose of writing only. All right, so that's the step that we are going like that we'll be using by using target costing method. That's it. And the next is types of value. Okay, so like there are different value that we can be determined for a product. So on the first value is the cost value. Okay, so the cost value is the cost incurred for the production. And the next is exchange value. The exchange value is then, if I am willing to sell this item on market, how much amount I will be getting. So it is the consumers, the amount of money consumers are willing to exchange. It means that at what price I can sell the product. That's the exchange value. And the use value is that the benefit I'll be getting by using it myself. Okay, this is related entirely to function. Okay, so what's the product, what's its function? So the value I'll be getting by using that will be the use value of the product. And the next is the esteem value. So like esteem value is associated with some like status or something. Like if I'm using a Rolex watch, like I'll be having a more status, obviously, right? So this relates to the status or regard associated with the ownership. And the product with the high esteem value will often be associated with the premier or even price skimming price. So it means that like if a product is having a more value or something, all right, so like it will have an esteem value. Like esteem value is the value associated with the legacy that the product have. All right, so that's what esteem value means. And the next costing method, so that's what with target costing. Okay, so now we had covered activity ABC costing, throughput accounting, and target costing. So the next we'll be looking at the life cycle costing. Okay, so in life cycle costing we will be considering the cost from born to burial. So that's what life cycle costing means. Cost incurred from born to burial. It means that if a product is introduced or a product is born, and till the end of the product, the whole cost will be considered. So that's what life cycle cost means. So the life cycle cost of a product can be like determined by getting the total cost of product over its entire life cycle. So the total cost I'll be like incurring from the products born to burial divided by total number of unit produced. All right. So that's what life cycle cost means. So it's just the like based on the term only. We'll be considering the cost incurred for the whole life cycle of the product. That's it. All right. So a product will be having different stage from this born to burial, right? So the first stage will be the product development phase. All right. The product development phase will be the first step that we'll be considering. All right. So the first stage is product development phase. All right, so it means that we are developing a product, right? So like if I'm developing a product or something, like I'll be starting with like developing it, like getting ideas, the designs, the prototypes and all. And the next will be the market development. Okay, so after getting the prototype and finalizing the design, I'll be launching the product to the market. So that's the next phase. And the other phase will be the growth phase. So soon after introducing to the market, I'll be not getting a growth, but after some time the product will start to grow, the demand will increase, and at one point it will be reaching the maturity phase. So it means that there is a stuck at the demand that we are getting. All right, and after that the demand will probably reduce. All right, so this is the things which are happening on the total life cycle of a product. So this is the born phase and this is the burial phase from my example, right? So these are the costs associated in different stages. So in the product development stage, we will be incurring high cost, okay, including research and development and also the design, the prototype making. Will be incurring high cost on the development of the product. Okay, so that's the first stage. And the second stage will be the launch stage. On the launch stage also, the cost will be incurred on extensive marketing and promotion. So by introducing a product, we'll be required to make like aggressive marketing in order to make the potential customers aware of the product. So we'll be incurring high cost on our promotions and marketing also. All right, and the next is the growth stage. And in growth stage, sales volume increases dramatically and unit cost starts to fall since fixed cost will get recovered. So in the growth stage, I'll be producing more unit. So like I'll be achieving more economies of scale. Okay, so that's what happens by the growth stage. So my fixed cost will start to my cost will start to fall as my fixed cost will be recovered from the sale of the product. And the next is the maturity stage. So in maturity stage also, profit continues to increase, right? Like here also my profit will be increased. Marketing cost may increase due to competition. Okay, so if the competition increases, like then I'll be making more promotions and marketing to sell the product, and variable production cost per unit fall due to learning effect. Okay, so like after a certain time, the labors also will be get used to producing this item, and so they'll become experts in the production. So the time taken for producing each item will be reduced. That's it. And the next is the decline stage. So decline stage is something when the demand starts to fall. All right. So decline stage, product economies would be lost. So we'll be losing our revenue. So I have two options here. Either I can stop the production, or I can make an improved product with additional features. All right. So let's say so the prime example of this is, let's say, example of iPhone or something. All right. So what's happening with iPhone? iPhone, like, will introduce each product each year. So let's say iPhone 15 each year, and after some time they'll be producing the next like the next product, iPhone 16. So here what's happening, when the demand for iPhone 15 starts to fall, or like the maximum customers had bought the iPhone 15, then they will introduce iPhone 16. So these customers will switch to iPhone 16. So obviously the company is getting what? More revenue. So this is what the company uses. So either they have two options, like either we can incur like additional like R&D for the replacement product. So like in my example, like 16 is the replacement product, or additional development cost to extend the life cycle, or if I can like sell this iPhone 15 more. So these are the two options that we can make in decline stage. All right. So this is what based with life cycle cost of a product. All right. That's it. Simple. So this is what with life cycle costing, and next we will be moving to the environmental management accounting. So the environmental management accounting is more associated with the sustainability factors. It means that some companies may be careless about their environmental cost. Okay, some companies will be producing more hazardous waste, waste, and they will be getting it into the environment. So the public will be suffocating, or the public are affected based on their activities. So on that case, the performance management has introduced environmental management accounting. It means that the company should also manage their environmental cost. Okay, so the hazardous thing that are affecting the environment, the company is also considering those, so that the customers will also be satisfied. Okay, so the customers will be more impressed when a company is using this environmental management accounting. Okay, so if a company is producing less toxic gas and other things, so the there are chances that the demand of a product can also increase. That's it. So in environmental management accounting also, we will be considering certain cost. Okay, so the first cost that we will be considering is the environmental prevention cost. Okay, so the environmental prevention cost is the cost that are associated with the prevent the production of waste. All right, so if a company had done something in order to prevent the production of waste or something, okay, so in order to prevent something to occur, so let's say prevention of production of toxic gases. Okay, so a company had upgraded their existing machine to a new machine which will incur a less toxic gases. It will be considered as a prevention cost. And the next is detection cost. Detection cost, as you know, that the cost incurred for detecting something. Okay, so the cost incurred to ensure that the organization complies with regulations and voluntary standard. It means that a product is not incurring more toxic gas or something. If it produces, we can detect that. So that's what the environmental detection cost means. And the next is internal failure cost. Okay, so internal failure cost. So first I'll say an example. Simply, a company was producing something, and a leakage had occurred in the production. Okay, inside the production department, a leakage had occurred, and it had not left outside. Okay, so the company had cleaned the leakage within the company itself. That's what internal failure cost means. So the internal failure cost means that cost incurred from performing activities that have produced contaminants and waste that have not been discharged into the environment. So here the waste had not been discharged into the environment. All right, but we had produced but a failure had occurred. Okay, so that's what happens when we use so that is the cost incurred for considered as an internal failure cost. And external failure cost is the opposite. When a leakage had occurred, okay, and the company had eliminated it to the outside the company, so that's what external cost means. It's the cost incurred on activities performed after discharging waste into environment. Okay, so after discharging to the environment, the cost associated with cleaning or the fines or penalties from the government, those are considered as the internal failure cost. And the next is conventional cost. Like the conventional cost is associated with the raw materials and energy cost having environmental relevance. So any raw material cost or energy cost associated with the environment, it is considered as the conventional cost. And next is potentially hidden cost. So the potentially hidden cost means that the cost that the cost we cannot directly get from our activities, environmental activities. It is that hidden in the general overhead. Okay, so it will be included in the general overhead. So that's what potentially hidden cost means. And contingent cost is cost to be incurred at a future date. Okay, it means the future cost. Okay, if I do something now, I'll be getting a cost in the future. That's what conventional cost or contingent cost means. And next is image and relationship cost. It means that a leakage had occurred to the environment, and the media is and it had got public, and the media is like spreading this information about like our company is bad or something. So we will be incurring cost to reduce that bad fame. Okay, so the cost associated by that is considered as the image and relationship cost. So it is cost that by their nature are intangible. For example, the cost of preparing environmental reports. So we'll be giving a report to the public that so these are the reason that had caused it to happen, and we will not be and we will look into it, and we will take steps to reduce the emission in the future. So that's how we are giving an information to the public for the mistake that we had made. So that what image and relationship cost means, and it is mostly intangible. That's it. And the next is the environmental management accounting techniques. So those are the technique that we use in environmental management accounting. So the first is the input output analysis. It means that how much units are input to the production and how much unit we are getting as output. So it's just material inflows are balanced with outflows. Okay, it's just considering, so this is the production and these are the input and these are the output. So in input output analysis, we will be looking at the number of unit which had input to the production and the number of output that had came out of the production. So that's just input output analysis. And the next is flow cost accounting. In flow cost accounting, the cost is allocated to what? Material flow, system flow, and delivery and disposal flow. It means that if we want to produce a product, first we need to buy the material. So the cost incurred with the material is considered as the material flow. Okay, so the cost of material is considered as the material flow. And the cost incurred for production to complete, it means that the cost of buying the material is considered as the material flow. So first, since we had got the material, now we will be starting the production. So the cost which had incurred from the start of the production to the end of the production. Okay, it means that so we had made the production from starting to stage of selling the product. Okay, so the next step will be to sell the product. So the cost incurred till that is considered as the system flow. Okay, till can sell. Okay, till the stage we can sell the product is considered as the system flow. And the next is delivery and disposal flow. It means that the cost incurred for either to sell the product or to dispose the product. So the disposal product means that by producing, I'll be getting certain waste also. Okay, so the waste we cannot be sell. So the waste cannot be delivered. It can be disposed only. So the cost allocated with the delivery of the good output and disposal of the waste output is considered as the disposal flow. Okay, so the value and cost of each flows are then calculated. Okay, so that's what associated with flow cost accounting. And the next is ABC costing. So ABC costing is we'll be allocating cost on the basis of activities for the cost to be incurred. So it's just allocated cost to cost centers and cost drivers based on the reason for cost. It's just ABC costing we had looked earlier. And next is life cycle costing. Okay, so we'll be looking at the environmental cost that we are getting from start of the production till the end of the production. That's it. Okay, so next are the advantages of using environmental management accounting technique. Okay, so the first advantage is that better production cost. All right, so we will be looking at the whole costs that are incurring for a product. So we will be getting a better cost of the product and we can improve pricing. Okay, so we'll be considering like all the costs so that we can like give a price to the product considering all of those costs. And the next is better environmental cost control. Okay, so it is more based on sustainability. So the EMA is more based on sustainability. All right, and the next is facilitates the quantification of cost savings from environmental friendly measures. All right, so by using environmental management accounting, a company would get better insights on the environmental cost. So if they reduce the cost, they can like state their product as environmental friendly product. That's it. And the next is integrate to strategic management. So a company with the sustainability adoption will have a long-term success. So like it will be contributing to the strategic success of the company, or it will be contributing to the strategic management. It means that the long-term decisions, right? And reduction in use of environment damaging product. So once we start using EMA, we will be get better insights on like what are damaging the environment and the reason for that. Okay, so once we get that, we can eliminate. Okay, so it results in reduction of what environmental damaging product. So these are the advantages of using environmental management accounting. And obviously it have so disadvantages. So the first disadvantage is time consuming. Okay, this whole process will be having like will be incurring a sufficient amount of time, right? So it will be time consuming and also expensive. Okay, so we should know that like different costs that we are incurring and all like based on environment. So it is also expensive and difficult to determine accurate cost and cost drivers, same as the disadvantages of ABC costing. And the next is external cost would be ignored. Sometimes like we will be not getting the external cost, like we can't calculate the external cost that will be incurring in the future. So like it is uncertain about the external cost. And the next is some costs are not quantifiable. So let me say an example. Okay, so currently we are emitting some toxic gases. All right, toxic gases we are emitting, and this toxic gas is going to the public. All right, so the public are like breathing these toxic gases, and in future they will be getting some health issues. Okay, in future they will be getting some health issues. Can we calculate the cost incurred for this health issue? Is it that simple to calculate the cost associated for a non-quantifiable product? So that's the like another disadvantage of EMA. Some cost cannot be quantified. All right, so the cost associated with the public getting health issues like cannot be quantified more easily. Okay, and the next is that increased cost of competitors doesn't implement EMA. It means that we are implementing EMA, but our competitor is not implementing EMA. So they are not considering the environmental cost. So they will be having less total cost compared to us. So their profit margin, so like after considering their profit margin, their price will be less than our price, because we are considering extra cost that they are not considering. So for that reason, like it will be like leads to competitive disadvantage. Okay, so that's the another disadvantage of using EMA. Okay, some company may not adopt EMA. Okay, and next we will be looking at the CVP analysis. So now we are done with our specialist cost and management accounting technique. So do you have any doubt or something? Like ask in chat if you do, like you have any doubt of something till what we had looked into covered now. Any doubt? Any doubt? Hope that everyone got cleared about till we had covered now. So we'll be starting with break-even CVP analysis. So in CVP analysis also there are different equations to consider. So the first equation to consider is, in order to get the break-even point in unit, the equation will be fixed cost divided by contribution per unit. So these are the important equation. Okay, so these are the important equation to consider in CVP. So you can just like screenshot it or something to look into it later. All right, so these are the equation to consider. The first is the equation for break-even point in unit will be fixed cost divided by contribution per unit. And the next equation will be unit to get desired profit. Okay, so like if we have a target profit to achieve, okay, or if you want to know that how many units should I be selling, like in order to get this much profit, then the equation will be fixed cost plus desired profit divided by contribution per unit. All right, so like I'll be getting the number of units that I should be sell in order to get my target profit. And the next is margin of safety. So the margin of safety will be budget level of activity minus break-even level of activity. So it basically means the profit that we are getting after the fixed cost. So it's budgeted level of activity minus break-even level of activity. And in order to get the margin, like margin of safety in percentage, the equation will be budgeted sales minus break-even sales divided by budgeted sales in 100%. So like dividing it with the budgeted sales, will be getting the percentage of margin of safety, and the contribution to sales ratio can be get by dividing contribution with sales. Okay, and the next equation is break-even point in sales revenue. Okay, so these equations is in break-even point in unit. So in order to get the break-even point in sales revenue, we will be dividing fixed cost with the CS ratio. It means fixed cost divided by contribution to sales ratio of a product. And the next is sales revenue for the target profit. So the numerator will be the same. So the numerator will be fixed cost added with required profit divided by what? Like instead of contribution per unit, we will be using contribution to sales ratio. All right, that's it. And the next is the multi-product break-even analysis. So like if you are producing like if you want to get the like break-even of multi-product, okay, so like these are the equation for a single product we are producing. So like in order to get for the multi-product, we'll be using this equation. So the first equation will be weighted average CS ratio. It means we are considering the CS ratio of the total product that we are producing. So it will be total contribution divided by total revenue. Okay, so the total contribution from selling 2 to 3 like 2 plus products and the total revenue associated with it. That's it. All right. And the next is the break-even revenue. And the equation for break-even revenue will be fixed cost divided by weighted average CS ratio. Okay. And the next is sales revenue to get the target profit. So here also the numerator is same, fixed cost plus required profit, and it is divided by the weighted average CS ratio. That's it. So that's what to do with sales revenue to earn target profit. So please just like note this equation, like screenshot or something. All right. So these are the equation that you need to know for the calculate for the purpose of CVP analysis. Okay, that's it. And next we are looking into the limitations of break-even analysis. Okay, so for all of the method that we are using, their assumption will be basically their limitations also. Okay, for each method there are certain assumption. So this assumption will be considered as the limitation also. Like going out of that by going like out of that assumption, we cannot use this method. All right, that's it. So the assumption is that the total cost and revenue is assumed to be constant. Okay, so the first assumption is there is no change in total cost or revenue. And the next is all cost is divided into variable cost and fixed cost. There are not other type of cost. It's just variable cost and fixed cost. So this is the other assumption. And the next is fixed cost remain constant over a volume. Okay, so it means that like the fixed cost will be like constant over an entire volume. Okay, it will not change. And the next is total variable costs are directly proportional to volume. Okay, so the reason for the variable cost will be the volume, not any other factors. The only reason for variable cost will be the volume. So that's another assumption. And the next is selling price is not changed. So the selling price is same for the entire year. So that's another assumption. And the price of production elements are unchanged. So the like material cost and labor cost is considered as same. Okay, they are not changing. So these are the other assumptions. So like when a material or wage cost changes, then the CVP analysis cannot be used, or it is not effective to use. And the next is no change in efficiency and productivity. So the labor will be like producing with the same efficiency and productivity from start to end. There is no room for like learning curve or something. All right. So that's what we'll be looking into. So that's what we are done with the CVP analysis, their equations and their limitations. So that's what with CVP analysis. And the next is planning with one limiting factor. Okay, So in throughput accounting, so this limiting factor is just similar to throughput accounting only. Okay, so if we had a single limiting factor, like we'll be using what, like identifying a scarce resource or bottleneck resource and to calculate the contribution per unit for each product, and then we'll be getting contribution per unit of scarce resource, right, or the contribution per unit of bottleneck resource for each product, and then we will rank, and then and then we will allocate resources based on the ranking made. Okay, like the previous equation only. If we have three products A, B, and C, and if I rank the product A as 1, B as 2, and C as 3, I'll be producing the A product first. A will be produced first, B will be second, and C will be produced third. All right. So that's how we plan with a single limiting factor. Okay, but if we have more than one limiting factor, then we will be using linear programming. Okay, so the linear programming is a method like that include like drawing of this like graph or something with this x-axis and y-axis. All right. So in order to do linear programming, we will be having different steps. Okay, so the first step will be define the variable. Okay, so the linear programming can only be used for production of two products. All right, two products. Linear programming can be used for the production of two products. All right, so the first we will be defining the variable. Okay, so in two product, let x be the first product and y be the second product. So that's how we define the variable. And the next we would formulate the objective. Okay, formulate the objective means that we will be looking at which are the limitations. Okay, so let's go with an example for that. Okay, so just assume that here we are producing two products. Here we are producing two products X and Y. All right, and the material required for X will be 2 kilogram, and for Y it will be 3 kilogram. Okay, and the maximum material available is, let's say, 10,000 kilogram. All right, and the next is labor. Okay, and the labor hours like required for X will be, let's say, 2.5 hours, and the labor hours required for Y will be 4 hours, and the maximum labor hour that I have will be 11,000 hours. Okay, so these are the two constraints that I have. Okay, so here my material is limited, also my labor is limited. So in order to formulate the constraint, we will be looking at the time taken to produce X. Okay, so for each unit of X, 2 hours is required. So my objective will be, or my equation will be 2x plus 3y. Okay, so the maximum kilogram that I have is how much? 10,000. So by using materials to X and Y, it means 2 kilogram for X and 3 kilogram for Y. The maximum material that I should be used is 10,000 kilogram. So my equation will be, by adding this 2 into like number of product of X and 3 into number of product of Y, the maximum should be 10,000. So the equation will be 2x plus 3y should be less than or equal to 10,000. And for like labor, it will be 2.5x plus 4y. It should be less than or equal to 11,000. So this is the equation for my constraints. And next we will be looking at the objective. Okay, so let's say X and Y, right? So let's say X have a, let's consider the contribution per unit. So consider X have a contribution of 3 and Y have a contribution of 4. So my objective will be the total contribution. Like it means that contribution from selling the X and contribution from selling the Y should be maximum. So this is my objective, and these are my equation for my limitations. Okay, and next we will like formulate the constraint. So the formulating the constraint we have already done. So this is the formula for constraints. All right, and the next is draw a graph identifying the feasible region, and after that we will be solving this X and Y. Okay, and after solving this X and Y, like I will be getting a point or something. Okay, so like I will be getting a point here and I will be getting a point here after solving the X and Y, right? So this will be considered as the feasible region. So this will be considered as the like feasible region as, so these are the common area after considering all the constraint. And then I will be drawing the objective function. So like I will be drawing the like line for contribution here, and after extrapolating this, which point is met at last. Okay, after extrapolating this, like which point is met last, that will be considered as the optimum point, and I will be getting the maximum contribution in that. Okay, so like I'm not going into the like detail of this because we have limited time, right? So that's how we use linear programming to get the optimum production for product. And so next we will do like solve for the optimal production plan and answer the question based on the objective of maximize the contribution or minimize the cost. Okay, so here my objective was to maximize the contribution. Okay, so there will be situation to like minimize the cost also. So in that case also, like we'll be using this same linear programming method, but the objective to like minimize the cost is not tested frequently. Okay, so in exams also the main objective will be to maximize the contribution only, so you'll need to focus on that only. Okay, fine. And the next is assumption used in limiting factor analysis. So the first assumption used is we will be having a single objective only. So like and the single objective will be to like, and the single objective will be either to maximize contribution or minimize cost. So this will be by like basic objective, and the next will be each product uses same scarce resource without considering learning effect. Okay, it means that like each product is using same amount of resource and there is no learning effect. Okay, that's it. And the next is contribution per unit is constant. So these are the assumptions used in limiting factor analysis. And the next we will be looking at the shadow price and slack. Okay, so the slack is the amount by which a resource is underutilized. It means that I'll be having 10,000 kilogram of material available, but I will only be using 9,000 kilogram of material due to lack of labor. So due to this lack of labor, I have 10,000, but I'll be using only 9,000. So this material can be considered as a slack here. So in this case, the material is considered as a slack because here the material is underutilized. That is, slack occurs when maximum availability of resource is not used. Here my maximum availability of resource is 10,000 kilogram, but I am only using 9,000 kilogram. So here the material is considered as a slack. And the reason for material becoming as a slack is the lack of labor hours. Okay, so like I have like less labor hours, so the labor hours will be utilized by using like 9,000 kilogram. So there is no labors to use this the remaining 1,000 kilogram. Okay, so for that reason the material is considered as a slack. All right, and shadow price. Shadow price is based on the scarce resource. All right, so the shadow price is the excess contribution generated on availability of one extra unit of scarce resource. It means that, just take an example that here my constraint is labor hours. Okay, I have limited labor hours. Like let's say I have 10,000 hours of labor hours only. So by using this 10,000 labor hours, I'll be getting a contribution. Okay, so by exploiting this labor hours, like I'll be getting a contribution, let's say C1. So shadow price is the extra contribution that will be generated by getting extra unit of resource. So if I get an extra hour, extra 1 hour, then I'll be getting a extra contribution. So let's consider that as a contribution C2. So the extra contribution will be C2 minus C1. Okay, so after deducting my like new contribution with the old contribution, we will be getting what? Shadow price. So shadow price is the extra contribution generated on availability of one extra unit of scarce resource. All right, so next is how we can calculate the shadow price. So the like step 1 is take the equation of the straight line that intersect at the optimal point. Okay, so first we will be using the linear programming and we will be getting the optimal point and add 1 unit to the constraint concerned. Okay, so here my constraint was labor hours, so like I'll be adding 1 extra labor hours to the constraint, like while leaving the other critical constraint unchanged. All right, so like other constraint will be considered as same only. Okay, and step 2 will be use simultaneous equation to derive a new optimal solution. Okay, so after increasing the labor hours by 1 hour, like I'll be calculating the new contribution. Okay, and Then calculate revised optimal contribution and compare with the original contribution. It's same as here. So this is my revised contribution and this is my original contribution. And by comparing it that I'll be getting the shadow price, or by deducting the revised contribution with the original contribution, I'll be getting the shadow price. So that's how we get the shadow price. So these are the steps that we can use to get the shadow price. And the use of shadow prices. So the first use is management can use shadow price as a measure of the maximum premium that they would be willing to pay for more than a unit. So by using shadow price, like I'll be getting the maximum amount that I can be paid to the extra labor hours. Okay, for each extra labor hours like that I am getting, how much is the maximum extra amount that I am willing to pay. That's how we get using. So like using shadow price, we can get that maximum premium amount like that we can pay to like get the my limiting constraints, right? And the next is, if more of the critical constraint is obtained, the constraint line will move outward, altering the shape of the feasible region. Okay, so it means that if my labor hours is increased, okay, if my labor hours is increased, then my graph of the labor hours will be shifting upwards. All right, so after shifting the labor hours graph upward, then my constraint for labor hours will be decreased. So by reaching a certain point, another limiting factor will occur. That's what's said here. If more critical constraint is obtained, the constraint line will move outwards, the altering the shape of the feasible region. After a certain point, there will be a lifting point in buying more of the scarce resource, since any non-criticized constraint become critical. Okay, so currently my constraint was labor hours. Okay, so by getting more labor hours, like my graph had been shifted upwards. So after reaching a certain point, the labor hours will no longer be the constraint. Okay, after reaching the certain point, like let's say this was the labor hours line at first, and this was the line for material. Okay, after getting more labor hours, my labor hours line had became here. So like it is like more than the material. So my current constraint will be material, not the labor, because like I got more labor hours, so my like the constraint occurring due to labor hours had been eliminated. Okay, so these are the use of shadow prices. And the next is different types of market structures. Okay, so there can be different types of market that we will be going into. Okay, so in a perfect market, okay, so in a perfect competitive market, no participant can influence the price of the product which is bought or sold. Okay, so in a like perfect market, like no one can influence the market price. Okay, like no new like competitor can influence, or like the like existing like companies in the market also like cannot influence the price of the product. Okay, so in a perfect competitive market, no participant can influence the price of the product which is bought or sold. And the like other characteristics is zero enter or exit barriers. It means that it is relatively easy to enter or exit as a business in a perfectly competitive market. So like in a perfectly competitive market, like we do not have an like issues with the like entry or exit. We can sell when we want and we can stop selling when we want. And next is perfect information. It means that price and quality of good are assumed to be known to all consumers and producers. It means that everyone like all consumers and producers will be knowing the price and quality of the product. Okay, so there is like nothing to hide in a perfect competitive market. And the next is companies aim to maximize profit. Okay, so the primary objective of the company in a perfect competitive market will be to maximize profit. Okay, and the next is homogeneous product. The characteristics of any given market good or service do not vary across suppliers. Okay, so it means that the price of the good or service will be the same. Okay, so the product that they are providing will be the same, and the price that they are paying for the product will also be same. So that's what homogeneous product means. And then there is imperfect competition. Okay. And then there is imperfect competition. So the imperfect competition means that the imperfect competition refers to market not meeting the condition of a perfect competition. So if a market is not having perfect information and the company is not aiming to maximize profit, like, or the product are not homogeneous, or there is like entry or like exit barriers existing, then it is considered as a imperfect competition. So the imperfect competition includes monopoly. It means that one company dominating the industry comparing to the other. It means that like there is only one seller of a good and the seller dominates many buyers and can use its market power to set the profit maximizing price. Okay, so if a company had got monopoly, that company will be setting the price for like by which the product should be selling the market. So that's what monopoly means. And this is oligopoly. Oligopoly is means few companies dominate the market and are interdependent. Okay, so it means that so there will be some top two companies and these top two companies will be determining the price for rest. Okay, so these top two companies will be like determining the price for the next like the price for the rest of the industry. So that's what oligopoly means. Okay, so it means that the like few companies will be dominating the market and the firms must take into account likely reactions of their rivals to any changing price, output, or forms of a non-price competition. So it means that two companies will be dominating. So if one company increase the price, then the other company will also be increasing the price. So that's how it goes. So that's what oligopoly means. And the next is monopolistic competition. It's just the product will be similar but not identical. Okay, so like they will be selling the same kind of product but it's not identical. Okay, and there are many producers or price setters and many consumers in a given market, but no business has total control over the market price. So monopolistic competition means that the product itself is different. Okay, so no one can set the like market price at an optimal level. Okay, so different companies will be setting like different market price like due to their like uniqueness on the product, because here like no product is identical, it is just similar. So that's what monopolistic competition means. So these are the terms like that you will be required to know. Okay, and so the next is pricing decision. So the next chapter we are looking is the pricing decision. So we can set the product price based on three approaches. First will be demand based approaches. Okay, so if the demand is more, then price will be more. If the demand is less, price will be less. The next is cost based approaches. By calculating the cost only, we are determining the price of the product. So like it's just like calculating the cost plus our required profit margin. And the next is market based approaches. So it is based on the how the product is selling in the market. So these are the three based approaches. Is like demand based, cost based, and market based. So next is like next we are looking at how to determine the optimal price of the product. Okay, so in order to get the optimal price of the product, there is a linear relationship exists between the price and the demand. Okay, so if the demand will be more, then the price will be more. Okay, and if we like increase the price, like the demand will decrease. So the equation will be P is equal to A minus B into Q. This is the equation used to get the optimal price of the product. Okay, so A is the intercept. It means the maximum price at which demand will be zero. That's what A means. And B is the gradient, the amount that has to change to the change in demand by 1 unit. Okay, it means that change in like change in price by change in demand. Okay, the amount that has to change demand by 1 unit. So that's what the gradient means. And the step 2 is double the gradient to find the marginal revenue. Okay, so in order to get the so this equation was to get the price, and to get the like marginal revenue or equation was MR is equal to like the marginal revenue is equal to A minus 2 into Q. And like in order to get the maximum profit, the marginal cost will be equal to marginal revenue. So in order to get the maximum price, our marginal cost will be equal to the marginal revenue. Okay, so that's what said here. So that's what step 4 is. And other is substitute the value of Q into price equation to get the optimal price. So by solving this, we will be getting a quantity. Okay, or the Q, the quantity demanded. By substituting that into the price, we will be getting the profit maximizing price. All right, so then we will be getting the maximum profit. So this is associated with the calculating the optimal price of the product. And equation to find the total cost also we are using the same equation, like a different equation, and it will be y is equal to a plus bx. So like in order to get the total cost, the equation will be so the total cost is equal to a plus bx. So here the a will be the fixed cost and b will be the variable cost and a will be the activity level. Okay, so if a fixed cost of the product is 1000, variable cost per unit is 2, and the unit we are producing is let's say 200, then what will be the total cost? Our total cost will be fixed cost a plus b, variable cost per unit into quantity 200. So it will be what? 1000 plus 400. So the total cost will be 1400. So this is the equation that is said here. Total cost is equal to a plus bx. A is the fixed cost, b is the variable cost, and x is the activity level. Okay, so like basically the total cost is equal to fixed cost plus variable cost. All right. So next is the cost plus pricing method. Okay, so like if we are using cost plus pricing method, our equation for the cost will be cost plus our required markup or margin. That's it. And the next question is, what type of cost should be considered? What cost should be used to calculate the price of the product? So there are like different costs associated. So the first cost is actual cost or standard cost. Okay, so in standard cost, price can be set in advance for the period. At the start of the year itself, we can set the price for the product, but variances may occur and losses may arise. Because like if we are setting a standard price, but if we can't sell the product at the same price or the same like if you are like incurring like more cost or like less cost than the standard, then there will be variance. Okay, so like I had set the standard cost for $10, but the actual cost incurred was, so this was the standard cost and the actual cost incurred was $12. If the actual cost incurred was $12, like there will be variance. So by using standard cost, there are chances of getting variance. But if we use actual cost, the profit is guaranteed. Okay, so like if you are using like actual cost, like we are considering the same cost that we are incurred in actual case. So here the profit is guaranteed, but inefficiency may be passed to customers. It means that we could produce at a cost of $10, but we had produced at a cost of $12. So there is an like inefficiency in the production. So like that inefficiency will be transferred to the customer also by using actual cost, and not possible to predetermine. Okay, like by using actual cost, the price can only be determined at the end of the year, because cost will be incurring at the like the actual cost can be determined at the end of the year only. So in actual cost, we can't set the product in like we can't set the price in advance. Okay, like it can only be set at the end of the year. And the next cost we can consider is like whether we should consider marginal cost or full cost. Okay, so by considering marginal cost, absorption is not required. All right, it means that fixed cost is considered as a period cost and difficult to find appropriate markup or margin to cover fixed cost. Okay, by using marginal cost, our like the profit margin should cover both the fixed cost, and after that like we should get a profit. So sometimes it may be difficult to get that optimal margin to set, and it is mainly used in short-term decision making only. Okay, for long-term decision we'll be using full cost method. So in full cost, it ensures that all costs are considered for pricing the product. Obviously we will be considering both our variable cost and our fixed cost. So the profit will be made if target are achieved. So the profits are guaranteed if target are achieved. That's it, by using the full cost. However, absorption of overhead is an arbitrary measure based on budget overhead and budget base. Like as we said earlier, the like absorption is based on budgeted overhead divided by budgeted base or budgeted like unit hours or something. So end of the day they are budgeted. So like different can occur like when comparing it to the actual overhead incurred and actual unit sold. So there is a risk on it. And the next is by considering the relevant cost. Okay, so the relevant cost is used to set the minimum price for one-off contract. So like the relevant cost is considered as the minimum price. It does not consider fixed cost even if it is associated with for the product. So that's the main like disadvantage in like relevant cost. The fixed cost is not considered. and maybe be difficult to estimate the incremental cash flows. All right, so sometimes it may be like difficult to get the incremental cash flows, and no guarantee that profit will be achieved. Okay, by using relevant costing, we will only be considering the variable cost which are relevant for the production. Okay, so we are not considering fixed cost. So in that case, like there are chances for losses to occur. Okay, so next is the advantages and disadvantages of cost plus pricing. Okay, so the like advantage that like it is widely used, simple to calculate, selling price can be made by juniors also, and reason for price can be made, and price stability can be achieved if competitors also perform similar markup on similar cost. So these are the advantages, and next is like the disadvantages. So disadvantage is that it ignores relation between price and demand. Okay, so here the demand is not considered, only the price is set on the basis of cost. Only the cost is considered here, not the demand. Okay, the demand is not considered, and no attempt for the optimum price. Here we are not setting the optimum price by using that equation P is equal to A minus XP. So here we are not using this P is equal to like A minus B2 equation in order to get the optimum price. All right, so we are just like blindly getting the price based on the cost associated. Okay, and the next is different absorption gives rise to different selling prices. Okay, so like if I absorb on the basis of unit, I'll be getting a different selling price, and like if I be using absorption on the basis of labor hours, then I'll be getting another selling price. That's it. And it does not guarantee profit if volumes aren't achieved. Okay, if my required volumes are not achieved, then I'll be not getting my required profit, and decision between the full cost or marginal cost exists. So the company should decide like whether they should use marginal cost or full cost. So like it is also difficult to determine, and there is no flexibility in pricing. Okay, we cannot increase or decrease the price as our requirement. Like we'll be setting a price based on cost and margin, and that will be set for the whole year. And pressure to increase prices if less volume and budget. Okay, so if we are selling less volume, then we will be required to increase price in order to get our required profit. So that is also considered as a disadvantage. All right, and the next is customer based pricing and competition based pricing. Okay, so in customer based pricing, we will be setting the price based on customer perception. Like it means that we will be setting a price based on the customer requirement, and in competitive based pricing, we will be setting price based on the market competition. Okay, so like if the market is increasing the price, then we will be like then we will also increase the price like without considering the customer perspective. All right, that's it. And next are the different market strategies. Okay, so if a company is going to introduce a new product, so like they can use either market skimming or market penetration strategy. Okay, like based on the situation. So the market skimming is that high prices will be charged on launch of the product. Okay, so in market skimming price, a premium price will be set, or the product will be launched as a premium product. And the condition that should be met for the market skimming to be used is product should be new and different from existing market. It means that the product that the company going to introduce is different from the existing product. Okay, so like basically the product should be innovative. Okay, a product that the customer like haven't seen since then should be introduced, so that the customer will be willing to pay like more amount for the unique product that we are introduced. And the next is if they have short life cycle. Okay, so like if the company, so like we cannot sell it for a long time. Okay, so the life cycle is very short. Like then also we'll be using like market skimming to get the cost to recover the cost as soon as possible. Okay, and the next is less elasticity between price and demand. It means that even if the price is increased, the demand is not affected. Okay, so like even if we increase the price, the demand is not affected. In that case, we can use market skimming. So like even if we increase the price also, the customer will be paying more. So let's say an example of petrol or something. Okay, so the petrol is the like required commodity like in our like day-to-day life to travel. So like even if the petrol price is increased, does the demand for like petrol will be low? No, like everyone who have a like bike or car or something like will be paying for petrol even if the price is more. That's it. And So that's with market skimming strategy. And the next is market penetration strategy. All right. So the market penetration, like strategy will be low price will be charged initially. Okay. So initially we'll be charging low prices to get the better acceptance. Okay. So like at the introduction we'll be charging less price only. And the situation in which the penetration will be used is wishes to increase market share. Okay. So like if a company wants to take the market to their hand, then they will be charging less charge. Okay, so let's say an example of this Zudio or something. Okay, so let's compare this Zudio compared with Armani Exchange. We know the difference, right? Zudio is charging very less price for their outfit, and Armani Exchange is charging more. So if we go into the public, like what type of brand will be the like public, like where we like public be wearing more, like it will be Zudio products only. Okay, so if we take 10 persons, the like person wearing like Zudio will be more than the person wearing Armani Exchange. So what's the reason? They are selling at a very low price. Okay, so like they have more market share than Armani Exchange. Okay, but still Armani Exchange could be profitable due to their premium price charge for each product. Okay, so like in order to get the in order to like get like profit for Zudio compared to Armani Exchange, like Zudio may need to sell, let's say, like 10 outfit in order to get the profit like Armani Exchange getting for the one outfit. So that's the difference. The profit margin will be less for Zudio, but still they will be having more market share. And the next is it would discourage new entrants from entering market. Okay, since like Zudio itself is selling at a like low price, some competitors will not arise. So, like since they are selling at a very low price, like there are less chance for like competitors to arrive at a lesser price than Zudio. Okay, and the next is significant economies to scale to be achieved from a high volume output. So if we are selling a high volume of output, like then we can get the like significant like economies of scale, like we'll be getting like more profit like if we sell more items. That's it. And the demand will be highly elastic. Okay, so in order to elastic means, in case of market penetration, if a price is slightly increased, then the demand will be reduced aggressively. So if the demand is highly elastic also, then we can use market penetration. If it is not elastic, then we can use market skimming. All right. And the next is complementary product pricing. So in complementary product pricing, one product is used with another product. Okay, like let's say like razors and blades. Okay, so like if a person is buying razors, then they will be buying like blades also to shave. That's it. So that's what complementary product pricing means. So the price will be set for both razor and blades together combined. That's it. And next is product line pricing. It means range of product relate to one another, such as iPhone series at different prices. Yeah, like the product line means that a single product will have different series. Okay, so in iPhone also we have, let's say iPhone, we have what, iPhone 16, then we have iPhone 16 Pro, then we have iPhone 16 Pro Max, 16 Pro Max. So this is what product line pricing means. A same product will be sold at different stages. Like so like the first will be have 16, then 16 Pro, then Pro Max. So that what product line pricing means. A range of product will be sold, okay, as like one another. That's it. And the next is price discrimination. It's just different prices charged at different markets. It's, like it basically like based on the demand. So like if we have premium customers, then a premium price will be charged, and if we have like middle class customers, then like middle class price will be charged. So that's what price discrimination means. Same product is selling at like different price at different markets, and condition required for price like there are certain condition like required to achieve price discrimination, and those are: seller should have monopoly. It means that seller can determine the price at each market. Okay, seller have the power to determine the price. So that's the first condition to be met. And the next is customers segregated in different market. It means that one customer cannot go into the another customer. Okay, and the next is customer can't make sales between the market. Okay, it means that one customer can like buy from the cheap market and sell in the expensive market. That's it. And the next is effective for services. So the price discrimination can be more effective in services. It means that if a let's say let's say in case of a CA firm. Okay. In case of CA firm, two companies are coming to audit. Right? So one company have high profit and other company have less profit. So does the CA firm will charge same fee for this both high profit company and less profit company? They will obviously charging more profit for the high profit company, because CA know which company have more profit and which company have less profit. So they will be charging based on the customers' capacity to pay for the service that we are providing. So that's what price discrimination means. That's it. And the next is disadvantages of price discrimination. So the first disadvantage is chances for product in low prices segment sold at high price. So there are still risk that the product can be bought at low price segment and can be sold it at the high price segment at a higher price. So there is a risk for that, and competitors may sell at low price. Obviously, if we have a sound competitor, they will be selling the same product at the low price. All right. And the next we will be looking at the relevant cost. Okay, so next we'll be looking at the the relevant cost. Okay, so in order for a cost to be considered as a relevant cost, it should be future, incremental, and actual cash flow. Okay, so a relevant cost should be future, it is supposed to happen at the future after making the decision, and it should be incremental to the decision, and it should be the actual cash flow. So then there is opportunity cost. Opportunity cost is the value of best alternative foregone when decision is made. So if when we are making a decision, the contribution that we have lost to the best alternative foregone is considered as the opportunity cost. All right, that's it. And next is determining the relevant cost of materials. Okay, so in order to get the relevant cost of material, we will be looking at different situation. Okay, if the material is currently in stock and the material is regularly used, then the relevant cost will be the purchase price of the material. Because if I take that material, I am supposed to replace it. So I'm going to buy new material. So the relevant cost will be the current purchase price of the material. Okay, but if the material is not regularly used, okay, so the material is still in inventory. Okay, so the material is still in inventory and it is not used. Then the relevant cost will be the opportunity cost. It means that if I didn't use the material now, I can sell, I can sell it at a scrap value, or I can use in different production. Okay, so if the item is not required to be replaced, then the relevant cost will be the opportunity cost. That is our lost scrap value or the lost contribution if material is used here instead of elsewhere. All right. So also, if there is an alternative use for the material, if there is no alternative use, then the relevant cost will be the scrap or disposal value. If the item have a relevant cost, then the relevant cost will be the higher of scrap and other value. Okay, so if the scrap value of an item is $10, and if the contribution that we are getting in another item will be $12, then the relevant cost considered will be the $12 only. It is the higher of the value of other use and or scrap value. And if the product is out of stock, okay, if we do not have the material, then we want to buy it, then the relevant cost will be the current purchase price only. All right, then the relevant cost will be current purchase price. And the next is the relevant cost of labor. Okay, so by considering the relevant cost of labor, we will be using we will be looking at the spare capacity and the full capacity. Okay, if currently we have spare capacity, it means that the labors are okay. So the currently the labors are getting paid for 100 hours of work, and they are now only working for 80 hours. Then we have 20 hours as spare capacity, and I need 10 hours of labor. Okay, I need 10 hours of labor, and they are already getting paid for this 10 hours. And in that case, the relevant cost will be considered as 0, because we are already paying labor for the working hours. So then we are not required to pay additional payment. That's it. And if the labor is working at full capacity, Okay, if the labor is working at full capacity and we can hire more labor, that is like if we can take labor for extra staff for extra pay. Okay, it means that like there are chances of getting like new labors for my production, then the relevant cost will be the extra cost for the labor. Okay, and if I can't get more labors for production, like then I will be taking labors from other divisions. Okay, like it means that like like a labor is already producing in other division, like I will be taking labor from there. By taking that, the production of that division will be stopped. In that case, the relevant cost will be the opportunity cost of diverging labor. Okay, like it means that I'll be losing like that division will be losing a contribution as a result of me taking labor from them. So the opportunity cost of the taking labor and also the extra labor cost will be considered as relevant cost in that case. All right, that's it. And then we are looking at the relevant cost for non-current asset. Okay, so if the non-current asset is a new asset, then the relevant cost will be the purchase price or scrap or disposal proceeds. Okay, like if it is a new asset. If it is an existing asset, okay, if we currently have that asset, then the relevant cost will be the higher of sales proceeds and lost contribution from use in other department. Okay, so this is what the relevant cost associated with the non-current asset. That's it. And items that are not relevant include depreciation, because depreciation is not a cash flow, and profit or loss including depreciation, because like the profit or loss including like depreciation contains the depreciation which is not an actual cash flow, and also the original purchase price because it is a sunk cost. Sunk cost is what? Sunk cost is the past cost. And past cost is not relevant, because in order for a cost to be relevant, it should be future incremental and should be actual cash flow. Okay, that's it. And in one-off contract, okay, like in case of just a one-off contract, like the minimum contract price will be the total net cash flow associated with the contract. That's it. Like if a contract is a one-off, like we are getting like once in a time, then the minimum contract price will be the relevant cash flow associated with the contract only. That's it. And next we are looking at the make or buy decision. Okay, so a company have two options. Either they can make a product in-house or they can order it from external suppliers. Okay, so if there is a like in order to make a make or buy decision with no limiting factors, it means that like here we do not have any limiting factors or something, and we need to decide between whether to make or buy. The relevant cost will be the differential cost between two options. Like it means that the cost associated with making and the cost associated with the buying. Okay, if we have limiting factors, currently we have limiting factors, then we should go through these 5 steps to get whether to make or buy. So the first step will be savings per unit is calculated. Okay, it means that if I produce internally, how much cost that I've been saved, that is considered. All right, and the next is divide this with the scarce resource. Okay, so here I have a like limiting factor, so like I should divide the savings with the limiting factor associated with the product. It gives the savings per unit of limiting factor, and after that we should rank the product, and the product that have maximum savings will be made internally, and the product will have like less savings will be bought externally, and the higher savings will be on like the higher savings on the like the higher savings per unit on this limiting factor should be prioritized. Okay, it means that like the limiting like the highest savings on limiting factor will be like prioritized, and it should be produced in-house, and the rest and the product with less savings will be ordered from outside, and the scarce resources are allocated to product with the order of priorities until fully used. Okay, so that's how we used in like the in like limiting factor cases previously, and product with unsatisfied demand is bought externally. It means that like we had allocated all the limiting factors to the product based on their savings, and and the product for which the like say like the resources not allocated will be bought externally only. That's it. And the next is the other cost associated other issues to consider. Okay, so the other issues that we should consider include reliability on external supplier. Okay, So currently we are going to buy the product from outside. So first we should consider the supplier profile. And the next is the skills associated for the production. If they have sufficient skill, like if the supplier had got the skills to produce that item. And the next is alternative use of resource. All right, if the resource have any alternative resource or alternative use or something. And next is social aspect. Thus the public will be like satisfied with us getting like buying the product from outside. And the next is like the legal complaints, if there is any like legal issues associated with buying outside. And the next is confidentiality. Okay, so if I like get a product externally, I'll be sharing my design. Okay, like I'll be sharing my prototype that I require to the external supplier, so they'll be producing like that. So here my confidentiality is getting breached, like they are getting to know the design of my product. Okay, so that's a threat. And the next is customer reaction, whether the customer will be satisfied if I bought from outside or if I bought like if I produce internally. Okay, so basically like we need to consider, does the quality is getting affected. If the quality is getting affected from buying outside, then we should not go for buying externally. That's it. And the next is shutdown decision. Okay, so here we are going to determine like where whether a division should be closed down or not. Okay, so for that we should consider both quantifiable cost or benefit and non-quantifiable cost or benefit. So the quantifiable cost that should like cost and benefit that should be considered is lost contribution from the area that is closed. Okay, so how much contribution we are losing as the result of this shutting down. And the next is saving from specialist fixed cost from closure. Like if we are saying any rent, electricity or supervisor cost should be considered as the quantifiable cost. And any non-reorganization cost, if we want to reorganize that like division for other purposes, it is also considered as the quantifiable cost here. And the next is any non-additional contribution from alternative use of resources. Okay, if I use that, like if I shut down the decision and like start for other use, if we have any extra contribution getting from that use, it's also considered as the quantifiable benefit here. Okay, and obviously there will be some of this like non-quantifiable cost and benefit. So the non-quantifiable cost and benefit will be the penalties and other costs resulting from the closure. So if I close, whether there are any penalties or other costs associated, that is considered as like non-quantifiable cost or benefit, because like it's not easy to quantify that type of cost. And the next is reorganization costs, which are unknown. Some reorganization cost we can't like determine it easily, so that is also considered as the non-quantifiable cost and benefit. And the next is additional contribution from alternative use that is uncertain. Okay, if like whether the contributions are uncertain of the alternative use, then it is also considered as the non-quantifiable cost and benefit. All right, so that's how we are done with shutdown decisions. Okay, so next we'll be going to discuss about like whether a product should be further processed, like the further processing like decision. It means that whether a product should be further processed or not. Okay, so here the joint product can be separated at the split off point. Okay, so let's take an example of crude oil. Okay, so if we extract crude oil and after reaching a certain point, it will be separated to, let's say, both petrol and diesel. All right, so the point at which it is separated into petrol and diesel is the split off point. Okay, so till the split off point we will be incurring a cost. That cost is known as the joint cost, and we need to allocate this joint cost to both petrol and diesel. And in order to allocate that, we can use sales value of production of both petrol and diesel, or the production unit of petrol and diesel, or the NRV of petrol and diesel. So these are the three methods that we can use to allocate this joint cost to the product we had been splitted. Okay, and also when deciding whether to further process or sell at the split off point, the difference in revenue and extra cost is considered. Okay, so here we have two situations, right? So here we have like crude oil. Okay, let's say here we have crude oil, and after reaching a certain point we will be like splitting it into petrol and diesel, right? So here I need to make a decision whether I should sell at the split off point or should I sell after processing to petrol. Okay, so in order to determine that, like I would be looking at the revenue, like revenue getting on the like the sales of petrol and the extra cost that should be considered. Okay, so for processing from here to here, I will be having an extra cost. So we'll be considering the like the difference in revenue and the extra cost associated in order to determine whether the product should be further processed or not. That's it. And joint cost shouldn't be considered as it is not relevant to the decision. Okay, cost, like the joint cost is common in like both in this situation and here. So the joint cost is not considered by using here. Okay, because the joint cost is common, so it is not relevant. All right. And then we will be looking about the risk and uncertainty. Okay, so if a company is facing a risk or uncertainty, they will be using different methods. Okay, so like so for risk, there is a number of possible outcome and probability of each outcome is known. So if a number of possible outcome and if the probability of outcome is known, then it is risk. So what's uncertainty? Uncertainty is so there are a number of possible outcome, but the probability is so the probability is not known. Okay, so like if you know the probability, then it is risk. If you don't know the probability, then it is uncertainty. Okay, and in order to deal with risk and uncertainty, we have different methods. Okay, and the first method will be sensitivity analysis. Okay, so in sensitivity like analysis, will be considering the uncertain fact and considers how it changes would affect the decision making. So that's like sensitivity analysis, and like and then it is simulation. Okay, so in sensitivity analysis, we will be considering only a single variable to make the decision, but in simulation, we'll be considering like more than one variable to get like whether it is like affecting the profit or not. And the next is expected value. Okay, so like expected value is like getting into a decision based on the probability of occurrence. And next is maximax rule. Okay, so in maximax rule, we'll be like selecting the alternative that maximizes the maximum payroll achievable. That's what maximax rule means. And in like maximin, we'll be seeking alternative that maximizes the minimum payoff. Okay, so like maximus will be taken by the companies which are risk seeking. Okay, so if a company is risk seeking, they will be willing to get maximum returns. So in that case, a company can use maximax rule. But if a company is risk averse, okay, it means that a company can't take maximum risk, or like a company is not willing to take any risk, then they can use maximin. Like it means that they are getting the like they are making the like decision based on maximum payoff from the minimum. Okay, and next is minimax regret. It means minimizes the maximum regret. Okay, so the regret on choosing the like the best opportunity. So the regret is the sense of opportunity lost in making wrong decision. All right, so that's what minimax regret means. And next is decision trees. So it is the diagrammatic representation of multi-decision problem. Okay, so here we'll be drawing this like here we'll be drawing this thing. Like I will give an example of decision tree. It's like here we'll be considering, so this is the decision that we want to make. So here will be like different like branches or something, and we'll be using like circles and squares to make the decision. All right, so this is what decision tree means. Okay, so here this square represents a decision and circle represents expected value. Okay, so here the square represents a decision and this circle represents expected value. So that's how using decision tree also we can make a decision. Okay, that's it. And the next is the value of perfect information. Okay, so perfect information is the forecast, like which will like always be the correct prediction, so that the undertake the most beneficial course of action. So by using perfect information, we'll be getting the correct prediction, so that like by undertaking that it will be most beneficial to us. But imperfect information is like it is usually correct but can be incorrect too. Okay, so like in perfect information, like it will always be the correct prediction, but in perfect information it can be incorrect too. So like it will be not as valuable as perfect information. All right, so the equation for perfect information will be expected value from the perfect information minus expected value from the imperfect information. That's it. So here we are like brushing up the topic, and next we will be looking at the budget. Okay, so next we'll be considering the budget of the product. Okay, so first we will be looking at the purpose of the budget. Okay, so here the the main purpose of the budget will be what? It will be planning, control, communication to departments and coordination between department, evaluation of performance, motivation of employees, authorization of performance, and also the delegation of work. So these are the main purpose of budgeting. Okay, so instead of a company saying workers to do something, if they give them the budget, then the the laborers itself will be able to get an perfect image on what the company is planning to do. Okay, so by looking at the budget, everyone can know that what the company is planning for the next year. So that's what the purpose of budget means. So it's basically for planning, control, communication, coordination, evaluation, motivation, authorization, and delegation. So these are the main purpose of budget, right? And how all we can set the budget? There are different method in which budget can be set. Okay, so the first method is top down versus bottom up. So first let's look at the top down budgeting. Okay, so top down budgeting is basically like the upper management will be making the budget. Okay, so in top down management, the upper management will make the budget and it will be given to the lower level managers. Okay, so the decision is made at strategic level. So in top down case, they are not asking the opinion of the lower level managers. So the lower level managers will not be satisfied with the budget. All right, so so there are chances that the strategic decision may set the budget at a higher level. Okay, so which may be challenging to achieve for the lower level managers. So that's what top down approach means. So in top down approach, the budget is set without permitting the ultimate budget holder to have the opportunity to participate in the holding process. So who are the person who is supposed to achieve the budget is not involved in the budget setting process. It's the strategic level management which is setting the budget. So that's what top down approach means. So what would be the disadvantages of using what would be the disadvantages of using top down approaches? So the main disadvantage is that affecting the motivation. The lower level managers will not be satisfied or motivated by the decision made by the upper level management because they have not been asked about their opinion. So they will be dissatisfied. All right. So that's the main disadvantage of using top down approach. And the next is bottom up approach. Okay, so in bottom up approach, they are including all budget holders. Okay, so in that case, the budget will be set by asking the opinion of lower level laborers or the holders who are going to achieve the budget. Okay, so in that case, they will be motivated. That's not a problem. But so there is also disadvantages in using bottom up approaches. So while we are using bottom up approaches, we are asking the opinion, and the company will be paying the bonuses and the rewards for achieving the budget. So the managers, so the lower level managers will be reluctant to say the lowest budget possible so that they can achieve it more easily. Okay, so they may not make it more challenging to get the incentive or the bonus payment. And also the bottom up approach is more time consuming. Okay, the bottom up approach is considered as a time consuming process because we need to ask opinion of all the departments, right? So it is it is more of a time consuming process. Okay, and the next is incremental budgeting. Okay, so in incremental budgeting, only two steps. We will be taking the previous budget. So we will get the previous budget and add the inflation and any other adjustment. That's it. That's with incremental budgeting. So the budget start with previous period budget, step 1, or actual results, and adds an incremental amount to cover inflation and other known changes, step 2. So only 2 steps are taken for incremental budgeting, taking the previous year budget or actual result and adding for inflation and other changes over with incremental budget. It's not so reliable actually, but it's a method. And next is zero based budgeting. It's method of budgeting that requires each cost element to be specifically justified. It means that for each value entering to the budget, the reason for entering that value should be justified. It means that the budget is made with the zero base. Okay, so It's like we are making the budget for the first time we are considering, as though the activities to which the budget relates were undertaken for the first time. It's like, so the zero based budget, the zero based budget will be like we are making the budget for the first time. That's how we will be making the budget. That's what zero based budgeting means. And the next is rolling budget. Okay, rolling budget is like frequently making the budget. Okay, so at now I had made the budget for 1 year. Okay, and I will be and I will be, or the company will be revising it frequently. So like currently I had prepared the budget for 1 year, and after 3 months I'll be looking at the performance of the 3 months that had been completed, and based on that I will be revising the budget for next 1 year. Okay, it means that the budget will be revised on a frequent basis. So the whether based on a quarter, half quarter, or even based on month. Okay, so in rolling budget, the budget will be revised frequently, and the new budget will be set on the next 12 months on a frequent basis. So the budget that keep continuously up to date by adding another accounting period. It can be either a month or a quarter when earliest accounting period has expired. Okay, and the remaining budget is then reforecast as well as the new period being added. Okay, you got it right. So if we completed 3 years, we will be looking at the performance of those 3 years, and we will be making the budget for next 1 year. So currently we had made for 1 year, and in that 3 months had completed. So the next budget will be the extra 3 months of the next year we are making. Okay, so that's what with rolling budget means. And the next is activity based budgeting. Okay, so activity based budgeting is like a method of budgeting based on the activity framework. So it's basically like the ABC method, right? So based on the activity, based on activity based costing, we will be making the budget. Okay, by determining the cost driver and all. So that is activity based budgeting. And the next is feed forward control. So the feed forward control is like the measurement of difference between planned output and actual output. It's like getting the variance, right? By considering the variance, we will be making modification to the budget and the future results. That's what feed forward. Sorry, it's feedback control, right? There's a mistake in it. It's feedback control. Feedback control. Okay. So the feedback control will be we'll be considering the planned output, and the planned output is compared with the actual output, and then difference is made, and subsequent action is made based on that. And in feed forward control, it operates by comparing budgeted result against the forecast. Okay, so here we will be making a budget. Okay, first a company will make a budget, and then we will make a forecast. It's based on the current market condition, the company will make a forecast, and then the company will compare the forecast with the budget, and we look at that if the budget can be still achieved. Okay, and the control action will be made by the difference between budget and forecast. So if there is a budget, if there is a difference between the budget and forecast, the decision will be the decision will be changed based on the forecast. Okay, so if the forecast says that the budget cannot be achieved, then then we will change our budget. That's it. Okay, and next we are looking at the information required to make the budget. Okay, so the basic information that is required for the budget will be the previous year's actual result. All right, so the previous year's actual result will be required to make the budget. And next is internal sources regarding state of current asset and expenditure required. Okay, so in this year we are required to make some capital, we are required to make some capital investment or something, then we will be then we will be have to budget that also. Okay, so here there is a requirement of a new machine. Okay, in this year we are required to buy a new machine, then that will be included in the this year budget. And the next is estimate of cost of new product. Okay, so if you want to make a new if you want to buy a new machine or something, the cost associated with that should be budgeted also in the capital budget. And the next is external source of information, which may include supplier price list. Okay, so if you want to make a material budget or something, then we'll be buying the materials from the outside. Then we'll be required then we are supposed to get the supplier price list. And the next is estimate of inflation. So how much will be the inflation this year that's going to happen compared to the previous, and also the exchange rate movement. Okay, so if the company is dealing with forex, then we are supposed to get the like exchange rate movement also to make the budget, and also the strategic analysis on economic environment. So like if there are any war or something coming up, okay, like if some war or some economic recession is coming up, then then we cannot sell more items. So like our budget would be required to adjust it based on that. So these are the things we would be considered by using the the information we will be supposed to require in order to make the budget. Okay, and obviously every future is uncertain, so since the budget is also future, budget can also be uncertain, right? So the first reason for uncertainty will be the customer may decide to buy more or less goods than forecasted. Happens, the customer may if new product is launched by another company, then our customer will be buying less item than they had bought before. So that's the one risk. And the next is workforce may not perform as well as expected due to lack of motivation, illness, etc. The company haven't paid the workers sufficient salary, then there will be no motivated, no work, or some pandemic had occurred. So let's say corona or some fever had occurred for the workers, then also the productivity is affected. So the workers are not available to work, then also our budget will be getting into flow in future. And next is competitors may strengthen or emerge. Okay, so for every company, competitors is a threat. So if more competitors is coming, the risk of the company losing the business will be more. Okay, so then also it may affect our budget. So if new company, if new competitors may come, then also that may affect our budget. And the next is material price would increase, right? Currently we had calculated the material budget based on the material cost of $2 per unit, but the material cost has increased from $2 to $5 per unit. Then there will obviously be an adverse variance in our material budget. So that also can happen by making the budget. Prices can change, amount can fluctuate. That's it. And next is the beyond budgeting approach. So beyond budgeting approach is mainly so the beyond budgeting is not only looking into the budget amount. Okay, the company will be considering more thing other than budget. So it's set of guiding principles to enable an organization to manage its performance and decentralize its decision-making process without the need of traditional budget. So in beyond budgeting, we will not be using traditional budget. We will be using certain other futuristic innovation to set the budget. Okay, so in beyond budgeting, there will be clear principles and boundaries for each department. All right, and goals and targets are based on the relative success on the company. Okay, so these are the principles. Next will be high degree of freedom to each department. Okay, so the sales department will be given the freedom they require, and all other department will be given the freedom that they want. Okay, so the high degree of freedom will be provided. And the next will be responsibility for decision should be placed with the frontline teams. Okay, so basically the frontline teams are the managers. All right, so in beyond budgeting, the managers of each department is given sufficient freedom and also the responsibility for achieving. So this is what beyond budgeting means. Okay, so here the managers are not given a budget or something. So here the managers are not given the budget statement. They are asked to get the relative success. Okay, and the benchmark set will be by comparing the other competitive departments, other competitive company, or by the sales department within the company. Okay, so let's say a company will have sales department for 3 products A, B, and C. So they will be considering the performance of these 3 sales department only. So the frontline teams are considered as the managers. And the next is the frontline team should be made responsible for the relationship with the customers, associate, business, and suppliers. Okay, so each of the frontline teams or managers are responsible for the customer relation, association with the other businesses and also the suppliers. That's it. Okay, and the benefit of beyond budgeting is that faster response time. Okay, it means that we shouldn't make any budget or give it to them. They will be performing themselves in the best way possible. So it will give a faster response and it will be better innovation. Okay, by giving sufficient autonomy to different managers. The managers will be using their idea to get the business, right? But if the company give them a budget, like they'll be working like machines only. Okay, so like they'll be working to get the like achieve the like budget and get the incentive. Like they are no like they will be not sufficiently using their like innovative minds to get the business. But in like beyond budgeting, it will be result in like better innovation, as the managers will be using their ideas to get the business, right? And it will lower the cost, obviously, because in beyond budgeting we are not required to make the budget statement. Okay, so the company can save administration cost that are required for the budget setting process. This can be saved by using beyond budgeting, because the company is not producing any like budget statement. They are giving sufficient autonomy to each managers to produce. That's it. And it improves customers and supplier loyalty, because if each of the managers is dealing with like customers and suppliers in a like beyond budgeting model, they will be using like their ideas to like deal with them. So this will result in like customer getting satisfied with the like service or product that we provide, and also the supplier. Okay, so here like the discretion is given to managers, so the managers can make the payment for the suppliers like when they like. Okay, so in that case like supplier will also be like loyal to us, right? So these are the benefits of using beyond budgeting. All right, and the next is the quantitative technique. Okay, so the quantitative, so it's like the basic equation that we use in certain situation. Okay, so the first quantitative technique is the high low method. Okay, so like basically the high low method is used in what? Semi variable cost. High low methods are mainly used in semi variable cost. Okay, so in semi variable cost there will be variable cost and fixed cost, and in order to separate variable cost and fixed cost we will be using this high low method. Okay, so the equation of high low method will be cost at highest level of activity minus cost at lowest level of activity, like divided by highest level of activity minus lowest level of activity, we will be getting the variable cost. Okay, so this is the equation for variable cost, and after that we will get a fixed cost by like by by taking the equation such as total cost at each level minus total variable cost. All right, so I think I will make an example for this. Okay, so let's say a company will be producing 1000 unit, also the company will be producing 2000 unit. All right, and the total cost associated with producing like 1000 unit, let's say 10,000. Okay, so 10,000 is the cost associated with producing 1000 unit, and the cost associated with producing 12,000 unit is like let's say some 20, let's say 22,000 unit. Okay, so here the variable cost is not the same. Okay, so like the 10 by 1000, like the variable cost will be 10 like in here, and in here it will be 11. So like it means that a fixed cost is included in this. So first we will be getting the variable cost. So the equation for variable cost will be 22,000 minus 10,000. Okay, like I'm taking in thousands here, like divided by 2 minus 1. So here the variable cost per unit will be how much? It will be $12. Okay, so here I got the variable cost, and in order to get the fixed cost I'll be taking the total cost of 10,000. So it will be 10,000 unit minus 1,000 mistake in this minus, so our like the total cost will be 10,000 minus 12 into 1,000, right? I think there's a mistake with this. Okay, 1 second. The variable cost will be 22. 10,000, 20,000. Okay, 1 second. So here the fixed cost will be cost of activity minus 12 into let's say minus 12 into maybe 12,000, right? Okay, like let's consider the like variable cost in like thousands only. Okay, so like after doing this we'll be getting our variable cost, and in order to get the like fixed cost we will be deducting the like total cost from the variable cost. So the variable cost will be variable cost per unit into our activity level. So like, so here our activity level will be 1000. Okay, so by deducting that we will be getting this fixed cost of the product. Okay, that's it. Okay, so next we will be looking at the learning curve. All right, so the equation of learning curve will be y is equal to a into x raised to b. Okay, so learning curve is something like, okay, if if we are doing something for the first time, like it will take more time, right? But if we are like getting used to it, then our time will be reduced. That what like learning curve means. Okay, so if a labor take 10 hours to produce their first product, okay, by producing their 10th product, like they will be taking, let's say, 6 hours or something, right? So that 4 hours is considered as the learning curve here. Okay, so by getting used to something, like we will be taking less time to make it. That's it. So that's what learning curve means. So the equation for learning curve is y is equal to a into x raised to b, and here x is the cumulative number of unit that we are producing, and y is the average time per unit to produce x number of unit, and a is the time required to produce first unit. Okay, and like b is the like learning log, like it's like log r divided by log 2, like it will be provided in the question. Okay, so it's based on the like learning curve percentage, and like r is the learning rate like expressed in like decimal. So if the learning curve is, let's say, 90 percentage, then the learning rate like r will be 0.90. all right, so this is the r. Okay, so this is like what associated with the like learning curve. So this is basically the equation y is equal to a into x raised to b. All right. Okay, nice, 1 second. Okay, so next we will be looking at the linear regression analysis. So the linear regression is like used to like estimate the relationship between the variables. All right, so the two variables we'll be using here is the like the relationship between y and x. Okay, like it is similar to the like equation to get the total cost. All right, so the linear equation is like similar for the like equation of total cost. Okay, so here like y is considered as the dependent variable, and a is considered as the intercept, and b is the gradient, and x is considered as the independent variable. And the equation to get b will be this, like n into like n into sigma x5 minus sigma x into sigma y divided by like n into sigma x square minus sigma x the whole square. So like this equation need to be like by hearted. So this is the equation for the b, or the like gradient of the straight line, and like n is considered as the number of pairs of data. Okay, like the like how many like number of like how many pairs of data is provided for us in the question, and by doing that we will be getting a is equal to like y dash minus b into x dash. So the equation for a will be y dash minus b into x dash. So it's basically getting the fixed cost, right? So like it is similar to getting the like fixed cost from the total cost, and like y is the like average value of y, like it will be like sigma y by n, and the like equation for like x dash will be sigma x by n. That's it. Okay, so like that's what with linear regression. All right, so next we will be looking at the correlation. Okay, so the correlation is used to get that like the relation between two variables, like how many like how much is the strongness of relationship between two variables. Okay, so that can be determined by using correlation. All right, so we'll be like determine that based on the equation called for correlation coefficient r. So the equation for correlation coefficient r will be n into sigma xy minus sigma x into sigma y, and divided by like n into sigma x square minus sigma x the whole square into n into sigma y square minus sigma y the whole square. So these are the equation which is used to get the correlation coefficient, and the logic for this is not examinable in the PM. So like you guys are required to like by heart this and just like apply it in the question. That's it. And if the value of r is equal to 1, it means that our correlation is perfect. Okay, so it means that like those two variables are perfectly correlated. Like if the value of r is 1, okay, and if the value of r is 0, then it is no linear relation. Okay, so there is no relation between those two variables. All right, and if it is negative 1, it means perfect negative correlation. Like it means that like if one variable increases, then the other variable will decrease. Okay, so like for like whether it is positive, like it will be like whether one increases, then the other will also increase. So this is what a positive perfect positive correlation means. Okay, also if we like if the like r is greater than like 0.8 or 0 point like negative 0.8, the like then like it is said that there is a strong positive or negative correlation. Okay, so if it is 1, it will be perfect correlation. Okay, and if it is like greater than zero point 0.8, like then it is considered as strong correlation. Okay, like it can be strong positive or negative correlation, right? And next is coefficient of determination. Okay, so coefficient of determination is used to get the percentage. It's like it represents the proportion of total variation like in the y variable that is explained by the regression equation. Okay, so it means that how much percentage is changed by y as the result of x. So equation is what? Y is equal to a plus bx, and by using the r square, like if my like answer is 25 percentage, it means that the 25 percentage of change in y is due to the change in x. Okay, and the rest 75 percentage will be due to other reasons. Okay, so if the like r square is 25 percentage, like it means that the 25 percentage of change is like the 25 percentage of change in y is due to x, and the rest 75 percentage can be due to other reasons. Okay, that's it. And next we will be looking at this seasonal variations. All right, next we will be looking at the seasonal variation. Okay, so in seasonal variation, like variation also will be like in question, like the trend or the seasonal like the trend and seasonal variation will be provided. Okay, so in additive model, like we can get like actual data by getting trend plus seasonal variation. All right, so this trend and seasonal variation will be provided in the question. Okay, so just add like trend and seasonal variation to get the actual data, and the seasonal variation can be get by like deducting trend from the actual data. So this is by using additive model. Okay, and by using multiplicative model, like we should like multiply trend with seasonal variation. All right, so by multiplying trend with seasonal variation, we will be getting the actual data. All right, that's it. So this is the like the seasonal variation thing, and next we will be looking at the advanced variance. All right, so we can take a 5 minutes break for that, for advanced variance. So in advanced variance, there is so things to do. So let's take a 5 minutes break. Okay, so let's start. So next we'll be looking at the advanced variance topic. Okay, so in advanced variance we'll be considering we'll be like breaking down our basic variance into two types. Okay, so first we'll be looking at the material mix variance. Okay, so in material mix variance we'll be looking the variance that is occurred due to change in mix. Okay, so we're looking at the impact on profit due to the change in mix of sales. Okay, so in advanced variance we'll be comparing our actual quantity used with the actual quantity used in standard mix. All right, so that's how we'll be comparing advanced variances. All right, and in material yield variance we'll be comparing the standard quantity with actual quantity in standard mix. All right, so here we'll be using columns. Okay, so like basically for multi products these methods are using. So here we'll be using these columns. Okay, so let's say we are like selling three products A. So here we are selling three products A, B and C. So first we will be getting the standard quantity required for production, and the next will be our actual quantity, and next we'll be getting the actual quantity for standard mix. Actual quantity for standard mix. All right, actual quantity for standard mix. And by comparing this actual quantity with actual quantity for standard mix, we'll be getting the mix variance. All right, and by comparing this standard quantity with actual quantity for standard mix, we'll be getting our yield variance. So that's how we get our mix and yield variance using advanced variances. And the next is interpretation. Okay, so if mix variance is favorable, it means that the higher proportion of cheaper materials is used. Okay, so it would reduce the average cost. Okay, so like in mix we are using, so like if expensive materials are using less, let's say like let's make an example of biryani, right? So basically the biryani is made using what? It is mainly like made using rice and chicken, right? That's a chicken biryani. So if the proportion of chicken is reduced, then the cost will also be reduced. Then our like mix variance will be favorable because the expensive material is used less. So that's what indicates when our mix variance is favorable. And if the yield variance is adverse, it means that the output achieved is less than which was supposed to achieve on a given input. Okay, so it means that if we had input 1000 unit of material, we are supposed to get an output of let's say 900 unit, but our like let's say 900 unit, like but our like output was only 800 unit. In that case our material yield variance will be adverse. So these are the reasons for getting our mix variance as favorable and also the yield variance as adverse. Okay, and if the mix variance is favorable, if our mix variance is favorable, there are chances that our yield variance will be adverse. So the reason is that in order to get the mix variance to be favorable, we will be using cheaper material. So like if we use cheaper material, like we would require like more item to produce. Okay, because the wastage will be increased. So the yield variance will get like adverse if the like mix variance got favorable. All right. So that's what with material mix and yield variance. Okay, so next we will be looking at this sales mix and sales quantity variance. So in sales mix and quantity also we will be comparing the same thing, right? So basically in sales mix and quantity also we will be like making the same table. Okay, so like here we will be selling two products, let's say B and X. Okay, so here also we will be selling like we will be comparing the budgeted quantity, actual quantity and also the actual quantity in budgeted mix. Okay, so comparing the budgeted quantity and actual in budgeted mix, we will be get our quantity variance. All right, we will get our quantity variance by comparing budgeted quantity with actual quantity in budget mix, and by comparing this actual quantity with actual in budgeted, we will be getting our mix variance. Okay, so in sales mix variance we will be comparing actual quantity sold with our actual quantity in standard or budgeted mix. All right, and in sales quantity variance we will be comparing our budgeted quantity with the actual quantity in our standard mix. That's it. All right, so this is what sales mix and quantity variance means. All right, so next we will be looking at this planning and operational variance. Okay, so let's say an example. All right, so at the start of the year, all right, so at the start of the year and at the end of the year. Okay, so at the start of the year I budgeted that the material price should be $2 per kilogram. All right, at start of the year I budgeted that my material price should be $2 per kilogram. Okay, at the end of the year the material price at the market was $3 per kilogram. Okay, at the end of the year the like market price was $3 per kilogram. Okay, and I had purchased, okay, so like after getting discounts and all, the like average price per kilogram which I had purchased was for 2.5 per kilogram. Okay, so our basic variance, like in our basic variance we will be comparing this like budgeted with actual. So we'll be comparing this 2 with 2.5, but this 2 and 2.5 cannot be calculated in like the real case because like the market price was already $3. So in order to like get the accurate comparison of variances, like we had split the variance into, here the variance is split into both planning and operational variance. Okay, planning and operational variance. Okay, so in planning variance we will be comparing our standard with revised standard. All right, standard with revised standard is compared by using planning variance. All right, so in my planning variance I'll be comparing this $2 like $2 per kilogram with this $3 per kilogram. So this is what we compare using planning variance. And in operational variance I will be comparing this 2 kilogram with this 2.5 kilogram. Okay, so planning variance means like comparing my budget at the start of the year with like what had happened at the end of the year. And in operational variance I will be comparing what had happened at the end of the year with the actual result. Okay, so here at the start of the year my budget was $2. At the end of the year the market price itself was $3. Okay, and I had bought it for $2.5. Okay, so basically the company had performed well. It's the market that got like it is a market like in which the price had increased. So that's how we will make standard like planning and operational variance. So in planning variance we will be comparing revised budget with the, so like in planning variance we will be comparing our like revised budget with actual budget. Okay, so it is like uncontrollable by the management. Okay, like it is like outside the manager's control because it's the like market price which is fluctuating. And in operational variance we will be comparing our revised budget with the actual result which is controllable by the management. Okay, like because it's the management which is making the purchase and all, so they can like, so they would have control on the actual result they are making, like but not on original budget or the revised budget. Okay, and so this planning and operational variances like are mainly for sales actually. Okay, for so like the for planning and operational variance for sales the equation will be like by comparing actual quantity and revised quantity into standard margin we will be getting the market share variance. Okay, and by comparing the revised quantity with original we will be getting the market size. So the market share is controllable by management. Okay, so this market share will be controllable by the management. Okay, so if our market share is increased it is mainly due to the performance by management because like here we are considering our actual sales quantity, but the market size like market size can be increased or decreased due to the change in market business. Like it's not like controllable by the like it is not controllable by our management. So here we will be considering our like revised budget with original budget. All right, so that's what with planning and operation. So the performance measurement will be like covered after like after the break. Okay, so Naina ma'am like Naina ma'am will be joining you for FM classes. Thank you.
Yeah. Hi guys, my name is Naina. I'll be doing your. Hi guys, my name is Naina. I'll be taking you through the marathon video for financial management, that is FM. Okay. We'll not be doing questions because I want you to see what are the things that you can cover, okay, first. And then if you are missing out on something, I hope you can go back and revise that, okay. And if we have time, that is, we will solve a few questions, that is if we have time, okay. But before that, my main priority here is just to let you know what are the topics that are there in FM, and where you need to focus a little more, okay. Fine, so we can start. So it's like a 60-page PDF where we'll just skim through a few pages, but then there are certain formulas which are very important. Fine. So let's start with this first one. Financial management decisions. What are financial management decisions? So overall, the whole subject is based on three decisions that you can make. Okay. One is the investment decision. One is the dividend decision, and one is the financing decision. Okay, if you know where to get your finance from, how you put in your money for any investments, or how you decide to give in dividends to your shareholders, you are basically a master in FM at this point. Okay, now for investment decision, we need to know which project we need to invest in to increase our revenue the most, increase our profits, increase the shareholder value, just increase whatever except for loss. Okay, anything if you can increase, that is investment. Okay, so there are multiple methods in which you can figure out whether or not to choose that particular investment. Okay, so there's things like NPV, we have IRR, we have many methods. We'll go through those things. Okay, coming to dividend, we'll be learning different dividend policies that a company could have too. Okay, so some companies prefer to give out dividends, some do not prefer to give out dividend, they choose to get their earnings back into the business. So multiple companies have their different strategies. Okay, we just need to figure out which strategy works best for which company. Okay, that is dividend. And financing decision is, it's a huge chapter. If you've noticed, if you've studied from Study Hub, Capital, whatever, you would have noticed that this is one chapter, but it is very huge. Financing, right? So we'll be learning what are the sources of finance. Obviously, to invest and to give out dividend, you need money. Okay, where's that money coming from? Where's the money coming from to invest? Obviously through financing. Now this can be done through debt, this can be done through equity, etc. Okay, but every time you are using something to finance, you will be looking at certain costs that are related to that particular investment. Nobody gives you money for free. Okay, there is no free lunch concept in this world. Okay, there is no free lunch. So basically, when we're talking about source, I will be taking you through what is the market value of each thing. Could be equity, could be debt. Under that, you could have preference shares, could be many things. Okay, but each of these have costs associated to it. Okay, we'll be learning how to calculate the cost, which comes as a percentage. We'll be learning what is the market value of this, and then finally we'll be learning what is the total cost that the company is incurring to fund that particular project, fund that year, whatever. Okay, right. So when we're talking about financial management decision, we'll start with investment decision. Okay, this is basically where to spend. Before this, you need to have money, so obviously financing comes first, but then in FM concept, it is all about increasing the money, so we give investment a lot of preference here. That's our priority. Okay, so investment decision is where to spend. Where will you spend the money that you have? What does this cover? Investment decision, we'll be looking at which project to choose. Okay, and day to day, how is our cash supposed to be taken for operations, day to day operations, for certain projects, short term, long term, anything. We'll look at everything here. Okay, for big projects like buying equipments, buying properties, etc., we'll look at it. For day to day needs, for example, keeping stock in hand, for which we will be dealing specifically with another topic called working capital. Okay, this is also a very important concept for you. Can come for section C, section A, section B, anything. Similarly, in investments also, NPV is a very main topic here. IRR, same. Okay, why does investment decision matter? Obviously, we have money. Okay, we need to know that we should be able to increase this money to a little more. that's the main purpose of business. We have a little money coming in, we need to make sure that we increase that particular flow. Okay, that's how business makes profit, that's how they give dividend. So financial manager's role, which is our role basically, is to evaluate which project will earn the most money in the least cost. Okay, we have different methods, like I said, we'll go through it. Again, coming to working capital, we'll go through that as well. Financing decision, how to get money. Very, very important. Do we get it through equity? Do we get it through debt? Do we get it by stealing? What do we do? Anything, we need to know about it. Okay. So what does it cover? Where are we getting funds from? Obvious answer, borrowing. Whenever you're borrowing money from somewhere, becomes debt. When you take debt, you need to repay that debt along with interest. Okay. But when it is owner's money, that is equity, we do not need to like give it back to them, but instead we need to provide them with certain dividends. Okay, that is again dependent on the company. Here the financial manager's role is, we need to compare the cost and risk of debt versus equity. Should we take debt or equity? How do we figure out which one is the best for the company? That is what we'll be deciding here. Okay, here we need to recommend the best mix. Obviously a business cannot run fully on debt or fully on equity. It cannot be two separate extremes. Okay, we need to have this optimal mix, and we'll figure out how to do it. Dividend decision, what to give back. We took money from equity shareholders, right? How are we going to give it back to these people? How are we going to make it up to them is the question. Okay, so what does this cover? Choosing how much profit to pay to owners versus keep in business. Basically they're asking the choice between dividend and retained earnings. Retained earnings is the cheapest source of finance. Okay, you do not have to pay any transaction cost, anything, this, that, nothing, except for maybe lost opportunity cost. Okay, so basically retained earnings, if you keep the money back in the business, shareholders wouldn't like it. Some shareholders, okay, we have something called distribution of shareholders, right? So they will get to know what each shareholder's preference is. It's called clientele effect. Maybe look into it, it could be asked for your section A. Clientele effect is nothing but, you know, each shareholders have their own preference, so they will be focusing on the company where they are able to fulfill each of their preferences. Okay, so if a company is giving more dividends, some people will like it, but at the same time some shareholders wouldn't like it because they'll have to pay tax on that, and they would rather keep money in their hand, keep their shares intact. Okay, right, payout, it makes the owners happy. Keep in, it makes the company's future look stronger. Okay, why does it matter? Too much payout leaves too little for new opportunities. Too little may disappoint owners. So you need to find a trade-off basically, guys. That's what we'll be looking at. Okay. Now, what's the financial manager's role here? First of all, assess cash availability and future investment needs. So basically we need to see if whatever we're planning for the future investment, do we have that much cash to, like, you know, put in the project. Right, so that this is the diagram that, you know, describes the relationship between these three. Firstly, what happens is we take money in through financing decision. Source of finance, cost of capital structure is what we'll be learning specifically on financing decision. When money comes in, we have to make a decision. Okay, what kind of decision? Investment decision. What is that? We'll need to appraise all the possible investments and see which one gives us the best return. Okay, working capital, we need to assess it. Risk, very, very important. Risk versus return is gonna be a very important trade-off that we'll be looking at here. Okay. Right, after you make money here, you will again go back. Now this money, financing decision, you could go make a decision whether to give it as dividends or, like, you know, spend on investments, which will again give you money back through which you can pay your dividends, which is money going out. Okay, this is all that comes in FM. Nothing other than this is gonna come, but obviously there are multiple theories associated with it. There were too many people who made too many theories, and we need to sit and learn about all that. Okay, that's what we'll be doing in FM. Right, so what is financial objective? The main thing for any company is to maximize the shareholders' wealth. How do you do that? You will create value for them. Okay, this can only be done through increasing your value. How will you do that? Investment decisions. Got it? That's why it's important here. Now, what is TSR? Total shareholders return. Now, shareholder will invest some money there, right? Now we need to know how much he's getting back. How do you calculate it? This could be a section A or B question. I hope you can remember the formula and answer this. This is going to be a pretty straightforward question. Okay. Do not miss out on such easy marks, guys. So, total shareholder return is nothing but dividend per share plus change in share price. What is the meaning of change in share price? Right now, whatever is the share price minus share price in the beginning. Okay, that's going to be the change in share price. Share price at the start of the period. Again, you divide it to see how much interest you're basically getting. For example, let's say a company is giving dividend of $4. Okay, and in the beginning of the year, company's share value was how much? Let's say 1, and right now it is company's value right now is 10, and right now it is 5. In the beginning it is 5. You divide by 5 to get whatever answer it is. 4 plus 10, 14 minus 5. That's 9 divided by 5. Whatever the answer comes, that's a percentage. Okay. Okay. Next, other objectives. While shareholder wealth is the focus, company also pursue profit maximization because some shareholders will want wealth maximization. Shareholders who are looking for short term, they will want profit maximization. Okay, how can you give profit maximization? That is a short term thing. Okay, everybody doesn't want to sit and wait for long term. Okay, some people want impulsive buys, right? So for them, short term is the best way you can do it. And if you're not able to maximize profit, they're not going to invest. You're going to lose out on many shareholders because of that. Okay. Growth, obviously you need to increase the company's growth by doing more sales and investing in more projects, build your scale up, etc. Market share, you need to capture the most of the market share to get a competitive advantage. For example, when we look at most people, okay, right now I've seen around me that whenever you have fever, people always prefer paracetamol or dolo, right? There could be multiple other tablets, but these are the two things that have captured the market in this big way. Okay, people, even kids will know what these two medicines mean. So that is market capitalization, market share. That much part of the market they have captured. Got it? So that they need to do. That's when people will start investing in them. They will know about it. Customers will buy from there, etc. Right? Social responsibility. This is a very recent trend. Okay, until recently people didn't care about the society. Okay, but now we have sustainable development, we have social responsibility, we have CSR, we have whatnot. Okay, investors, most of them, many of them look at CSR as well when we're investing in a company. Okay, now coming to profit versus wealth. Now here also you need to have a particular trade-off, because sometimes if profit increases, it will be with effect to wealth decreasing. How? Because just to increase the profit, they could give multiple discounts right now on products. Okay, that's not going to work out well in long term, because how much discount can you even give? You need to make certain growth over time, right? So for example, see, short-term profit hikes, this could lead to profit increasing. Okay, profit is increasing, but then this is through a shortcut. Okay, leading to the detrimental damage in the shareholders' value. Basically, the wealth is decreasing of the company. Okay, high reported profits don't guarantee strong cash flows, obviously, because profit is different from cash. There is profit, there is cash. If I'm making $100,000 profit, doesn't mean I'm getting $100,000 cash. Okay, we will be learning this particular topic in working capital management. Right, maximizing and satisfying. What is the difference between maximizing and satisfying? These little words could be asked in your MCQs, so just remember these words. Okay, maximizing is chasing the highest possible return. Okay, satisfying is accepting good enough returns to limit risk and reduce complexity. So maximizing, you chase the highest return, you take the most risk to get that particular return. But satisfying is like, you're like, okay, fine, yeah, I got so much, no, never mind, I don't care, this much is enough for me, my risk is low, that's all I care about, is what you're gonna think. Okay, now companies often maximize returns for shareholders but satisfies for other stakeholders. So there are multiple stakeholders in a company, right? Not just shareholders. Shareholders just one stakeholder, who's probably the most important one, but still. And there are other stakeholders. So for shareholder, they go all in just to increase their wealth, just to increase what they want. They maximize things. Okay, but for all the other stakeholders, they'll be like protect the environment or give it in cheaper, give products cheaper, or employees could be like increase my salary. You will just do what is good enough. Okay, that is satisfying. You're like, just be happy with what we're giving you. Okay, so that is difference between maximizing and satisfying. Got it? Now, stakeholders. These are the main people that we'll be talking about. Internal, connected, and external. These are the three different types of stakeholders. So obviously you just need to know it in corporate governance theory, okay, which will not be tested for more than 2 to 4 marks. So but then this topic comes in all the papers, so it doesn't make sense in skipping it, right? So we'll just go through it. Internal stakeholders are people within the company, for example, the management, the directors, the employees, etc. Connected are the people who are connected with the company in some way or the other. For example, could be the shareholders, that's the most important connected one. Then we could have the finance providers, financial intermediaries, whatever, whoever is connected to us in certain way or other, connected. Externalists, they are not related to us directly, but then they are somehow affected by us in a long term, that is, okay. Indirectly affected by us, external. Directly affected by us, connected. And who is within the company, that is internal. Got it? Now, agency theory, very important theory. So obviously in a company, there are owners and there are management. Owners are nothing but the principals, and management are the agents. So owners hire management to run the company on their behalf because they are not very sure about how to do it. Okay, so that's why it's called a principal agent relationship. Okay, now what is the agent's job? They are getting paid regardless. Okay, but how well the company is doing, only according to that owners are getting paid. So eventually in the end, they have this relation, they have to have this fiduciary relationship between owners. So whatever they want should be their main priority, the management. But sometimes these people get greedy and they're like, what will happen, they wouldn't be able to figure out if I took in money from here or there or whatever. So that's where agency conflict arises. Okay, sometimes they choose their greed over the shareholders' value. Okay, and it's their responsibility to choose the shareholders' value over their greed. But when that doesn't happen, obviously in the end we are human, right? So at that time we need to figure out how this agency theory conflict is happening and we need to stop it. Okay, again, corporate governance. This is a very important word, again could be asked for a 2 marker, information asymmetry. So see, management knows everything about the company, but shareholders, they know very little because they are not in the company for all the time, right? Whole day of the every hour of the day they are not in the company, so they do not know much about what's happening in the company until the management tells them, see, so and so and so is happening, do you want to take any chance, do you want to take any decision, etc. And obviously their decision will not matter too much because management is the one making the final decision. Okay, right. So what is information asymmetry? Managers know more about day to day, but then principals, who are nothing but the shareholders, it becomes very difficult for them to monitor what's happening. 1 second. Okay. Yeah. So divergent incentives. What is divergent incentives? Managers may favor strategies that boost their pay or job security over shareholder wealth. This is the part where I was talking about them being greedy. Okay, they are choosing their greed over the shareholders' value. Got it? Mitigating agency problem. Now obviously agency problem arises in every company. Okay, but then how you deal with it is what makes you different from other companies. So firstly, you'll have to set in the corporate governance mechanisms. Look at audit, look at external, internal, both, to understand better, right? Monitor and oversight and transparent financial disclosure, very important. And that's why we have financial reporting also. So if you've given financial reporting, you will know this is the main goal there, okay? Incentive alignment. What could we do? We could tell the management, okay, if you increase shareholders' wealth, you will also get certain incentives that will promote your money more. Okay, so that way they'll be, they'll be like, I'm helping them, but at the same time, I'm also getting too much money. Good for me, then I'll start doing it. That's what they'll think, and then that will work out for them. Okay, so that's why we have something like ESOPs. We'll be looking at that. Okay, so what are the managerial reward schemes that will, help management look forward to working with shareholders, understanding what their needs are and working with regards to that? Firstly, minimum profit targets. So now what we can do is we can tell the management, see, we want so much profits, this is your target, you have to, achieve this target, and then probably you will get some money. Okay, you will get some bonus basically. Okay, but then what is the problem here? They will just achieve that particular target and they will stop, and they will be like, okay, next month I'll achieve more. Okay, because more than that they're not getting anything, and this is again profit. So when it is profit, the problem is they could manipulate the records, they could window dress it, okay, to make the profits look higher and their bonus go higher. EVA, economic value added, is the bonus linked to increase in shareholders value. What is the shareholders value? TSR, that we looked at in the first page. If that increases, you get your bonus. Okay, so this is kind of directly linked to the shareholders value, so this works out. But then this is very complicated also. Look at this EVA. If you look at it only, you will be like, I don't want to do this, right? So that's going to be a problem again, because many people would not prefer doing complex calculations, time consuming calculations for the same thing. Okay, revenue growth is, not about profit, we're talking about revenue now. So what they'll be like, okay, just increase your revenue. Okay, now what these people could do is sell on credit. Okay, sell to like maybe people who are not even there. Okay, and they'll be like, okay, fine, you can pay later and pay later. That way your revenue is increasing. For revenue to increase, cash doesn't have to come in, right? We can even sell it on credit. That's what's happening here. So revenue, just to increase it, just to boost it, what they do is they give out products, maybe in discount, maybe in a lot of credit period, right? And that will lead to revenue increasing, but cash is not coming in any way. And cash is what matters, because that's what you use to pay dividends. And if that's not happening, doesn't make sense if revenue is growing or falling. Coming to ESOPs, which is the final one and probably the most important one. Okay, employee share option plan. So what you do is you give the management an option to buy the shares of the company. That way they will also have a stake in the company and they will want the company to perform well. Okay, but obviously the existing shareholders will probably not like it, because that dilutes the value of their shares, right? So then that is one thing. And the other thing is, what the directors could do is maybe just take the share right now and sell it off right now. Okay, that's why to deal with this, what we could do is have a minimum holding period. Okay, that's a way that you can deal with this risk. Coming to corporate governance codes, this can be an ethics question. Obviously, one ethics question always comes in any exam, any ACCA exam. There should be one ethics question. Okay, so first we'll be learning about NEDs. What is their responsibility? At least half of the board members, excluding the chair, should be an NED, right? Chair also should be independent when they are being appointed. Okay, NEDs must devote sufficient time, so they just can't come, they just can't like look at everyone's face and go back. They have to dedicate that much amount of time to their work. Okay, and chair key committees. So NEDs must chair audit committee, remuneration committee, risk committee, etc. That is where the NEDs that is where the NEDs work the most. Okay, next, not hold share options in the company. NED should be independent. Obviously, we cannot be giving them shares and expecting them to be independent. Okay, if we are giving them shares, then they will be obliged to let the company perform well. Even if they are not, they will just let it slide. They'll just be like, I'm getting profit out of this, why should I even like bother with these little things? Okay, one NED serves as senior independent director to champion shareholders' interests. So there is one NED who's always present in all the companies. His main work is to deal with the shareholders. He goes to the shareholders, he asks them, what do you want? What do you want from the company that we can provide to you, etc. Okay, so he's going to be the shareholders' champion. Okay, boards disclose in annual report where NEDs are independent and review their performance and time. So basically, in the end, we just look at the NEDs performance. We see if they're working well, etc. Okay, that's what we do. Okay, coming to ED. Separate the roles of chairperson and CEO. Obviously, too much power in one person is never good, has never been good. Look at history, for example. Okay, the chairperson must be independent on appointment. Like I said, the chair should always be independent on appointment. Remember, I said it here. All directors must stand for re-election at least every 3 years. So if you are a director for more than 3 years, there's a chance that you are not independent. Okay, you are not working for the benefit of the company. So let's say you have been appointed as a director. Every year is actually a good thing to do. Every year election is good. But then if that is too much for a company to handle, it's okay. Maximum is 3 years. Okay, so more than 3 years, nobody can be a director without being re-elected. Clear disclosure on directors' total remuneration, including chair and highest paid directors. All this must be disclosed in the financial statements. Okay, shareholders should know how much the directors are getting paid and why they're getting paid so much. For a matter of fact, board should aim to limit directors' notice period to 1 year or less. See, this is what I do. Okay, notice period should be less than 1 year or less than that. Fine. Nature of not-for-profit organizations, or NPOs, basically, and not-for-profit organizations. So the main purpose of this is for the benefit of the society, for anything other than profit. This is okay. Here, this and this could be tested. Okay, for 2 marks, that is not more than that, 2 to 4 marks max. So economy, efficiency, effectiveness, this can be tested for MCQs, asking what each one means. They could give what is economy and they'll give you 4 options. You need to figure out which one that is. Okay. And I'm telling you guys, you'll think this is a very easy topic and you can like figure it out, but they will ask it in a very confusing way. You will get confused. Should I choose the first option, second option, like that? Okay. Applying value for money in practice. So what do? First, you have a target set. Okay. Now this could either be a financial target, or it could be an operational target. So any of these targets you could set. Okay. Next, you will measure performance. After you set the target, you will perform. And then you will see if your performance is in line with the target that you had set. And if it is not, you adjust it to get it back in track. Okay. That is basically VFM. That's like setting normal budgets itself. Now comes the most important part where investment appraisal starts. Okay, investment appraisal techniques are very, very important because this is totally dealing with the investment decision. Like I said, guys, I will not be solving sums. Okay, first I will focus totally on getting all the theory to you. You need to know what you're missing out on. Like, just look at the video. Okay, and if there is something that you feel like you've skipped, then go back and revise it. I will tell you which topic could be more important. Go back and revise it. For example, guys, chapter 20, there are only 2-3 topics that are very important, and that is all I'll be focusing on. Okay, everything else you can go through. Okay, you will get it for 2 to 4 marks or whatever. But then if you're not getting it for that much marks, it doesn't make sense to sit and waste 2-3 days on that one topic, right? So that's why I want to take the topic to you first. Okay, relevant cash flows and accounting profits. Now, what are cash flows and what are profits? Remember, I told you both are different. Just because you're making profit doesn't mean you have cash. Okay, so cash flow will totally deal with it in working capital. But here, profits also we need to look at. Use cash flows for all in appraisal methods. So now there are different appraisal methods, right? Most of the appraisal methods only use cash flows, but there is just one, which is ARR. Okay, accounting rate of return, which is also known as return on capital employed. This is the only thing that uses profits. Okay, and when I mean profits, ACCA has made it very simple for you. So whenever you need to adjust from cash flow to profit or profit to cash flow, you just make one adjustment, which is the adjustment of depreciation. Okay, other than depreciation, they are not going to complicate it for you guys. Okay, so you can be rest assured, just take the depreciation, incorporate that value. Okay, so first, use cash flows in investment appraisal. Second, ignore sunk cost. So you need only relevant cash flows. Relevant cash flows are the ones where you ignore sunk cost, committed cost, admin cost, and overheads. These 4 costs you will always ignore whenever you're looking at cash flows. Got it? Right. Include opportunity cost. Opportunity cost you should always include. That is not an irrelevant cash flow. It is a relevant cash flow. Okay. That is the amount you're missing out on by choosing an alternative strategy. Okay. For example, let's say you were too sleepy. Okay. You went on a trip. You were too sleepy. You couldn't wake up in the morning. You went with your friends. Okay. So your friends try to wake you up and they're like, we are going to this amazing spot. Let's just go. Okay. You'll be like, I just want to sleep. Just let me. Okay. So one is sleep. Whereas your friends have gone to watch this incredible place, okay, and then they had the moment of their life. They saw the most beautiful scenery there, etc. right? So now when they come back and talk about that scenery to you, you'll start thinking, was my sleep that much more important that I missed out on this amazing scenery? Okay, so you'll have this regret, right? That's nothing but the opportunity cost. When you choose an alternative option as compared to this option, how much are you missing out on? Okay, make sure the option you choose gives you more value than the opportunity cost. Otherwise, it's very clear you're choosing the wrong option. For example, here this was a wrong option to choose. Got it? Okay. Always base your calculation on incremental future cash flow that occur only if the project proceeds. Okay. Now, let's look at the methods. The first one being accounting rate of return, ROCE. Now, this can come for section C as well, guys, but also can come for section A and B. Okay. Section C are called, like, they obviously will ask NPV question, if you're lucky, that is, and along with that they will ask you probably to do it in different methods. There are multiple questions from the exam kits that you can look at. Okay. ROCE's formula is this. Usually if they ask you to calculate ROCE, this is what you will be looking at. Okay, so what is ROCE exactly? What is accounting rate of return? Basically is they are looking at the profits as compared to the amount you invested. You invested so much, but how much profit are you getting back as a company? Okay, the company has invested this much amount in the project, but are they getting back that much profit is the question here. Okay, unless specified otherwise, we will use this particular formula. But in certain questions, they will tell you use this average capital employed, average capital investment, and calculate the ROCE. At that time, if you do the other formula, you're going to lose marks. Okay, read the question very carefully. This is what ACCA loves doing. Okay, so read the question properly. Make sure you know whether it's initial capital, which it will always be if nothing is specified, and if they've specified something by telling it's average capital investment or whatever, you need to do it in that method. And what is the formula for average capital investment? Initial investment plus scrap value divided by 2. So this is basically a machine or something that will be given. You just need to do this. Okay. Now, when we look at the ROCE, which is nothing but the ARR, the decision rule is if the expected ROCE for investment is greater than the target or hurdle rate as decided by the management, then project should be accepted. Now, this is completely based on the management judgment. There is nothing that says 10% is good or 90% is good or whatever. Okay, management will decide this is the rate that we need. Okay, and if the ROCE shows that yeah, the rate is being matched or it's even better than that, then you will solve it. But if the management cannot make the right judgment, then it doesn't make sense to be choosing this method. Okay, also I'm telling you again, profit is what you're using here. Now guys, in these investment appraisal methods, the most important question they can ask you is to give the advantage and disadvantage of each method. Okay. They will ask you why one project is superior to the other project, and you need to be able to mention it. If you cannot do it, you cannot expect any marks. If you want to pass, this is going to be the first step that you do. Look at the advantages and disadvantages, choose which method is superior to the other, look at the company specific methods, etc. For example, the ROCE advantage is it's very simple to use. Why? Because it's using profits. Okay, and profits sometimes is what the investors look at. Okay, and it's very easy to track as well because it's profit. But the disadvantage, you can see a list of it here. Okay, firstly, it doesn't show time value of money. You know what is time value of money, right? So value of money today is not the same as value of money tomorrow or after 10 years or after 100 years, right? So that particular main component is being excluded here. Okay, so time value of money doesn't consider the timing of the project. Okay, ignores when money comes in. Yes, so what this means is I can get some money today in year 1 and in year 2 some money. Okay, so it is not telling us the first year to and year 3. I'm asking you what is the return. Now it doesn't look at the year 1, year 2 specifically. It just tells, yeah, so much. Okay, it will not tell year 1 you made so much, year 2 you made so much. It will just give an average, which doesn't make sense because we need to know how much we have invested in that time frame, how much profit have we earned. If we do not know that, then it doesn't make sense, guys. Okay, for example, year 1 I invested 10, year 2 I invested 100, year 3 I invested 10 again. So my total investment is 120. Right? But now majority of investment, the timing this is the investment that is there for the longest. Now this should be giving us more returns, okay? But at the same time, we have year 1, year 2 and year 3. Here we've invested 100, 10, 10. We are giving in the same amounts, okay? But the ROC is going to be different in each of it because the time value is not considered. That's one main disadvantage of ROCE. It shows the percentage but not how much money you will make. So percentage is there, yeah, fine, you'll just look at 10% growth, okay, good for us, okay? But it's not going to tell how much money you're exactly getting in, okay? How much money you're exactly getting in, you will get to know through other methods like NPV, okay? Right. Different ways of recording cost or depreciation can change the result. Like I said, profit, we cannot do anything. That's the easiest way management can manipulate it. And you know, there are different methods, okay? So it will not always be the same. What are the relevant cash flows? We went through that. Again, let me tell you, future incremental cash based and opportunity costs. These are the relevant cash flows. What are irrelevant cash flows that we should ignore completely? Sunk cost, committed cost, non-cash, allocated, etc. Right? So that's the first method. We are done with accounting rate of return, also known as ROCE. Remember the formula, guys, very important, along with which you need to understand the advantages and disadvantages also. Okay. Coming to the next method, which is the payback method of investment appraisal. Now, this just focuses on one thing. How fast can you get in your initial investment? Okay. After you recover your initial investment, it is not going to look at anything. That is the main disadvantage. It doesn't look at the whole life of the project. For example, okay, we'll do this sum, okay? The payback period tells you how long it takes the project to recover initial investment, measures how quickly your money comes in, that's it. It doesn't, again, look at the time value of money, it doesn't look at the project after that, later, etc. Okay, now, in this, you can see, if the cash flows are consistent, payback is very easy. Every year, if you're getting 10K and initially you spent 100K, it's very simple, just divide 100K by 10K, you will know in 10 years, you'll get your money back, right? But if the inflows are not constant, okay, then you will have to do this other method to understand why it is not constant. Okay, I'll tell you how to do that, don't worry. Okay, I hope this part was clear for you. For example, see, spend 2 million, that's the initial investment, get 500,000 per year. So what is the payback period and how many years are you going to get your 2 million back? 4 years. That's it. Nothing would be simpler than that. That's why you will not be getting such easy questions also. Don't worry. Okay. But along with that, if it is inconsistent, okay, not constant, that is, then you'll have to use this particular method. For example, let's see. So first what you will do is you will find the cumulative cash flows. Okay. 1,900, 1,600, negative, 1,100, still negative, 1,500, no, 500, still negative, and finally this final year, 5th year, so that is 5th year, it is positive. That means the 4th year will have to have recovered the money, right? So now what you will do is the year that it is the last negative, that is 4 years you will do, and then you will use this particular formula. Shortfall at the start of the year, how much was the shortfall? 500. Okay, 500 is the negative, right? So divide by cash inflow that year, that is 800, okay, into 12. That's how you will get the period. So this is month wise also you will be able to allocate. Now, in this, what is the decision rule? Accept any project whose payback is within your maximum acceptable period. For example, they will tell, the manager will be like, within 2-3 years, if I'm getting my initial investment, okay, no problem, we can invest in that. Okay. If it is not, then you're not going to invest in that. Okay. But the problem here is, guys, if within 2 years you're not able to get your money back, but after 2 years you're going to get really huge returns, then you're missing out on that because the payback is not going to talk to you about that. Correct? So that's a problem again in payback. Again, like I said, in investment appraisal, you need to know the advantages, disadvantages, and formula of doing things. Okay, these are the only 3 things that can be tested. Advantage is very simple. Liquidity focus means what? They need their initial investment back soon. That's it. Risk insight, faster payback generally means less time, so things could not go wrong. Okay, if you get money faster, that means you're recovering your initial investment, so risk has been reduced significantly right there. Real cash, in payback period we are using cash flows, not profit. This advantage you can use everywhere. Okay, most of the advantages and disadvantages is going to be similar. Okay, Disadvantage of payback, however, it includes ignores later cash flows. Like I said, once you get in all your initial investment back, they do not care about what happens with project. Okay, timing overlook treats early and late inflows the same thing. It does not account for time value of money. No good benchmark. Again, management's decision, management's judgment is what needs to be perfect here. Only according to that we can make a decision. Okay, discounted cash flows, very, very, very important. This is something that considers the time value of money, and any investment appraisal methods that goes through time value of money through discounted cash flows are very important for you. That's going to be the main advantage when you're mentioning all these things. Right, asking the same question again. Why money today is worth more than money tomorrow? Okay, 1 rupee today, $1 today is more than the value of the same 1 rupee or dollar tomorrow, right? Why? Because of earnings potential. This same 1 rupee, $1, you can invest and grow it, right? One is the earning potential that could be there. Inflation, prices rise over time. So today's rupee buys more than next year. Okay. Risk and uncertainty. Future cash is less certain. See, if somebody tells you I'll give you 100 rupees after 10 years or 10 rupees today, what would you accept? 10 rupees today, obviously, right? So whatever you're getting in the short span is what people look at. Compounding, growing your money forward. Now, if you're investing certain sum of money today, how much will you have it after like 5 years, 10 years, or whatever the lock-in period is? How much will you have? That is compounding. Okay. This is the formula for compounding. So how do you do it? F is the future value of your investment. T is the present value of your investment. R is the rate at which you will be getting your interest, and N is the number of years before you get that particular interest. Okay. For example, invest 100 today. Today is obviously the present value. Obviously, even a kid will know that. 10% per year is the rate. 2 years is N. How much will that money be after 2 years? Again. Okay. So now, future value will not be nothing but 100 into 1 plus 10% raised to the power 2. That's it. When you solve that, you will get the future value of that particular investment. Got it? So this is that easy, guys. Same thing, discounting is the future value will be given. Okay, you're just finding the present value of it. You'll be like, after 10 years, I want 1 crore. Then you will ask, how much should I invest today for it? And in what rate, etc. Okay, that is discounting. Okay. Now, for this, the formula is present value is equals to future divided by 1 plus R. The same thing. They are just changing the formula. P comes here. So 1 plus R goes under the F. That's it. That's the formula. Okay. If I look at the same value, now I'm just going to assume that 100 years is going to be the future value. So F is 100. Everything else is the same. Let me assume that. So present value is going to be 100 divided by 1 plus 10% power 2. That's it. Okay. That's that easy. Right. Discounting factor. Now this is the main discounting factor, which is just 1 divided by 1 plus R power N, which you would have seen here. To discount, future value is there. Okay, but along with that, 1 divided by 1 plus R power N. So here, if you want to say, this is the discount, my future value is going to be, 100. So how much is it in present value? You can just take this future value and multiply with this discounting factor. Or obviously the easier option is to go back to the table and look at it and see what it is. You'll have the annuity factor, discounting factor table in your exam also, and in your study text, all that it's there. The main topic of NPV. NPV is, I can say 90% certain that you're going to get in your exam. Okay, it's almost tested in all the attempts. So NPV is going to come for a 20 marker, plus obviously the components within NPV is going to come for 2 marker as well, section A and B both. Okay, right. Now NPV is the total value of future cash inflows and outflows from the project. Okay, NPV, the thing is, guys, you're using this discounted cash flow model. You need to find out the discount. You need to find it out in the present value terms. It tells you in terms of cash flows. Again, cash flows we are using here. Okay, how to calculate NPV? List all the cash flows. What? Okay, let me just show it. So we'll have here 1 0 0 1 2. Oh my god, 1 2 3 4 4 years. Let's say the project is okay. Cash flow year, first year you spent 100,000. You got 20k, you got 70k, you got 40k, etc, etc. Now what you'll do is find the present value of each thing. How will you find the present value? Remember that formula. So this is cash flow is nothing but the future value. Okay, future value divided by 1 plus r power n, you will get the present value. Okay, that you will write here for each thing. And then the total value of it you will take. That's going to be the NPV. You can do it using this formula like this. Or what you can do is you can just take the cash flows and you can do it using the Excel spreadsheet. That is equals to NPV, interest rate, comma, cash flows, right? And close the bracket. Don't forget to close the bracket and reduce the initial investment. That's going to give you the NPV. This is a much easier formula. You don't have to sit and calculate the discounting factors. And this is valid. This is ACCA is going to accept this particular thing. Decision rule. If NPV is more than 0, project adds value. If NPV is positive, you accept the project. If NPV is negative, you reject the project. If NPV is exactly 0, then you're just breaking even your investment. Okay, if you're fine with it, go ahead with it, no problem. It depends on the company. If NPV is equal to 0, project breaks even. Now the thing is, guys, if project breaks even, whether you do the project or not, your money will be the same. Doesn't matter, doesn't make any difference. So just look at it once according to what they're asking the question, that is. NPV is less than 0, project destroys value, reject it immediately. If comparing exclusive project, choose the one with highest NPV. Now there could be multiple projects with different NPVs. Okay, which one will you accept if everything is going to be positive? Obviously the one with the highest return. Advantage of NPV: accounts for time value of money. Like I said, absolute measure means it shows exactly how much cash is coming into the business. Okay, it uses cash flow, not accounting profit. Like I said, multiple advantages and disadvantages could be taken in different methods. Considers entire life of project. What doesn't consider the entire life of the project? Payback. Aligns with shareholder wealth maximization because the exact amount of cash is coming in. And when cash is coming in, that means you can pay dividends out, pay shareholders money, etc. Disadvantages: it requires a discount rate. Now, this is again subjective. Management should figure out what is the exact discounting rate. If your discount rate is wrong, it's going to be very hard to get the perfect answer here. Okay, that can destroy the whole NPV calculation. And it's a little complicated to calculate because, you need to find out the future values for which you need forecasting. You need the discount rate for which you need judgment, etc. There's too many uncertainties in this method. It's hard to explain to non-finance managers without a bit of background. Obviously, now you don't know what NPV is. Only after you started studying it, you're like, okay, NPV is net present value. NPV is how much money the company is getting with the project invested, etc. But if somebody who doesn't know, we should sit and explain to them what is NPV, and then we should explain what is a good NPV. Okay. Discounted annuities. Annuity factor is, for example, let's say you're gonna get 10,000 per year for 20 years. Okay. Now the problem here is, guys, you are getting it for 20 years. Fine. But it's the same 10,000. How many times will you, discount the same 10,000 again and again and again? So that's why if the number of years are given, constant cash flows, and the rate is given, then you can just look at the annuity table and figure out how much for 20 years and let's say 10% the annuity will be, which you can just multiply with 10,000 to get the answer. Understood? So that one thing is you can just look at the formula and do it. Other thing is you can use this particular formula, which I would strongly not recommend you to do it because that's a lot of time waste, guys. And FM, you need to calculate a lot. You need to put in so much of theory. You will not have time to sit and calculate all this. Okay. So just use the annuity factor table that they have given in the question. Okay. If you don't want to do that, no problem. If you want to do it for 20 years every year, you can do it. No problem. Anything that is fine with you, do it. Okay. Don't let anyone tell you otherwise. Formula for calculating present value, you just take this particular annuity factor and you multiply with cash flow. Just like I said, what we can do here. Okay. Perpetuity is a cash flow which will come for the foreseeable future. Okay, so every year, at regular interval, every month, every year, every 2 years, every 3 years, anything, regularly the money is coming in, okay, and it is continuing for the foreseeable future. Like, it is not stopping. From now onwards, if you can forecast the profit and you're seeing that the money is not stopping, that means it's a perpetual cash flow. Okay, in this scenario, you can just take present cash flow divided by rate. So present value of it will be, let's say I'm getting 10,000. for the foreseeable future. I do not know for how long, but for the foreseeable future at 10%. Then very simple, the present value will be 10,000 divided by 0.1. Got it? So that will be what? 100,000 is going to be my present value. Right. So again, we have growing perpetuity. Now, here I told you 10,000 is going to be constant for foreseeable future. But if I tell you 10,000 is what I'm receiving today, but the next year I'll probably get a 1% increase and 1% increase. So constant increase if it's there, then you will use this formula. For example, 10,000 into 1 divided by rate is 10% minus growth rate is 1%. So 9%. That will be 10,000 into 1 divided by 9%. And whatever the answer is, that's going to be the present value. Got it, guys? It's very simple, all this. Right. Okay. So sometimes, you know, your perpetuity starts a year early or 2-3 years or 4 years late. Okay. And at that point of time, you just have to like just take the normal thing, like there is no perpetuity, there is no stoppage. For example, take the present value and then discount it back to the year before that. Okay. That's it. Very simple. Coming to internal rate of return. Now, internal rate of return, there is a formula that we can use. Okay, internal rate of return is nothing but the return required by the shareholder to invest in that particular company. So how much return do they need? I'll tell you this one thing, guys. So we have shareholders. Shareholders will give the money looking at the amount, the percentage that they will get. Correct? So let's say shareholders want 9% in their investment. And they're ready to invest in the company. Okay. Now the company took the money and they are fine with giving them this 9%. So now for the company, cost is 9%. Can you see this? The same return that shareholders want will become the cost for company. Okay. So that's why if we are talking about cost of finance, this is the cost of finance. Got it? For this particular value that shareholders giving, 9% is going to be the cost of this finance that we are getting. Okay. So IRR, it's just a rate at which project's NPV becomes 0. That means the NPV breaks even. Okay. Whatever we have initially invested, we are getting that money back. Got it? That's it. That's the IRR. Now, it represents the project's own break-even cost of capital, where inflows exactly cover the outflows. So if IRR is more than that particular thing, okay, then you can accept. If IRR is not more, you reject it. For example, accept the project if IRR is more than the cost of capital. Got it? So this is the return for shareholder, but company also should get a particular return percentage. If this return is more than this cost that they're incurring, let's say 10% is the return. Now the return is more than the cost that they're incurring of 9%, right? Then you can accept the project. That's the decision rule. Now to calculate IRR, first you need to calculate the NPV. NPV for what? For 2 discounting factors. Okay. One high discounting factor, one low discounting factor. And then you'll have to just put it in the formula and get the answer. Now this becomes a very lengthy process again, guys. That's why I would suggest you to do the IRR calculation using spreadsheet formula. For example, we have here 0, 1, 2, 3, 4 again. Cash flows, let's say minus 100,000 as outflow, 10,000, 10,000, 10,000. Okay, let me just change it. 10,000, 40,000, 10,000, 30,000. Okay, what you can do is first you can calculate the NPV of it using like 5% discount rate, 10% discount rate, whatever. You can just calculate the NPV and then put it in the formula. Or what you could do is use the Excel formula of is equals to IRR, open the bracket, put in all these values, cash flows, and close the bracket. That's it. You will get the IRR percentage. That's it. It's that simple. And I would always recommend you to do this method because this will just take for 2-3 minutes, 2-3 seconds, if I'm being honest. You just need to drag and put it here. That's it. But this method is gonna take 5 to 6 minutes easily, guys. So don't waste your time unnecessarily. Okay. Next, we have advantages of IRR and disadvantages of IRR. Okay, advantages again similar to NPV, but the only difference is NPV is giving you absolute value and IRR is giving you a percentage. Okay, time value of money considered, good. Percentage return, which is easy to compare and easy to calculate, easy to compare for managers. Okay, uses real cash flow, not profits. Full project life is included, not like payback period. chooses projects with IRR above cost of capital, that's why shareholders value will boost. Okay, but at the same time it has disadvantage also. No absolute value. That means we know the percentage that's coming in, but we don't exactly know how much money we are making here, like NPV shows us. Only an estimate. You need to have many calculations, very subjective and complicated thing. Okay, so that's why you need to be sure with this one, guys. Calculation is very complex, and at times your IRR could be, you could have multiple IRRs. For example, let me take you back to this question. Let's say you have 100k outflow, correct? 10k inflow, again 40k outflow. Okay, now there are two outflows here. In such a scenario where the sign from positive to negative, if it is changing multiple times, that many IRRs you can have, and that is not feasible. Okay, and sometimes there'll be a scenario where IRR is only not there. There is no IRR that exists for that particular project. Okay, then what would you do? IRR would be a useless thing to compute. Okay, now look at the number of times this has changed. It was negative, then it became positive. The first time it changed to positive, second time it changed to negative, and third time it changed back to positive. So 3 times it is being changed. Okay, that means how many IRRs could the company have? It could have 0, 1, 2, or 3. That many times it changes. That's how you get to know how many IRRs a project has, by looking at how many times the symbol has changed from positive to negative or the other way around. Okay, right. Next one, reinvestment assumption. So we are assuming that whatever money we are getting, we are reinvesting it, which at the same rate. That is, it's impossible to find the same amount and same rate. It's very hard. It's not impossible, but it's very hard. Okay, time value of money also becomes a major factor there. Okay, so that could be a difficult assumption to keep in mind. Now, what is inflation? Inflation is the rate at which the general level of prices rise, leading to decrease in purchasing power of money. We will be learning about this in PPPT, which is purchasing power parity theory. It says how much a country's currency can change with respect to its inflation. Okay, we'll look at that, don't worry. Now, there is a return that a company can look at without considering the inflation and with the inflation. Okay, without the inflation, the rate that the company can look at is the real rate. With inflation, it is known as nominal rate. So we have the real rate and nominal rate. So what's the formula, guys? Real plus inflation will become nominal, right? That's the easy way to understand. Real is R, inflation is H, nominal is I. Okay, this is what the formula becomes. So 1 plus I, which is nothing but nominal rate, is equals to 1 plus R, real rate, and 1 plus H, inflation. Okay, got it? Right. Now suppose a lender wants a real rate of 4%. What is the real one? 1 plus 4%, and expects inflation of 6%. 1 plus 6%. What is nominal rate? Here they're asking you to calculate I. You can easily do that. That will be 1.04 into 1.06 minus 1. That's it. That will give you the answer. I hope this is simple for you. Okay, you can probably get it for 2 marks if you're lucky. It's a very, very easy calculation. Okay, if you're using nominal method or real method, there are 2 ways in which you can calculate the NPV. Okay, how do you deal with it? If it is nominal method, you inflate cash flow to reflect the expected price increase, but real method, you will not include inflation, exclude the inflation. Okay, discount them using nominal rate, that includes inflation. Discount them using real rate. So here you will discount with real rate, there you will discount with nominal rate. Most used when different cash flows are affected by different inflation rates. So inflation rates are different. Okay, cash flows are different. Okay, in that scenario, for each different cash flow, you have a different inflation rate. So one inflation rate will not work for everything. Okay, but this side, everything has the same rate. Okay, that's the only difference. Here no tax, here there is tax. If it is real cash flow, use real discount rate. If it is money, which is nothing but nominal cash flow, use nominal discount rate. Okay, simple. Right. Incorporating tax in, now whenever you're calculating NPV, I hope you all might have tried to calculate an NPV sum at least once right now. right? So in that you might have seen there are effects of tax, effects of NPV, effect of working capital in NPV, etc. Correct? So now how do you deal with it? If it is tax, very simple guys. If you have an inflow of cash, that saves tax. It is tax deductible basically. If you have an outflow of cash, sorry, tax you will have to pay, but outflow of cash, there is tax savings in it. Similarly, if you're purchasing a machine, okay, that will lead to some capital investment that you're making, right? Now this capital investment, which gives capital investment, that is also an outflow, right? Negative, it saves tax. Okay. Now, this capital investment that we are making gets a tax allowable depreciation, which creates tax savings. Now, tax allowable depreciation, you will depreciate this, right? That is also coming under tax savings. Why? The depreciation that this particular, okay, let me give you an example. We are buying this machine. I don't know what machine this is, but it's a machine. We are buying a machine. Okay, now on this machine we will obviously have to reduce the depreciation per annum for calculating the profit. Correct? Now when we are reducing the depreciation, the problem here is, guys, depreciation is not a relevant cash flow. It's only a profit estimate, an accounting estimate. Okay, so it is not a relevant cash flow. Then what should we do? We still have tax savings on it. How? Because the tax savings on this particular depreciation is a relevant cash flow. Recently, when I was solving this one sum, I saw this type of question. That's why I wanted to bring it to your notice also, guys. See here. They will ask you whether tax allowable depreciation on capital investments is a relevant cash flow. No, it is not. Tax allowable depreciation is not a relevant cash flow. Tax savings on that tax allowable depreciation is relevant. Got it, guys? Do not get confused with these small words. They will try to confuse you with, but do not get confused. For example, see here. TAD, it is not a cash flow, but it generates tax savings, and that tax savings is a cash flow. It's a relevant cash flow. Okay. Working capital, current assets minus current liabilities, we will look at that a little later. Okay. But when working capital is looking at the NPV, okay, what do? The initial working capital is going to be an outflow because we are putting in money, and every year working capital increase, again outflow. But the final year, they release the working capital back, they realize it. Okay, that becomes an inflow for us. This is the final year of the project. Don't forget to mention that. That's going to be an inflow. Okay. Yeah. Now coming to lease versus buy decisions, very simple topic. Okay, so now certain projects will require a machine, or most of the projects will require a machine. Let's just say one project requires a machine. Okay, now you have two options, guys. Either you can lease it or you can buy that particular machine. It depends on how much money you have and based on what strategy you're choosing to apply. Right now, when we are looking at leasing the asset, then what happens? Obviously, asset is not owned by the user. User is who? The company. Okay, we do not own the asset, but we have tax relief that is available on the payments that we make for lease, okay, or rent or whatever. Okay, for that we will have tax savings. Okay, but when we are buying it, now the company owns the asset. So the capital investment that we are making here, that is tax deductible. Along with that, it has tax allowable depreciation, which creates tax savings, which is also a relevant cash flow and saves us from the burden of tax. Okay. And later, obviously, we may sell the residual value, and for whatever value we are selling, we'll have to pay tax on that. Okay. So now, for each of this, what is the relevant cash flow? Here, lease payments and tax savings on lease. But here, purchase cost, which is nothing but initial capital investment. Now, tax savings, which we just spoke about, residual value also we spoke about. But very important, do not include interest payments. Why? Why are we not including interest payments? Because they're already taken in this particular rate. Whenever we are buying, guys, we are always 100% going to assume that it is being financed from a loan. Okay, and for that we need, for that borrowing we need to incur some cost, right? And that is calculated using this rate. Got it? And this interest is already included here. For example, let's say to buy a machine, we'll have to get a loan of something, right? And the interest rate for that loan is 10%. But after, always look at the post-tax cost of borrowing. Let's say tax is 30%, so it will be 10% into 0.7. Okay, so whatever the answer to that is the post-tax cost of borrowing. Okay. Right. Now, this is a question which I have seen very frequently being tested in the recent years. Okay. I would not want you to miss out on this easy concept, right? I think I obviously cannot be sure, but this could come in your exam because this is how many times it's been repeated. Okay. Calculating the EAC and EAB, it came in section C question also, explaining what is the difference between this and that. Okay. Now, let's look at this example first. Toy, you want to buy a toy. Okay, you have two options. One, you buy toy A, which costs 600, but it lasts for 3 years. Okay, the second option is you buy toy B, which costs 900, and then it lasts for 5 years. Now, if you're a smart enough person, you're going to think, okay, it's 600 for 3 years, 900 for 5 years, which one's better? Okay, you will not immediately be like, 600 because I am paying less. You will not be like that if you're smart, that is. Okay, so you will do 600 divided by 3 to check that per year the total cost for you is going to be 200. But for this one, it's going to be 900 divided by 5. That's going to be less than 200. I don't know the exact amount. Let's look at the calculator. Okay. Yeah, that's going to be 180. So if you look at the year-wise value, then this 180 is what's going to be beneficial to you, correct? So you will choose to buy toy B because you're able to spend more, spend less and then use it more. That is where EAC comes in. Got it? How much cost are you spending for 1 year to look at it? Okay, that's the formula also. What is the present value of it and how much are you spending looking at the present value? Okay, similarly for EAB, that is equivalent annual benefit. Here, how much money are you saving per year, you'll see. And if you're saving more money for that year, you will choose that option. If you're spending less, you will choose that option. That's the only difference. Got it, guys? Next, we'll come to capital rationing. Capital rationing is a very fun topic. Okay, this is when we'll have a lot of NPV projects, positive NPV projects. Okay, but we cannot undertake all of that because we do not have that much money. Okay, now this could be because of two reasons. Okay, capital rationing, that means ability to not invest in all the NPV projects because we don't have enough money, could be two. One is hard capital rationing and one is soft. Okay, hard capital rationing is when the economy puts it on you. Okay, for example, see, imposed by lenders, market conditions, etc. Now, let's say the country is itself having an economic downturn. Okay, we do not have enough collateral or whatever to give it to the lender to get the money. Okay, that could be because of hard capital rationing. But soft capital rationing is within the company. For example, we will probably not have enough resources to work on that particular project. Then we cannot undertake the project even if we have enough money, because who's going to do that project if we don't have resources? Correct. So soft capital rationing is set by the company itself, set by the management. But here it is externally imposed on us. Okay. Now, capital rationing can be done are of two ways basically. One is single period, where just in one particular accounting period you lack funds, or it could be in multiple periods you lack funds. Okay, so now either ways you'll have to do something, right? But good for us that this is out of our syllabus. Multi-period capital rationing is not going to be tested for you, but single period is going to be tested. Okay, and for dealing with this you'll have to deal with profitability index, PI. Okay, here what we'll look at is multiple projects. Okay, all the projects, how much NPV each project makes, how much is the initial investment you're giving basically to get the project done, right? You'll have to see this and see which project will give you the highest profitability according to how much initial investment you can give. Got it? You'll divide this to get the profitability index, and then you'll have ranks set for each of it. For example, if I give you, like, we have projects A, B, and C. Okay, and for this the NPV is 10, 20, 30, but for this initial investment is 100, 120, and 110. Okay, or let me take 120 here also. Then our profitability index is gonna be NPV divided by initial investment, which is 10 by 100. What is it? 0.1. 20 by 120. How much is it? I don't know. We'll check. 20 divided by 120, which is 0.17. Okay, and then there is 30 divided by 120, which is 0.25. Now here, guys, you will look at the highest amount. Okay, 1 second, let me take this a little this side. Now you will set ranks for each of it from the highest to the lowest. This is giving you the most money, so this is gonna be rank number 1, rank number 2, and rank number 3. Now if you have only little money, you will invest in this first, and finally this one. This is what profitability index is. Very, very simple topic. Okay, now coming to the next topic of risk and uncertainty. Investors will only take so much risk to get so much return. Okay, if they are taking high risk, they will expect a higher compensation or return to get. Okay, now risk is quantifiable. Okay, uncertainty is unquantifiable. We cannot quantify it. Okay, risk we can look at through different probabilities that we assign. Okay, however, uncertainty we cannot assign probabilities because there is too much uncertainty, too much unpredictability here. Okay, obviously here you cannot do anything. There is no mathematical way in which you can find out how much the uncertainty is. The only way you can do is using judgment call. Management should make the judgment here also. Okay, but here we can look at a few maths or stats tools to decide how much risk is there and how we can deal with it. Got it? Sensitivity analysis asks the what if question. For example, what if what if sales fall by 10%? Will the project still be profitable? That kind of question. What is it? Now let's see. Let's say NPV is 100. Okay, and sales, if it falls by 20%, NPV will become 0. Okay, but how do we know that if sales falls by 20%, NPV will become 0? That is sensitivity analysis. Okay, so now we need to see how sensitive one variable is as compared to the NPV, and which can make the NPV's value negative, basically 0. Okay, so for that we will be using this formula. For example, see here, let's say sales was NPV was 10,000, sales was 2,000. Okay, then what is the sensitivity of sales? How much percentage can sales change by to make NPV 0? Basically that question we are asking ourselves. So what is NPV? To 10,000. What is the relevant cash flow? 2,000. So into 100, 10,000 divided by 2,000, 5 into 100. What is this, guys? I'm so bad at math at this point. Okay, 10,000 divided by 2,000, which is 5 into 100. Sensitivity percentage. So this will not come in such big amounts, but it will come in percentage. So I'm just going to assume it's going to be 5% fall. Okay, if the NPV falls by 5%, so sorry guys, it is NPV is 2,000, sales is 10,000. Otherwise it doesn't make sense, right? Okay, so NPV is 2,000, sales is 10,000 into 100. That will be, let's go back, 2,000 divided by 10,000 into 100. That will give 20%. This makes sense. Okay, so 20%, if the sales revenue changes by 20%, why is it not erasing? 1 second. Yeah, so If the sales changes by 20%, NPV is going to become 0. So you need to make sure that sales doesn't change by 20%. 20% is a very valid number, but sometimes the changes are as less as 1%. So 1% here and there could happen, right? Then there's a high chance that NPV could change. Okay, and we do not want such things. That's why sensitivity, as low as the sensitivity is, that high there is a change, that high there is a chance that NPV could become 0. Okay, so we'll always look at how sensitive one variable is as compared to the NPV. But the problem with sensitivity analysis is it just looks at one variable at a time. That's why to counter attack this particular thing, we have something called simulation. Similar to sensitivity analysis, it looks at the changes in variables and sees how sensitive it is. But then here in simulation, we can look at multiple variables at a time. That is so much cost savings, so much time saving. Okay, but again, it's a very complex method. It's time consuming, it's costly, right? So everything has its own disadvantages and advantages. But then here it considers all outcome. Once you set it up, it's very easy to understand, but to set it up, it's a little hard in the beginning. Okay, now sensitivity analysis, it's simple to understand, helps management makes judgment based decisions. Okay, yeah, fine, other things you can go through. It doesn't give a right answer. Okay, again, it depends on judgment. Probability analysis is when there are multiple possible outcomes to one particular thing. So what we need to do is figure out for each probability what is the expected value. That's why this is related to this. Okay, so now it shows an average of all possible long-term outcomes. Okay, what is it showing here? Basically, if one project can be undertaken hundreds of times with different chances of different probability happening, then what is the expected value? So this will give us this assurance of, whatever we do, at least so much value we will get. Okay, that is expected value. But this is only useful when you are looking at a project that is happening multiple times. If it is a one-off project, it's the worst decision you can make. It's not going to give you a right picture here. Standard deviation shows how much that particular outcome deviates from expected value. Okay, so expected value shows we'll get $1,000 profit, but then we only got 200 profit. Okay, how much is it deviating from expected value? 800 divided by 1000. So it is deviating by 80%. That's a huge amount, right? So we need to see how much is it deviating from. Obviously, all this can come only for like 2 markers, guys. Don't get too stressed about all of this. Now, remember in payback, we had this disadvantage where it is not considering time value of money. Just to counter that, they have bought something called discounted payback method. What is discounted payback? Basically, it is incorporating the time value of money. Now, advantages, disadvantages, everything is same except for the time value of money. Time value of money was a disadvantage in normal payback, but here it is an advantage. That's it. That's the only difference between payback and discounted payback. Okay. Now, we are done with initial the main investment appraisal. Now we have to go to working capital, followed by which we'll go to investment, followed by which we'll go to financing and dividend decisions. Those two are small topics, okay, as compared to investment. This is a huge load. Half of the FM syllabus is completely investments. Right. What was working capital? Current assets minus current liabilities. Correct. If it is a positive working capital, that means company can meet its short-term obligations, which is very important. If a company cannot meet its short-term obligations, it is gonna go bankrupt. There is no future for a company like that. Okay. Now, cost of investing in working capital. There are two costs that we need to look at. One is funding cost. How much money are you spending on funding the assets, or how much is the lost opportunity cost? Okay, net cash that is tied up is this one. This is the cash operating cycle or working capital cycle formula. Now this I've learned it in this acronym of RIP. So receivables plus inventory minus payables. Okay, that is going to be the cash operating cycle. In working capital, the main thing you need to know is the trade-off between liquidity and profitability. Okay, sometimes when you chase after profitability, it reduces liquidity, and when you chase after liquidity, it reduces our profitability. Okay, so you need to get a perfect trade-off between these two. Okay, obviously you need your company to be profitable, but you do not want to do it in expense of your liquidity. Okay, because obviously in the end, cash is there, that's what matters. With that cash is what you'll invest in projects, pay dividends, etc. Just profit is not going to help much. Okay, now approaches to managing working capital. There are two ways in which you can manage working capital: aggressive approach and conservative approach. What is aggressive approach? Basically, the company maintains low level of working capital. Why do you have to maintain a high level of working capital in the business when it's doing nothing, basically, right? So what they are doing is they're taking up that working capital and investing it in multiple different projects to get that profit. But now, if there comes a time where you need money and to, like, pay off your debts or anything, and if you don't have that, it's going to lead to bankruptcy in the end. Okay, if you do not have enough working capital. But conservative is you are saving in, maybe we will need it. That kind of question you're asking yourself. If this happens, we'll need it. What if this happens, we'll need money for it, right? So that is conservative. So even if it is unnecessary, you still maintain high levels of working capital. You pay your suppliers early. You do what not, just like, have it conservative. Do not take much risk is what these people believe in. Now, implication: lower cost of working capital. Why? Because you are not maintaining much working capital. You're just, investing here and there. You're getting profits from everywhere. But then this has high risk of liquidity. Okay, the opposite is what goes to conservative approach. Here, what are the risks? Low receivables, shorter credit to customers. You're not giving them a lot of time to pay. Okay, receivables are very low. That's why the customers might be like, these people, they're not giving us enough credit time, like, to pay the credit. Okay, let's just go to somebody else, is what they'll think, right? So now here you can lose customers. Customers are the main person in any business, right? Without them, there is no profit. But you can lose customers because of that. Low inventory will lead to stockouts. Then what will happen if some customer comes to our shop and then they're like, I want to buy this, and every time we'll keep answering, it's not there, we'll get it later, you will stop coming to the shop eventually, right? So that is lost sales, dissatisfied customers. But if you have high payables, then suppliers will not prefer to give you more supplies. Okay, they'll be like, these people just want to, like, extend the credit period, we'll not get profit, what to do, let's not do it, is what their final thought will be. Okay, so then, if there's some discount or something, you lose it, then supply, everything is just gonna go haywire. But in conservative, there is a high cost of working capital because you need more capital. Okay, the capital is tied up in whatever working capital, receivables, payables, inventory, whatever it is, it's tied up there. So you don't actually have enough cash in your hand that way. Okay, lower risk due to better liquidity and buffer. Yeah, I mean, that's there because you have all the working capital existing. You can get cash anytime. Okay, but then again, what are you going to do with it? If you cannot get some profit, business needs profits as well. You cannot just stick with one thing. Like I said, you need a perfect trade-off between the two. Now, this is something that is so widely tested for your true or false questions, like in 2 markers. Basically, you need to know what is overcapitalization and overtrading. Okay, overcapitalization is equals to undertrading, overtrading is equals to undercapitalization. Okay, that's the relationship between these two. Overcapitalization occurs when the business holds too much working capital. Overtrading happens when it doesn't have sufficient working capital. So basically this one and this one. Got it? Now, this is an important question, guys. They will give you like 4 options and they'll tell which option shows that the business is overtrading. Okay, these are the 4 options. Very, very important, very frequently tested. So if liquidity ratio is falling, overtrading. If there's a huge growth in sales revenue, overtrading. If working capital days are rising, overtrading. If assets is mainly funded by payables, overdraft, or whatever, overtrading. Okay, these are the 4 main factors through which you can identify overtrading. Okay, now these are the working capital ratios. You need to learn these ratios. You can be tested in your section E or B. Obviously, if you would have done FR, you would have seen how important ratios are there. right? But here it is not of that much significance. Okay, it will obviously not come for a 20 marker, but then at the same time you cannot underestimate it because it can come for like 4 to 6 marks from section A and B. Okay, so go through a few working capital ratios, right? So you can go through these. It's easy topic. Cash operating cycle is that R plus RIP1, receivables plus inventory minus payables. Okay. Okay. So what is cash operating cycle? Basically, it is the time that the business takes to get inventory, sell it, and get money back from investors, customers. Okay. And there are two companies here. One is that manufactures their products. One is retail businesses. So if you're manufacturing the products, first you need to buy the raw materials from supplier. You need to get work in progress ready. You need finished goods, and then receivables and payables. Receivables and payables are a constant part in both. Plus receivables minus payables. But inventory is where it changes. Here there is only one inventory because you're buying it and selling it directly. But here you're manufacturing it. Okay. That's why you have raw materials, work in progress, and finished goods. Add everything and then do the normal thing. Got it? Right. Next is inventory management. Inventory management. Here sometimes the cost of holding inventory is too high or too low. How is it to cost of holding, cost of high inventory and cost of low inventory? There are costs for both of it. Okay. Now if it is high inventory, then that particular inventory, it's an opportunity cost because capital is tied up in that inventory. Instead of this, you could have done something much better to get profits. Okay. But if that's not happening, it's an opportunity cost, lost cost. Storage and admin cost you have to incur because you're holding too much inventory. Where will you store? You cannot store everything on your head or in your house, right? So you will have to like pay for the factory, pay for the go down or wherever you're storing it, and you'll have to like employ people to look after these things, etc. Not to mention risk of obsolescence of damage. If there are worms coming in your food or if there are rats biting on your textiles, then we do not want such things. Okay, already we're spending too much, we don't want to spend more than that. Okay, keeping too little inventory also is a problem. Why? Because of stockouts. Like I said, dissatisfied customers, remember? And high reorder or setup cost that we will do using the sums. We have to do this EOQ sums, etc. We'll look at that. Okay. Loss of quantity discounts. So what is the meaning of that? If you buy it in small quantities, you will not get bulk discounts. Okay. But if you're buying it in bulk discounts, bulk quantity, you will get discounts. So if you want to use that, you will have to go through this. These are a few words that, again, like I said, section A and B are gonna bite your head off if you do not know the meaning of these words. Okay, so we have reorder level, which is the stock level at which new order should be placed. For example, let's say we have 100 inventory left. Okay, and we'll be like, as soon as there is 20 inventory, we need to order more. Okay, then this becomes the reorder level. Got it? Reorder quantities, after it reaches this reorder level, how much should we order? For example, let's say our target is always to maintain 500, and if our quantity is 20, how much are we going to maintain? 480. That's going to be our reorder quantity. Okay. Lead time is how long does it take between ordering it and receiving it. For example, you go to Amazon, try to buy something. Okay, you click on the purchase button, you make the payment, and then after that, how long does it take for them to deliver it to you? That's going to be the lead time. Okay. Buffer inventory is if unexpectedly this reorder level is not sufficient and many more customers came, you still have to have a buffer. Okay, like just in case type of stock there. Okay, that is buffer inventory. Now for all of this, we'll have different formulas. You will need to know that because you'll have to calculate it, but this is one of the most important formula. EOQ is very important in working capital. Okay, what's the formula for EOQ? Why did I write it here? 2 square root of 2. CO is ordering cost, D is demand, and CH is holding cost. Okay, for each of that also we have different formulas. For ordering cost, it is demand by quantity into ordering cost, and holding is quantity by 2, which is average inventory, into holding cost. Okay, now what is the meaning of total cost? Total cost is the purchase cost that is normally there plus holding cost plus ordering cost. Now to find this out, purchase cost will be very directly given in the question, but holding cost and ordering cost is where you need to like spend your time. Okay, you will need to calculate it. For that, you will need to learn the formula, guys. There is no shorter way to do this. Okay. Now, right, total cost of ordering inventory is this one, which is nothing but this is the formula for holding cost, and this is the formula for ordering cost, and D into C is nothing but the purchase cost, total purchase price. Okay, fine. So see here, EOQ is basically the point where it minimizes your holding and ordering cost, a point where you spend the lowest. Okay, purchase price is gonna, let's say, be constant. Okay, but if you reduce this, the value of total inventory also goes down. Okay, that's the thing. This is holding cost, this is ordering cost. The point at which they are at the lowest, that's where we'll find out the EOQ. Okay, that's how much we need to order to have the least loss. Now again, very important, assumptions of EOQ is gonna be tested. Okay, could be section A, B, or a small part of section C. Also, it could be tested under working capital, basically. Okay, so you need to know what are the assumptions of EOQ. They can give you 4 assumptions and be like, which one is not an assumption. You need to be very thorough with such things. Now, this is the process of calculating the EOQ. First, you just calculate the EOQ by filling in the amounts in the formula. That's going to be the EOQ, right? But sometimes you have discounts associated with it. They'll be like, if you buy so much quantity, we'll give you discounts. Okay. In that scenario, we need to see if the discount that we are getting is compensating for the EOQ that we are not choosing. Okay. That's why first what we need to do is always calculate the EOQ and check whether the quantity is qualifying for the discount. For example, let's say if they tell 500 units if you buy, we'll give you 2% discount or something. But our EOQ is only 400. It's not qualifying for the discount. That's it. You stop right there and then you compare whether EOQ is better or discount is better. But if it is qualifying for the EOQ, then it is even more better because you'll just buy it through the EOQ and then you'll get discounts. So if it is not qualifying, then you need to know, do a cost benefit analysis and try to understand which is the better option. Okay. So then you calculate the total cost at EOQ. Total cost formula is purchase price, holding price, ordering price. Okay. Calculate the total cost at discount level. Now let's say for 400, which is the EOQ, you will calculate the total cost. And for the discount, that is 500, you will see after calculating the discount whether the cost is something. So if the total cost here is 10,000 and the total cost here is 9,000, you will obviously not choose the one with EOQ. You will choose the one with discount because you're saving much more on that. Got it? You will do a cost benefit analysis basically. Okay, whichever is the lower cost, that's what you will be choosing. Reorder level. Now there are 2 formulas to this. One is if demand per unit and lead time are constant, then very simple, ROL is demand during the lead time. But if it is not, then this is the formula you need to use. Okay, many students mess up at these formulas for ROL and maximum period, maximum average, lead time, etc. These are the words people get confused with. You guys don't get confused with it. Okay, this is an important concept. We cannot skip out on this. Okay. Right, so this is the formula for reorder level that if they ask, it's a straightforward calculation. Periodic review system. Periodic review system is very simple. At fixed regular intervals, inventory is reviewed. Okay, if there is a chance of stock out, it's okay. Purchase at that time. That is periodic review system. Okay, every frequently, basically regular time intervals, what you do is you go check. Okay, so that we have the specific target level, we need to bring inventory to that level. If it's too low, then you will order more. If it is too high, then we cannot do anything. It's gonna be a wastage. Okay. Just in time inventory, the main advantage for this, 0 holding cost, no wastage. Okay. Disadvantage, here inventory is not tied up, so that's why cash flow is also improved for you. What could we ask for something? What could we ask for better? Okay. Disadvantage, however, here we need to have a very good rapport with the supplier. So as soon as we ask them for supplies, they need to be immediate in sending it to us. Otherwise, again, these stock out problems and lost customers and whatnot. Okay. But sometimes, like we cannot predict delays. right? So that could happen, and that could, like, make the customers not trust us anymore. Slow moving inventory, you need to keep a track of it. Okay, if the inventory is slow moving, then you need to figure it out and get rid of it immediately. Okay, management action. So what can we do if there is a slow moving inventory? You can do a aged inventory analysis. That is something that analyzes how long the inventory has been there in the business. You eliminate obsolete items. If there is no use of that particular thing, get rid of it. Do not waste your holding money, holding cost on that particular irrelevant thing. Okay, only reorder when needed, just for unnecessary scenarios, because you have too much money. If you keep ordering, then your business is bound to fail, right? Impact on working, and never mind. Accounts receivable management. Now accounts receivable and accounts payable, that we'll be learning. Okay, the goal is to determine optimal level of trade credit, which balances. We need to create a trade-off between profit and cost of profit. Okay, for receivables, basically we need the customers to pay us back fast. Okay, but at the same time we need to encourage them to pay them fast, right? So we need to give them discounts, this, that, right? But then this discount has some cost. So the benefit of paying back fast versus the cost of these discounts is what we need to compare to figure out what action we will be taking. Okay, now 4 aspects of credit policy. This is important. So whenever you have a new customer, how do you know that you're going to give it for credit, right? So what do you do? First, you assess the credit worthiness. Every new customer that comes in, you need to make sure that this person pays. Okay, you need to like check, go to his background details, become James Bond for a while. Okay, set credit limit. After you get to know how credit worthy he is, you will set a limit for him. You will see how much can we give him a credit for. If he's a stupid customer who doesn't pay back early, it doesn't make sense that we give him 1,000 million credit. Okay, max to max, what, 1 million we'll give them. Okay, but if he's a really good customer and he pays back on time, is a good person, etc., we give him more limit. Doesn't matter. Okay, after step 1, we can figure out whether step 2 is the right amount. Next, invoice promptly and collect overdue debts. So first, invoice promptly, will ask them, telling, see, you need to pay back. This can be done by you, or you can get in like factors to do it. We'll look at what factors are. Collect overdue debts. Obviously, we're not doing a charity, we're doing a business, so we need to collect overdue debts. I think I broke a little of the chair, but it's okay. Fine. Right. So then monitor the credit system. So what are we doing here? Basically, sometimes we just go behind the customers, they pay back, but sometimes we forget to collect from them. That's why we need to go back to the credit system and keep regularly reviewing it by checking if all the receivables have been received, and if it is not, do your aged analysis, etc., and figure out if we are going to get that particular thing or not. Okay, calculation of accounts receivable. Remember, I told you to go through the working capital ratios. I'm just doing it once more here. Receivables balance is going to be credit sales into account receivable collection period divided by 365. But this one depends on the question. Sometimes they give this at 360 or 366. You need to be careful. You cannot just choose 365. Okay. Finance cost is receivable balance into interest overdraft. So see, to give out the receivables like that, we need to get money from somewhere, right? We'll be funding the receivables from somewhere, and for that we'll have to pay some interest. So you figure out how much cost you're spending on this finance, and if we are giving discounts to the customers to pay us back early, whether that particular discount is more beneficial than this particular cost. Okay, so how do you calculate discount? Using this formula. And if the proportion of customers that will be taking the discount, let's say we 100% of the customers are there, right? Out of this, only 30% customers will be taking the discount, and we know the amount of customers that will be taking the discount, you will not use this formula. Then you will do a cost benefit analysis. If you use this formula at that time, your answer is bound to be wrong. Okay, so what are you going to do, guys? You will use a cost benefit analysis and try to solve it by yourself. Got it? But If the customer's proportion is not known, then you can use this particular formula and get the answer. It's a shorter way to do it. But yeah, just remember when to use the formula and when not to use the formula. Only use this method. Which method? The cost and benefit one. If the question specifies that so many people, so many percentage of the customers are planning to take the discount, then you will do it. Or only a portion of customers are expected to pay early. If they give you a portion of customer itself, you need to start by using this formula. I mean, this cost benefit analysis. If they do not give so much percentage of customers and all that, then you go back to using this easy formula. Okay. Next, invoice discounts. So what is invoice discounts? Here is basically how do you get your money back from the customer? Do you run behind them like you're running in a marathon, or do you appoint or outsource this task to somebody else? That's going to be the main question here. Okay. So what do you do? One main question that can be asked is factoring. Okay. Now factoring, there are two types. One is with recourse and without recourse. In without recourse, that is non-recourse factoring, the factor bears the risk if the receivables are gonna be bad debts. Okay, but if it is with recourse, then the client bears the risk. So we will have to still consider it in our books. But if it is without recourse, we will not care anymore. We remove the receivables from our balance altogether. We are like, yeah, whatever factor, you were the one who chose it, right? So yeah, advantages of using factoring. Okay, what could be the disadvantage? I'll tell you first. So basically, guys, it's like this. So customers are there, right? They will not like if someone else is coming and bothering into their business. It's between you and the customer. Why are you calling a third party in between? It's like a relationship at this point. Okay, you do not call in different people in between. You sort it out amongst yourself. Okay, you are there, the customer is there. Ask the customer. It's okay. Do not call in extra people there. So the customer is going to be very awkward with the third party. He'll be like, yeah, why are you coming? I'm dealing with this other person. Okay, there's a reputation risk. Obviously, that means what? It signals financial distress. What is the meaning of that? They'll be like, why are these people so desperate in collecting their money back? They don't have money, or what? Are they going to go bankrupt? Is what people will start thinking. Okay, loss of credit control in non-recourse deals. So basically, if it is a non-recourse deal, which is factor bearing the risk, we do not have any credit control there because everything is done by the factor. Okay. Okay, sometimes this factor takes in more money than what we could collect from the customer. So customer collection, let's say, is going to just give us a loss of 5,000. But these factors are coming in and they're like, you give us 20,000, we'll do everything else, right? So that's going to be a loss for you, right? So you need to again do a cost benefit analysis here. Okay, advantages is it improves the cash flow. Up to 80% of the money that belongs to the receivables, the factor will advance it to us. Be it anything, could be recourse or without recourse. But if it is recourse, we need to pay it back to them if the customers are not giving it. Okay, it reduces admin work because the factor is doing work for us. Access to credit assessment, here there is a loss of it, but here we have access to it. Okay, non-recourse offers bad debt protection. It is like insurance now. Understood? Understood, guys. Factoring is also a very important topic. You will probably get one question from it. Okay, could be a calculation question or could be a like this advantages, disadvantages, without recourse, with recourse question. Okay, now okay, this is not account receivable, it's account payable management. It's the ability to purchase goods or service without immediate payment. So whatever we learned for receivables, we'll be learning for payables right now. Okay, early settlement discount. Again, guys, everything is similar, but here if you are paying early, maybe you're getting a little more discount. That could be a option, right? So to calculate that, this is the formula you can go through. Okay, but this particular thing, number of periods, is this one. Okay, that's how you realize how much early settlement discount you're getting, and you decide, early settlement discount, is it worth it to choose it, or should we just do like randomly, like we'll just use the payables and we'll use it as a short-term finance, no cost, nothing, we'll use it in our business, we'll use it to fund NPV projects, you can see. Okay, but if the discount is really good, then I don't mind going back and paying it right now because the discount is that good. Right. So now we'll manage the foreign trade. Okay. Here the only thing you need to know is, I will tell you what's the only thing you need to know. One is export credit risk management techniques. Okay. So these are the tools that deal with foreign exchange trade. Okay. Just learn these words. Okay. And try to understand what they are maximum. What is letter of credit? It's a guarantee of payment from the other person's bank. What is credit insurance? You're just taking an insurance basically about that credit. Offload receivables to the third party, similar to factoring, guys. Export factoring, this is okay. Bank guarantees, added assurance of payment, and no credit or cash in advance. So basically, you're not waiting for them to pay later through credit. You're like, pay it right now and then I will send you the goods, like that. Got it? So sometimes what kind of question they'll ask here is, which one is a foreign risk management technique? Okay, you can choose this. In a question, they had mentioned even commercial papers. Commercial paper is not a technique, it is a source of finance. So we will not choose that. So they'll be like, which is not, commercial paper is not, like that. Okay, coming to cash management. Cash management is how much cash you need to have in the company, how much cash you can invest. Okay, that is what you'll realize from cash management. Insufficient cash can lead to loss of settlement discounts. What is the meaning of that? If you do not have enough cash in your business, what's gonna happen, guys? If there's a discount for payables, you will not be able to take it up because you do not have enough money to pay for that. Okay, then potential liquidation because you'll not be able to pay your debts. Okay, right. Now here, aspect cash forecast, this is really not necessary. Okay, this is very, very, very important. Okay, there are two models in which you can manage cash. Okay, one is the Baumol's model, which is similar to the EOQ principles that we learned, and the other one is Miller-Orr model, which I will tell you. Okay, so first let's start with Baumol's model. Same formula, but C here is transaction cost. Okay, not CO, not ordering cost. C is transaction cost. D is demand, similar to that one, but here demand for cash. H is holding cost. Okay, that will give you how much is the optimum amount of cash you need to have in your company. Got it? That is Baumol's model. Remember that. Okay, it comes under cash management. But Miller-Orr model is like this. Okay, we have cash, right? So we will set a limit, a lower limit and a higher limit. Okay, if the lower limit touches, we will not go below that. Okay, for example, let's say 10,000 to 50,000 is the limit of cash we need in business. What are we going to do? If the cash level falls below 10k, like 5k, 6k, you will bring in a little more cash and keep it there. Okay, because that's going to be a limit for us. But if it exceeds 50k, also like 60k, 70k, what you can do is this extra money, extra cash, you can invest it, okay, to get more returns. But this particular limit should not be breached. There should be an upper limit, lower limit, and if it crosses that, we need to bring it back to the limits. Got it? That is Miller-Orr model. Now for this, there is a formula that you can use, which will be given in the exam. So although it looks like a very complicated formula, it is simple. Okay, variance, how much are they, like, going, deviating, basically. Return point, you will calculate. All this information will be given in the question. Your only job is to take it and put it in the formula and then get the answer. Okay, they'll ask you for a return point or spread or whatever, and they'll ask you what Miller-Orr does. You will tell it is a lower limit, it sets a lower limit, upper limit, whatever, and transfer of cash should happen when upper or lower limit is breached. Got it, guys? Yeah, again, even for working capital funding of cash, there are three strategies: aggressive, conservative, and matching. Aggressive and conservative will learn in working capital, the other one also. But here, aggressive is use short-term finance for all assets. Here, you use long-term finance for all assets, and matching is you match the duration of finance with the asset. So for how long do you want the finance? If you want it for 1 year, go with short-term. If you want more than 1 year, go with long-term. That's it. You match it. Okay, so here obviously risk is high, low, cost is low. You need to see what the company needs and then decide. Right. Now comes the macroeconomic policy. Now, theory is not very often tested in FM, but it could again come for section A questions. Okay, section A. I don't think it will come for section B also. Just section A. Okay. So what is macroeconomic policies? This is something that the government is aiming to do to improve the performance of economy. Okay. Now it could be by increasing inflation, decreasing inflation, increase the interest rate for short-term and long-term bonds, anything it could be. Okay, so we can just skim through this. Monetary policy is the government regulating the money supply and controlling interest rates. Okay, here they are basically controlling the flow of money to control inflation, to stabilize the economy or whatever. Okay, well, this is not that very important. I mean, you have to go through it. You will get certain marks from it, but you can go through this one. There's nothing to revise about this. Fiscal policy is something that looks at how the government is raising finance, how they are spending that particular raised money. Okay, how do they usually raise money? Obviously through tax. And how are they spending it? See, tax, or they could borrow from people, from other countries. Okay, and how are they spending this taxed money or borrowed money is what we'll be looking at it. Fiscal policy. Got it? Again, taxes types, direct, indirect, etc. Okay. Sustainability is nothing but defined as meeting today's needs without compromising the future. Remember, I told you about CSR, similar to that. Okay. Corporate governance. Again, this could come again, like I said, it's coming in all the papers. So let's not skip it. There should be a clear separation between CEO and chair. All this we've gone through, but let's just go through it once more. Appointment of independent NEDs, establishment of audit and remuneration committee, transparent director recruitment, active risk monitoring. Audit committee should be made up of NEDs. They should monitor financial reporting, internal control, and relationship with the external auditors. It couldn't be more simpler than this. Coming to financial markets and treasury function. Here you need to know that financial system consists of three things. One is markets, one is institutions, and one is securities. Securities are what we invest in. Institutions are where we borrow money, and financial markets are where we invest it, okay, or take money from, like stock exchange, money market, etc. Right? Now, markets are also of three different types. Main two are capital and money market, but other than that, we have other markets also, like commodity, derivatives, forex market. Derivatives, we will be learning about it, but then majority of it comes in AFM, so we do not need to focus a lot on it. Okay. Calculation will only be for forwards. Okay, futures, no. Forward, spot rate, this is what we'll be dealing with. Money market hedge is a very important topic in your syllabus. We will be going through that also. Okay. So capital markets are, like, you know, stock market, bond market, etc. Money markets, treasury bills, certificate deposits, certificate of deposits, commercial papers, etc. Right? Okay. Derivatives, we'll be learning about these four, but calculation you just need to know for this, and money market hedge. Okay, centralized versus decentralized treasury could come as a 2-marker maximum. We'll see. So centralized treasury is, in a whole company, there's just one treasury department and they deal with all the projects. Okay. Decentralized treasury, however, is each department get their own treasury function. Okay. So here single control, here local decision making. Now this, both of them have their own advantages and disadvantages. For example, centralized, there's lower cost. Okay. Because if we are borrowing in bulk also, we get that bulk negotiations, better discounts. Okay. Risk control is better, liquidity is higher, because if anybody wants it, they can just go get it from them. But at the same time, you know how many hierarchy we should follow, how many people we need to ask for permission. That's going to delay the process too much. Decentralized is more autonomy. That means this huge hierarchy is not necessary anymore. And fast and local response, if we are looking at the local demand, and immediately we can adjust with that and then get the new products, get money for the new products. Okay, foreign exchange risk. Now this foreign exchange risk, interest rate risk, these two topics will give you one section B question. Okay, if you cannot answer it, you're losing 10 easy marks only from section B, whereas you can get that from section A also, a question or two. So 12 to 14 marks you'll be losing if you do not know foreign exchange risk. Okay. Firstly, these types of risks are very important in section A, section B, they can ask. Okay. There are three types of foreign exchange risk: transaction, economic, and translation. Translation risk is just an accounting risk, which is from one company's balance sheet, that is from one currency to the other currency. When you are converting and translating, there's this accounting loss or gain that happens. That does not affect the cash flows. Translation risk. Transaction risk, however, is the short-term exchange rate differences which will lead to small profits or losses. Okay, but economic risk is just transaction risk. Economic risk is just transaction risk, but in a long term. Got it? This is the difference between these three. Okay, now exchange rate systems. What is exchange rate systems? We have floating exchange rate, fixed exchange rate, and managed floating, which is also known as dirty float. Okay, this is nothing but the hybrid of fixed and floating. This is usually done for smoothing. What is smoothing? So there is no sharp increase or decrease in the amount that you will be earning. Okay, for example, floating is you just go with whatever the economy is taking you to. Okay, fixed is you have a fixed exchange rate, so you cannot maybe take the favorable advantage of economic increase or decrease, or it will also lead to you not being uncertain about the future. Okay, let's say you took a loan of at, let's say, 10%. Okay, now for this 10% loan, you could either take a fixed rate or you could take a floating rate, which could last from 0% to 50% or whatever. I'm just looking at two different extremes. Okay, now if you would have taken a fixed rate, you would know, my interest amount is 10%. I'll just keep paying 10%. It's not going to make a big difference if the economy goes here or there. Okay, but floating is gonna tell if the economy goes worst for you, you will have to pay so much more interest. But if the economy is going really good for you, you're going to save so much money as well. If you're ready to take that risk, floating is your man. Okay, but if you're taking fixed, you need to have, if you want certainty, you go with fixed. But most of the time people do something called smoothing, where you take a certain percentage of fixed and certain percentage of floating. Okay, so if you have fixed, you can still take advantage of floating if the economy becomes better, or if it becomes worse, it will not matter to you a lot because you still have a fixed percentage. Same time, if you take floating, you still have an advantage of fixed, and you'll not go completely bad or great. Okay, that is smoothing. This is what is explained in IRPT and PPPT, which is nothing but interest rate parity theory and purchasing power parity theory. This four-way equivalence explains the meaning of it. Okay, now here IRPT is just FO by SO is equals to 1 plus IC by 1 plus IB, which is nothing but interest rates of counter currency, interest rates of base currency. Here inflation of counter currency, inflation of base currency, and this is purchasing power parity theory. Okay, right, expectations theory, all this we'll go through. Four-way equivalence is just dealing with these four things. Okay, if interest rate parity and purchasing power parity hold true, then higher inflation should lead to higher interest rate, which would lead to higher depreciation for that particular currency. Okay, right. Now purchasing power parity theory, we'll just go through this one thing. It's like this. Purchasing power parity theory tells something about the law of one price. Okay, now for example, let's say you're buying a shoe. Okay, in the US, let's say dollars, $1 you're buying, $10 you're buying a shoe for. Okay, but in India, that same shoe is not gonna cost you 10 rupees. Correct? Why? It's the same product, right? There should be something like a law of one price, is what purchasing power parity theory is telling. Now they are telling that this difference in exchange rate, so this, let's say, is 86 rupees right now, 860 rupees is what you should spend for $10. right? So now, why is this difference happening? It's because of inflation, difference between the two currencies. Okay, so if there's higher inflation in a country, then the currency of that country will depreciate more. You need to be very, very clear with this relationship between these two. If inflation is high in a country, currency depreciation will be high in that particular country. Understood? Makes sense, guys? Right. Now let's look at it once. The exchange rate is determined by relative inflation between two countries. Based on the law of one price, identical goods should essentially cost the same, right? If country A has higher inflation than country B, the currency of A should depreciate relative to country B. That inflation is reducing the purchasing power. Goods in country A becomes more expensive. Demand from country A drops and people will prefer cheaper foreign goods. Okay, that is, if the country's depreciation is higher, the value of that currency falls, and if the value of the currency falls, everybody will want to buy from that country because it's cheap. Why will you pay more for the same product when you're getting it for cheaper, right? So this is the formula for purchasing power theory. Okay, purchasing power parity theory. So here S0 is the current spot rate, S1 is the future spot rate. Okay, HB is inflation for the base currency, HC is inflation for the counter currency. Got it, guys? Just remember, law of one price. Identical goods must cost same, but they are not costing same because of inflation, which leads to depreciation of that currency. Got it? Okay, so from interest rate parity theory, I think we can do it after the break. Right now, you will go back to switching to PM. So yes.
Hi guys, so I think let's continue with the performance measurement and control part. Okay, so like the upcoming part is like more of like measuring the performance of the company, and it is mainly a theory part actually. Okay, there is less calculation. The only calculation that there is for transfer pricing calculation, I guess. So the rest is just theory. Okay, so I'm gonna explain how to do it. Fine. So the main thing that's happening in this performance measurement is that the ratio analysis. Okay, so this type of question can be asked in section C only. Okay, in section C, as you know that for 40 marks there will be two questions, one for 20, another for 20, and like 120 mark will surely be of ratio analysis. Okay, and in the 20 mark also 5 mark will be for calculations. Okay, so the 5 mark will be to calculate this profit margin and the liquidity ratios, the asset turnover, ROC and all. Okay, so that 5 mark is an easy mark actually. The values will be provided in like directly in the question, and you should just perform that. So the thing that you should be aware is that you should be well known about the equations. Okay, you should by heart those equations thoroughly. Okay, so basically we have three ratios. It's profitability ratio, liquidity ratio, and gearing or risk ratio. So all of the profitability ratios had been marked here. Okay, so the first one is gross profit margin, and the equation is the company's gross profit. It's the revenue minus cost of sales, gives the gross profit divided by sales in 100. That's the equation for gross profit margin. And then the operating profit margin. Operating profit margin will be, as you know, like revenue minus all cost. All right, like that gives operating profit. Like it is also can be said that the profit before interest and tax. All right, profit before interest and tax can be considered as the operating profit, and that divided by sales gives our operating profit margin. And then there is return on capital employed, or the ROCE. And the equation for ROCE is operating profit divided by capital employed. Okay. The equation of capital employed can be total asset minus current liabilities, or total equity plus non-current liability. Alright. The reason I'm repeating that, you should by heart this equation. Alright. Because it's a sure short question. Okay. Those 5 mark is a sure mark, like, and it's an easy mark also in PM comparing to other questions. Alright. And the next is equation for asset turnover. All right, so it values how many revenues are generating for each of the asset employed. So its equation is sales revenue divided by capital employed. All right, and the equation of capital employed is just the same. It's either total asset divided by current liabilities, or total equity divided by plus non-current liabilities. That's it. And then we have this inventory holding, receivable holding, and payables payment period. Okay, so that also, like, you may have studied it in, I think, like MA, like FR and all. Okay, but like these equations are also important in PM2. Okay, so the equation for inventory holding period will be inventory divided by cost of sales into 365. Okay, and for receivable it will be the receivables divided by credit sales. Okay, but in some exam question the credit sales will not be given. In that case you should consider the sales revenue. Okay, you should consider the sales revenue if credit sales is not given in specific. Okay, so we are assuming that the like all of the sale the company is made is credit sale. All right, and next is payable payment period. For that also the equation will be payables and divided by credit purchases. All right, so if credit purchases are not given, then you should consider cost of sales. Okay, sometimes the credit purchases will also not be provided directly in the exam, so you should consider the cost of sales considered as credit purchases, purchases. All right, and so that's we are done with our profitability ratios. So these are the profitability ratios that will be examinable in the question. All right, and next we will be looking at the liquidity ratios. So like the liquidity ratios is more associated with the current asset of the company. So basically we have two equations. It's just current ratio and quick ratio. So current ratio like evaluates the current asset and current liability that we have. Okay, so the equation will be current asset divided by current liabilities only. All right, and also for the quick ratio is the critical cash the company have. All right, so for inventory to be considered as a quick cash, like first we should sell it. All right, so the rest of the current asset will be, as we know, that cash, receivables, and so these both are considered as the like other current asset. Okay, so like cash can be like directly converted into like value like as soon as possible. Okay, like even our like bank cash also we can easily be withdrawn. So inventory is not considered as a quick asset to convert to cash, but still the receivable is considered as a current asset. So have you guessed of the reason why it is considered as that? Because receivable also like money that we don't have, we are supposed to get it, but still we are considering like receivables in the quick ratio. We are only eliminating inventory. Have you guessed the reason for that? Anyone? Anyone? So the reason for considering receivables as in quick ratio is the availability of factoring. I think you guys know that what factoring means. Factoring means like if you have an amount to receive, like we will be like transferring the ownership to like another like factoring companies or something, and the factoring company is going to pay us some amount like as advance. So we are like transferring our receivables to that company, and that company will be like relieving the receivables from our customers in the future. So that's the reason why receivables is considered in quick ratio, but inventory is not. Okay, in order to convert inventory into cash, like first we need to sell that. All right, so that's a like a little bit process to convert into cash. All right, so that's the reason why the receivables is considered as current like included in the quick ratio but not inventory. Okay, so like that's all with gearing ratios, sorry, liquidity ratios. And next we will be looking at the gearing ratios. So the main gearing is more associated with the risk associated with the company. All right, so the first equation will be the operating gearing. Operating gearing like will be based on the company's current activities. All right, so like for short term activities. So the equation for operating gearing will be the fixed cost divided by variable cost. So it means that a company having more fixed cost is considered as more risky, because the reason is that the fixed cost will be incurred regardless of the number of unit we sell. All right, even if we have 0 units sold, still we will be having a fixed cost. So fixed cost is considered as a like risk on the performance management perspective. So if the operating gearing is more, it's a risk for us. And the other equation will be fixed cost divided by total cost also. So like out of the total cost, if the majority of parties like let's say this majority of part is fixed cost, then it is also considered as risky. All right, and the next will be the financial gearing. So financial gearing will be based on the company's financial perspective, and like it will be equating the debt and equity. All right, so the equation will be the debt divided by equity. All right, or other equation will be debt divided by like debt plus equity into 100. Okay, so you can use either of this equation, or in some questions the equation will be specified by the examiner himself. So you should apply the equation as they like suggest you to do. Okay, that's it. And next is the equation for interest cover. All right, and the equation for interest cover will be this PBIT. Like operating profit is same as PBIT, so it will be PBIT divided by finance cost or our interest. All right, so it is used to check the capacity of the company to pay their interest. Okay, if we like it means that if the company has like less interest cover ratio, then the company is considered to be like less interest cover ratio, then they are like considered to be more risky. Because the reason is that if a company have more amount of finance cost, and finance cost is a like liability itself, less profit will be available to shareholders and for the further investment of the company. So that's why if the company having less interest cover, then it is considered as risky. And next is dividend cover. It is used to like evaluate the capacity of the company to pay the dividend to shareholders. All right, so like it will be the net profit divided by dividend. Okay, it is also same as finance cost but not as risky, because we can like still hold our dividend, but we still like would be like required to pay finance cost. All right, so dividend cover is also an like measure to like analyze the risk associated with the company, but the like dividend cover will be like more concerned by the shareholders actually. Okay, and interest cover will be more concerned by the banks and other financial institutions who provide funds to the company. All right, so different users will be using different ratios to evaluate the performance of a company. All right, and if in the like exam also, like you should see what perspective does the examiner wants you to answer. All right, so the relevant ratio should be calculated and should be interpreted based on that. Okay, if the risk of the company is asked, and if both fixed cost and the debt is given, like you should like evaluate the company's performance on the basis of both operating gearing and financial gearing also. Okay, and this 20 mark in section C is so important and so easy marks also. Okay, so like as we know that out of 20, the 5 mark is for calculation. For the rest 15 mark, you can like like you can get at least 10 mark for sure if you like read the question thoroughly and just give the like basic point or something. Also still we can get the 10 mark, but try to connect it to the scenario so that you can get like more than 10 mark also. Okay, all right, but don't write like blunders on the exam also, because it's not like college. As you know, the like examiners will be also looking at the also looking at have you read the question, like have you understand the situation. All right, so don't write the basic point also. All right, but basic point will have will also contribute to the mark also, but the maximum mark on mark on basic point will be, I think, 3 to 4 only. Okay, so the rest will be on the like scenario based connections and other things. Okay, but if the scenario is like very little connected to the question provided, like then you can write the general point. All right, so first you should read the question and you should look into the question that if there is any like valid point given in the question to answer the given the scenario to answer the question. And after looking at the question, you are not getting so much valid points or something, then you can write the general point. But only after writing the relevant points in the question, like in the scenario, like you should write like this general things. Okay, because examiners always look at have you read the question, have you understand the question, or all right, like that. And next we will be looking at the certain measures that the company uses to evaluate the company. All right, so the first one will be the balance scorecard. Okay, so the balance scorecard is also used to like assess the performance of the company by the company itself. So here we are looking at the 4 perspective. Okay, here we will be like evaluating 4 perspective, and we will be looking that how the company is performing from this 4 perspective. So the first perspective will be the customer perspective. Okay, it means that how the customer is looking at the company. Like, is the customer satisfied? Is the customer is willing to buy more product? Is the customer have any concerns? Okay, like is our like company providing good services to customers? So it's basically from the customer's perspective how the company is. All right, and the next will be internal business process, how the internal management of the company is performing. So it's basically just like financial and sustainability perspective. Okay, like does the company have profit? Like, are they paying taxes? Are they paying interest? Like, is there any issues associated with the company? Like, is there any long-term issues or something? So it's basically means on like financial, like, and also some of the non-financial objective, since like it also include customer objective. Okay, customer is not always concerned about the profit of the company. Then one service, and like if the company is ethical, like that what the customer want. So it is more, so that's what is based with the internal business process. And the next is with innovation and learning. Does the company is introducing like new product, new ideas, like the like thing that like the things that can increase the customer value, the shareholder value. Okay, so it means how to improve and create future values, like how the company is planning for the future. Like that is also an important performance like measurement tool for the company. Like if the company is not planning for the future, like then it will be like shut down in few years. Okay, like every every company should be have a futuristic mindset like on business. All right, so the company should anticipate the future that is gonna come. I need to make measures based on that. I need to like introduce products based on that, right? So that's what the next perspective is. And next is just purely on financial perspective, how the business is creating value to shareholders, purely financial. All right, this is purely based on financial perspective. But in internal business process, like we will be looking at both financial and also the customer objective. All right, so that's the difference between financial and internal business process perspective. Also the internal like management of the company is also considered in internal business perspective. All right, so in exam also the company like in question it will be asked that evaluate the company on the basis of like for perspective or on the basis of balance scorecard. So in that case you should have to like the first thing like you should do is write 4 headings. Okay, so the first will be customer perspective, next will be internal business process perspective, next is innovation and learning perspective, next is financial perspective, and you should then develop the point based on that. Okay, and like after reading these 4 headings you will be reading the question, and in the question the first one you will be getting is the like financial point of the company. Okay, so like then you should like go into the like heading under the financial, and you should like note that point like that only you should answer the question. like don't try to answer the question after reading the whole paragraph. Okay, first you should look at the requirement, because like as you know, like as you all know that the time is also limited. So first you should read the question, like the requirement. Okay, so whether it is like balance scorecard or whether it is Fitzgerald and like moon model or something, and like based on that you should write the heading, and after that you should start reading the question, and at each point whether you are getting any point which can be connected to the question, like should be right like at that time itself. Okay, so don't try to like read the whole question and like then answer the questions. All right, or like otherwise like try to notes in a like try to note in a simple point also. Okay, like try to point out the important like point like while you're reading in a like paper or something, and further you can like develop that point. Okay, but don't try to answer the question after reading the whole question, because you may like forget some important points or something. All right, so you should note that. Okay, so it's a part of time savings. So next we are moving on to the benefit of balance scorecard. All right, so the first benefit of balance scorecard will be it focus on factors including on financial factors, like obviously the customer perspective, the innovation and the internal business perspective, and so like which will enable a company to succeed in long term, obviously. Okay, so it's based on a like sustainability factor, that's it. And it also provide external as well as internal information. Okay, so like internal like information will be more of this financial innovation and internal business perspective, and the external perspective will be the customer perspective. Okay, so it's given like image on the company on like both external and internal perspective. All right, but obviously there will be challenges too like faced by all of the methods used. So the first challenge is measurement of certain performance can be difficult, obviously. Like this is mainly associated with the innovation and learning actually, because the reason is that sometimes the company don't know what's going to happen in the future, because the future is uncertain. So the company cannot make a like very accurate like plan on the like future in sometimes. All right, so because the future is uncertain, so the company cannot always provide an accurate like perspective on their innovations. Okay, like but this like financial and customer can be made to some extent. All right, because it's present, but this innovation and learning is like mainly based on the future, and since the future is uncertain, sometimes the company cannot provide a measurement for like measuring the performance of the company on this innovation perspective. That's it. And the next is obtaining information. Sometimes getting information can also be difficult, like the customer perspective may require this like surveys or something to be conducted, and also the like the customers can be of like different like race, different country, and different like even like different genders too. So the obtaining of information is also sometimes challenging. Okay, and for that we should consider the cost benefit analysis also, like in order to like think like whether to move on with this or something. That's it. And next is information overload. Okay, sometimes we'll be getting too much information. Okay, like on customer also, the customer will be having like multiple like perspective about the company, so the company cannot always like reach a point like or a decision whether the company is performing well or not. So that is also a challenge to the company, like the information overload. All right, like different persons will have different perspective about the company, so that's also a difficult thing for a company to determine on whether they are performing well or not. Okay, so that's also a challenging part. And the next is conflict between measures. So if a company is focusing on finance, then they would need to limit the innovation, right? Because in order to plan for the innovation, the company would have an investment on R&D. All right, the company would always have an investment on R&D. So if the company was performing well in innovation, then their finance perspective would be worse, because the company will be investing for this R&D and all. All right, and you can also think in opposite. If the company is focused on increasing the financial perspective, then the innovation can go lower, or the like even the customer perspective can go worse, because the company will like always be focusing on profit, so they may use cheap qualities of material at a higher price. Okay, so like that's also like worsen the customer perspective. So there can be conflict between measures also. Okay, so the company needs to make a like moderate stand on each of the perspective and to maintain that accordingly. But like that's not an like easy task to do for a MNC. All right. So these are the problems associated with the balance scorecard. All right, hope you got that clear, right? So that's all with balance scorecard. All right, so this like the in balance scorecard, the important point is to know about this customer perspective, internal business, innovation, and financial perspective. And the main thing with this is to the application. All right, so these are mainly tested in this sections is only. All right, in like section 8 can be texted as like they will given these 4 options. Okay, so like one will be customer, then will be internal, then innovation, and then like instead of like finance it will be some supplier perspective or something. So like that's also an easy mark, and will be lucky like if in section A if such questions are asked. All right, but it's made but the main application of this type comes in the section Z only. So you will be required to practice more of the section Z questions to get like aligned with those point and like learning how to frame the question. All right, so that's what's with balance scorecard. And our next performance measurement tool will be the Fitzgerald and Moon building block model. All right, so in this model there are 3 building block on which the performance is measured. All right, so the first building block will be the dimension. All right, and the like dimension is based on 6 result. All right, it is mainly based on 6 result, and out of 2 results are downstream results, and the 4 is upstream determinants. Okay, so first let's look at the upstream determinants. So first will be the quality of service. Okay, like it will be like evaluating the quality of service the company providing to customers. And next is the flexibility, how far the company can adapt to the changing situations. So that's what flexibility means, how the company can adapt to the changing situation. Like if a pandemic occur, or if the corona came, like then the like schools were converted to online classes. So that's the flexibility that a company can also, the company will be also required to make such flexibilities. So when a like flood occurs, like how the like production is going to perform, like how the product is going to sell. So that's the like next determinant. And next is resource utilization. All right, how the company manage their resources, how the company exploit their resources. Okay, so like are they efficient in using the resource and all. And next will be innovation. So like as we have seen in the previous one, how the company is planning for the future. So based on the 4 things, if the company is performing good at these four things, then the company's competitive performance and financial performance will be good, right? So these 4 things are considered as the determinants. Okay, so these 4 things are going to determine the competitive performance and financial performance of the company. That's why these 4 points are known as the downstream upstream determinants. And as a result of this competitive performance and financial performance of the company can be achieved. All right, so that is with the dimension. Okay, collectively like these 6 are considered as the dimensions of the company, but still it is subdivided into upstream determinants and downstream results. Okay, so when we achieve our upstream determinants, then we can achieve our like downstream results also. All right, that's it. And next will be the standards. Okay, those are the targets set for achieving the determinants. All right, so in order to achieve the competitive and financial performance, the company may have to set some standards at different levels. All right, so standards are the targets set for matrices or the measures that are chosen for evaluate whether those like determinants are achieved. Okay, so the standards like set will be achievable, fair, and employee should take ownership. Okay, so why by evaluating the dimension, the company will be like getting conclusions on where they need to improve, what they need to do, and based on that the company will be setting certain standards or like obviously certain budget. Okay, so by setting the budget, the company should look into these matters. All right, so the budget set will be achievable by the employees, and it should be fair, and also the like the employees should take the ownership. All right, so if the if the tasks are too challenging, like there are chances that the there are chances that the employee may not take ownership on the budget, right? So like that shouldn't occur also. All right, so the task that should be given should be challenging but still achievable. All right, so the 3 points should be noted that it should be achievable, fair, and employee should take ownership. And These standards should be aligned with the rewards also. All right. Each employees will be given a share like this, like incentive plans and all. Okay. So whether like if in a company whether they achieve something, these rewards will be given, and that reward should motivate the employees to work towards the standards. All right. So the the measures for the reward should be the motivation to achieve those standards, and also the reward should be clear, motivating, and it should be controllable by each of them. All right. So the reward system, all right, the reward system should be aligned with the activities which is controllable by each of the employees. All right, those activities should be controllable by the each of the employees. If they are not controllable, they can't achieve that, or they will be not having any access to perform those tasks. All right. So these are the things that should be taken care when setting a reward system. All right. So this is with the Fitzgerald and Moon model. So the first thing is the dimension. Okay. So the dimension is broken down into this upstream determinants and also the downstream results. Upstream determinants are determining the downstream results such as competitive performance and financial performance, and in order to achieve those dimensions we will be setting some standards, and the standards should be fair, achievable, and the employees should be willing to take ownership on them. And for the standards we will be giving rewards, and the reward should be motivating for the employees to achieve that, and the rewards should be clear, motivating, and the measure should be controllable by each of them. All right. So this is with the Fitzgerald and Moon model, right? And next we'll be looking at the divisional performance measurement and transfer pricing. Okay. So it is based on the intercompany divisions. All right. It is based on intercompany division. So within the company there will be different divisions, and the performance of the company will sometimes be evaluated based on their relative divisional performances. Okay. So in that case, mainly there are 4 type of divisions. Okay, the first one is cost center, then it's revenue center, then profit center, and investment center. So the cost center will be incurring only cost, but there is no revenue generated. Okay, so the example will be the production department. Okay, so in the production department, the sales are not occurring, only the production. Okay, so that's the cost center, and the revenue can be the sales department. Okay, only revenue generated there. So sales department can be considered as the revenue center, and for a branch can be considered as a profit center actually. Okay, or the manager of a division. All right, a manager of a division will be having access to both sales and the sales and the production of item that are sold in those division. All right, and the investment center will be having access to cost, revenue, profit, and also the assets that will help you generate the profit and all. All right, so it can be considered as a separate branch or something. All right. So a branch manager can be considered as responsible for the investment center, because he will be having the responsibility for the sales, the cost, the profit, and also the facilities or the infrastructure that is provided within the branch to get that returns, right? So these are the 4 type of centers. So the first is cost center, revenue center, profit center, and also the investment center. Okay, and the next is equation for ROI. It means the return on investment. All right, so it is same as the ROCE as we have seen, but it is for separate divisions only. All right. So the equation for ROI will be the controllable profit divided by capital employed into 100. Okay. So in order to assess the performance of each management, their ROI will be calculated, and the ROI will be calculated based on the controllable profit made by each of the managers divided by the asset which has the asset which are provided to them into 100. Okay. So the advantage is that it is widely used and accepted since it aligns with the ROI measure. So the equation is same actually. It's profit divided by capital employed into 100. And the next is, it is a relative measure, so it enables the comparison between division with different sizes. Okay, ROC can even be used with the companies of different sizes. Okay, so in a company maybe the production department the production department will be big and the sales department will be small, or there may be 2 production department, P1 and P2. All right, the P1 can be small and P2 can be big, but still we can compare between them, because what's the reason? We are using a relative measure or the percentage measure. So even regardless of the size of the different division, we can compare it using ROI. All right, and it can be broken down into profit margin and asset turnover for detailed analysis also. All right. As we know that the equation for ROI is controllable profit divided by capital employed, and the equation for like profit margin is what? Profit margin will be profit divided by revenue, and like what's the equation for asset turnover? It will be revenue divided by capital employed. Okay. So we can split this return on investment into both profit margin and also the asset turnover. All right. And the disadvantage is that it may leads to dysfunctional decision making, because the reason is that even if a production department is performing well comparing to the other production department, like the reason could be the type of product they are selling. All right. So comparing to the external market, the best performing division can perform even more comparing to the similar product like that is selling in the market. Okay. So the other product will be the the other product will be the less demanded item in the market. All right. So it will be difficult to sell that. Okay. But still, when comparing, the first product appears to be more profitable, but still it may not be, right, comparing to the external market. And the next is ROI increase with the age of assets, that depreciation occurs, so managers may refuse to buy new asset. Okay, so as you know that the equation is what? Profit divided by capital employed, and the equation for capital employed is non-current asset plus current liabilities. All right, so if the value of the non-current asset decreases, then our return on investment will increase. All right, and the value of non-current asset will eventually decreases by considering the depreciation of each assets. All right, so if a manager buys new non-current asset, what's going to happen? The value of non-current asset will increase. Okay, so that will reduce the return on investment. So for that reason, some manager may not buy the new assets. Okay, so some asset may be obsolete and should be replaced, but still the managers may not replace because they may affect the ROI of the company. Okay, and their rewards and incentives may be based on those ROI. Okay, so that's a challenge also for companies. And next is may lead to manipulation of profit and asset figure. Or the manager can either overstate revenue and understate cost in order to get the better profit or something. And next will be different accounting policies may limit effective comparison. Okay, so that's also a reason. The division the different division divisions may be using different methods of depreciation and all. So if the depreciation method is changed, we have two methods, right? It's straight line and reducing balance. So based on the difference method used, there can be difference in the capital employed calculation, so the ROI can be different based on that also. So these are the challenges faced when comparing the performance of two divisions. All right, and so since we have certain limitations in calculating the ROI, the performance management have come with a new equation called residual income for the ROI. Okay, so since return on investment was a relative figure, the residual income will be a absolute figure. All right, it doesn't give a percentage, it gives an actual value, and the equation will be the controllable profit minus notional interest on capital. All right, so it is mainly based on the cost of capital on the asset. So the advantage is that it encourages investment center managers to make new investment if they add RI, because since RI is an absolute measure, if a new investment is made and if it makes profit, then the RI will be increased obviously. And the next is making specific charge for interest help to make new investment center managers more aware of the cost of asset. Okay, so for each division they will be having different notional interest. Okay, so if the company makes new interest and if it reduces the risk of the company, then also it will be beneficial for managers to take on. All right, and the next is risk can be incorporated into interest rate used. All right, so if the risk is increased, then the interest rate will also increase. All right, so the manager will be also keen to reduce the risk associated and to increase the residual income that we are getting from that. All right, so these are the advantages of using RI on the performance as a performance measurement tool. And the disadvantage is that it does not facilitate the comparison between two divisions of different sizes. Obviously, this was considered as an advantage of ROCE. All right, for ROCE, the different sizes can be compared, but for RI it cannot be, because ROC was an absolute measure and the ROC was a relative measure and RI was an absolute measure. Okay, so we cannot compare division with different sizes based on residual income. And the next is it can lead to manipulations also, since the same profit and like capital employed will be used for assessment of performance. It can also lead to manipulation. All right. And the other measures to evaluate this like divisional performance will be the variance analysis. All right. So like division 1 and division 2 will be given a like budget, right? So the budget will be given to both division D1 and D2. And if D1 have more adverse variance than D2, it means that D1 is not performing well and D2 is performing well. All right. And next is ratio analysis. Like obviously, as we have like studied earlier, the like profitability, like the division specific profitability analysis, risk and all. And next is staff turnover. It is also a thing to like, evaluate to get the performance of the internal performance of the company. Like if the staff is getting changed, like then it means that the internal manager of the company is worse. And next is the market share. All right. The like if division like 1 is producing in like one market and like division 2 is performing in a different market, their market share can also be used to evaluate their performance. All right. Or even if they are like performing in the same market also, their market share can be used to evaluate their relative performance. Right. So these are the things that we'll be using to get the divisional performance of a company. All right. And like and these are all subjective actually. Okay. So different like different company will be taking like different information as the different measures and something. So it's subjective actually. And next we will be looking at transfer pricing. All right. So transfer pricing can be said with an example actually. All right. So let's take an example of, so it's my obvious example. Let's make an example of this Tata company. Okay. So as you know that Tata company have two like subsidiaries, right? One will be Tata Cars and other is Tata Steel. All right. So Tata is a parent company and Tata company have got two companies called Tata Steels and Tata Cars. Okay. So as you know that car is made of steel. All right. So like one of the major component is like in making car will be the steel only. Okay. So since Tata Steel is the like subsidiary of Tata company and also the Tata car is also a subsidiary, Tata cars can get Tata Steels for free, right? Because it's the same company. So if Tata cars get Tata Steels for free, then like it will be like it's good for cars actually, right? So think that if Tata cars are getting steels for free from Tata Steels, Tata cars will be getting revenue from the sale of cars. All right. And for that sales, the cost of steel will be zero. All right. The steel cost will be zero because like they are like taking from Tata Steels. And like think about the situation of Tata Steels. Tata Steels are not getting any revenue on those sales. The steel like the revenue on those like steel will be zero, but still they will be incurring a cost. All right. So for Tata Steel, like they are freely giving their steels to Tata cars like without getting any revenue. Okay. And they are incurring a cost. So when the year ends, the performance of both companies will be evaluated, right? So obviously the performance of the Tata cars will be more and the performance of Tata Steels will be less due to this. So in order to eliminate that, we had introduced a thing called transfer pricing or the performance measurement, like performance management, and introduced a thing called transfer pricing. So transfer pricing is price at which goods and services are transferred from one division to another division within same organization. Okay, so a company having a similar subsidiary. Okay, like if they are transferring like resources with each other, a price should be set. Okay, but like that price is set to like evaluate the divisional performance of the company. Okay, like even if the steel is given as like free for like Tata cars, like the performance of the Tata as a whole is not affected. All right, the performance of this like the performance of the Tata will still be the same. All right, the performance of the like Tata is not affected on this transfer, but the performance of steel and cars are affected only. So transfer price is the price at which goods and services are transferred from one division to another within the same organization. All right. And the objectives of transfer pricing is to ensure the goal congruence. All right. So like if there is a competition occurring between the divisions also, then they will be more reluctant to make like charge the like best price to the like division and all. All right. and it also ensures the performance measurement. All right, so like the performance of the each division can be accurately measured by using this transfer pricing. And the next is autonomy. Okay, each of the subsidiaries will be have sufficient autonomy required for them. So like in this case, steel will be having an like independent opportunity to set their own price on steels, and cars will be car will be required to pay an amount to steel for the steel they are buying from them. And next is recording the movement of goods and services. All right, if there is no price set or something, the car division will simply come and take steels from the Tata steels. But instead of that, if you if you charge a price on that, like there will be a like records on how many steels have been gone from this Tata steels to Tata cars for production. Okay, so these are the objectives that can be achieved by using transfer pricing. Okay, by using transfer pricing, like this can be achieved. Okay, so next is how we can set the transfer price. All right, how a company can set a transfer price. So in order to set the transfer price, company can use different approaches. All right, and the first approach is the market based approach. All right, since steel is something which only the like the Tata Steels is not going to sell. Like we have like another steel companies such as, let's say, like we have like which are another other steel companies. Okay, let's say TMT or something. Okay, so TMT or like TMT is also the other steel company. So car can either buy steels from Tata Steels or this TMT company. Okay, so like obviously like cars will be like Tata cars will be buying it from steel. So steel needs to determine a price to charge. Okay, so the first approach will be the market based approach. If there is an external market for the goods, then the transfer price would be that price. Okay, so like TMT is like selling the like steel for, let's say, $20 per ton. Okay, it means that an external market exists for the steel. Then steel will also be charging the same amount of $20 for each ton of steel, each ton of steel that is given to Tata cars. So like that's what market based approach means. And next is cost based approach. Okay, cost based approach means here we are not considering any market price or something. Here we'll be looking at the cost plus profit only. Okay, so here the company will be looking at the like cost of the steel, like, and also will be adding a profit to them. All right, like the cost to make plus our required profit. Okay, and as we looked earlier, like we have like different cost to be like considered for this. So the first cost will be the full cost. It would include both variable cost and fixed cost. All right, and next would be the marginal cost. It would be variable cost only, and next would be opportunity cost. Okay, so like the opportunity cost include the best alternative for gone like as a result of this transfer. All right, so these are the three costs that can be considered while setting a price based on cost based approach. It means cost plus a percentage profit. All right, and in order to find an optimum transfer price, the equation would be marginal cost of selling division plus opportunity cost of selling division. All right, it means that the cost that the steel company is incurring, the variable cost that the steel company is incurring for the production of each ton of steel, and the contribution they are losing as a result of selling steels to the cars. Okay, like Tata Steels can either sell those like steel into other company or Tata cars. So the contribution they are losing as a result of selling to the like Tata cars is considered as the opportunity cost of the selling division. All right, and also if there is a perfect market for an intermediate product. All right, like it means that like the the product we are like transferring had got a perfect market, then the optimum price will be market price plus or minus any small savings on extra cost. Okay, so let's consider the packaging cost. Okay, so if the steel is sold externally, they are need to be packed at a cost of, let's say, $2 per unit. Okay, like, but if they are selling to cars, okay, if Tata Steel is selling to cars, then the packaging cost would be zero. So this is a cost saving. So in that case, the optimum price will be market price like minus this $2. All right, and so the second case is if the selling division has a spare capacity. It means that if Tata Steel have got a spare capacity, then the optimum transfer price will only be the variable cost. All right, because since they have a spare capacity, they are not losing any opportunity cost. Okay, so they are not losing any opportunity cost if they are having a spare capacity. So if the company have a spare or the division have a spare capacity, then the optimum transfer price will be the marginal cost of the selling division. Okay. Also, if the division is working at full capacity, then we are losing a contribution that we are supposed to get by the selling of the product outside. So in that case, the optimal transfer price will be the variable cost plus opportunity cost or the lost contribution. All right. So this is the optimum transfer price that is set at different situation. If the market is perfect, its market price plus or minus any savings. And if the if the division have a spare capacity, then it is only the variable cost. And if they have a full capacity, then the equation will be variable cost plus opportunity cost. All right. And the minimum transfer price will also be the same. It's the marginal cost, that is variable cost plus any lost contribution, that is opportunity cost. This is considered as the minimum optimum transfer price, like that should be get for a company for the best price calculation. All right. And so the next is the maximum transfer price. Okay, so the maximum transfer price can be considered as the lower of external purchase price or net marginal revenue of selling of final product. All right. So the first one will be the external price. Okay, and the next one will be the net marginal revenue of selling the final product. And the equation for that would be final sales price minus additional variable cost. All right. So instead of selling internally, if they are selling externally, if there is any extra cost. So let's say the packaging cost only. Okay. So here the packaging cost can be taken as an example. Okay. So if the packaging cost is saving, if we are transferring internally, then the so then the equation of then the equation for net marginal revenue will be final sales price minus additional variable cost. So that will be $2 per unit. All right. So the lower of this will be considered as the maximum transfer price that should be set. Okay. So the maximum transfer price would be basically the market price, and the minimum would be the variable cost, and also adding the any lost contribution, that is the opportunity cost associated with the transfer of internal items. All right. So now we are done with the divisional performance. All right. So now we are looking into the performance measurement for not-for-profit organization. All right. So it is easier to calculate or evaluate the performance of a profit organization, because the main aim of profit organization, at the end of the day, the aim of a profit organization would be the profit. All right, nothing else. But for not-for-profit organization or public sector, such as these government sectors, their aim will not be always be the profit. There can be different aims for them. So for not-for-profit organization, you would be required to make different measures to evaluate their performance. All right. For profit organization, end of the day, so the evaluation will be the profit. If profit is more, the company is good. If the profit is less, the company is bad. That's it. But for not-for-profit organization, it's not the same. Okay. So the aim of not-for-profit organization sector will not always be to maximize profit. They have non-quantifiable objective, which is subjective to non-profit organization working at each type of sectors. Okay. So different sectors will have different aims as their performance measure. All right. So this will result in difficulties to assess the performance of a non-for-profit organization. Okay, since they may have multiple objectives to be met. So these are the problem or the character of a non-for-profit organization. So the problem of this multiple objective is that most key objectives are very difficult to quantify, especially in financial terms. Okay, so some measures will be difficult to
evaluate,
because we need a value to evaluate something, right? But in not-for-profit organization, in all cases we may not have such values to evaluate. All right, because their aims will be different. Let's say for a government hospital, for a government hospital, their aim will be to treat the patient, right? Treat the patient at minimum cost, right? Or treat the patient effectively. So in all cases, we cannot get a value on whether the treatment of that patient was effective. So that's the challenge which is faced by the multiple objective of a non-profit organization. And the next will be multiple and conflicting objectives may arise. So that's also a reason. So if a company have two objectives, those two objectives may be conflicting. Okay. So So the one objective will be the cost saving. Okay. And other objective will be providing free medicine. Okay. So let's take an example of hospital. So the one objective will be the cost saving, and like next will be providing free medicine. As you know that these two are mutually exclusive, right? Both are like not possible together. So these are the reasons while with having multiple objective for the company. All right. So the evaluation tool that we used for the not-for-profit organization is the value for money. Okay. So the basic thing like that will be used for this is the value for money objective. So in value for money, we will be looking at the 3 E's. Okay. So the first E will be economy. All right. So the economy considered as an input or input measure. So it's the resource available at cheapest with required quality. So it basically based on so it is like mainly like based on monetary value. All right. So economy will be based on how much cost we can save by buying item. So that's what economy means. And it's an input measure. And the next will be efficiency. Efficiency is the input which is linked to the output. All right. So it's like basically like how much input are transferred to output. How much inputs are converted into output. If more number of inputs are converted into like output with less wastage, like then the company is like then we can say that company is performing well. Okay. Output achieved from the input made. So like that, this second E in the value of value for money, and the next will be the effectiveness. It is the output compared with the objective in which they are required to meet. All right. So it is mainly based on the objective. Since non-for-profit organization have objective which is not profit, each will be having different types of objectives, right? Each will be having different objectives. So effectiveness is the comparison of the output achieved with the objective that we had. Okay. So let's say for a hospital. For a hospital, their like aim will be to treat the maximum patients effectively. So that's their objective, and their like output was like the doctor providing treatment. Okay. So let's say like the doctor has provided maximum treatment for their patient. So in order to get that, if the treatment provided by the doctor was effective, we will be looking at the patients who had like recovered from their illness. So that's what the effectiveness means. Okay. Effectiveness means comparing output with the objectives of the company. All right. So these are the 3 E's that is considered in the value of money objective. All right. So this is all with the non-for-profit organization. So it's a like small part actually. Like here the main thing to consider is that this value for money. Some question can be asked, like a scenario can be given and they'll be asking like whether the economy, efficiency or effectiveness is asked here. That can happen. And also in section C also like there may be some like subdivision question. Okay, like evaluate the scenario like based on 3 E's or something. And a non-for-profit organization will be given. Okay, so in both case, the like theory that I should know is the what is economy, efficiency, effectiveness. Okay. So like economy is based on input only, and efficiency is based on input and output, and effectiveness is based on output and the objective. All right, that's it. So the next we'll be looking at this data information. So so these are just the like definitions actually. All right. So first, let's look at the definition of data. So data are fact or figures in a raw unprocessed format. All right. So this is just a definition. And information. Information is something made from processing data for decision making. So like after processing data, we'll be getting information or the or the useful information, and from that information we can make some decisions. All right. So like that. So data is something that will be in a unprocessed format, and information is something like which is like made from data to make decisions. All right. And these are the characteristics of a good information. Okay. So a good information should always be, so like in order to consider like an information as good, it should be accurate, it should be complete, it should be cost effective, understandable, relevant, accessible, timely, easy to use. Okay. So like it can be like studied as the like first letter of those things. It's accurate itself, right? Accurate, complete, cost effective, understandable, relevant, accessible, timely, easy to use. Okay. So try to study with this like first letters of the like good information as accurate. That's it. And next is the definition of information technology. All right. So information technology describes any equipment concerned with the capture, storage, transmission, and presentation of information. So something which is used to capture, store, transmit, or the presentation can be considered as an information technology. All right. So that's the definition for information technology or the IT. And the next is information system. So in information system is the provision and like management of information to support the running of the organization. So like what all factors are supporting the running of the organization? Those like provisions and those management of information, like who are managing those information, like those are considered as information systems. And the next is cost benefit analysis. So cost benefit analysis like that we use to like evaluate like whether like something should be like done or not. All right. So it can be used to assess the expected cost and benefit of the information system. And if the information system is like in order to evaluate that the like information system is effective, so we will be looking at the cost and benefit. All right. So by looking at the cost and benefit, and if cost is more and benefit is less, then we will not be undertaking that measure because the cost is more like and the benefit we are getting is less. But in cost benefit analysis, if benefit is more, all right, if benefit is more and cost is less, that's where we'll be using the like we'll be taking that measure. So in order to make the like decision on whether to move on with that, we'll be using cost benefit analysis. So the next is the cloud computing. So the cloud computing is the like the delivery of different services through the internet, allowing data to be stored, managed, and processed using remote servers. So that's the definition of cloud computing. And next is transaction processing system. So these are the different things that is used by the companies. So the transaction processing system is it records historic information and represents in a simple automation of manual system. All right. So the historic informations are like stored and like it is like represented into like simply automated manual system for the company to assess. And next is management information system. It covers data into useful information. All right, and which is then communicated to manager at all levels and across all function to enable them to make timely decision for planning, directing, and controlling activities. So if a manager want to make a decision on something, they will be looking at this management information system. From the management information system, they will be getting those internal and external information like that is required for the decision making. And next is executive information system. It provides strategic managers. Okay, like that is the top level management with the flexible access to internal information from the entire business and also the external environment. So for strategic decision and all, the managers will be using executive information system. Okay, because it's contain information on the entire business like and also some of the external environment informations also. And the next is ERPS. It is that free flow of data within the company. It's just free flow of data within the company. Okay, free flow of data within the company. So each company will be having its own separate database. All right, and the like data will be available to like all employees working in that organization. Okay, so the making use of that is made using enterprise resource planning system. So it integrate the data from all operation within the organization. All right, and it ensures free flow of data and information. Free flow of data. It ensures free flow of data and information, right? So that's what enterprise resource planning system is associated with. And next is big data. So big data is just the large volume of data beyond the normal processing and storage, like in order to analyze the capacity of typical database applications. So these are just like definitions actually. So the asking of big data in exam would be like this 2 marks question only. Okay. So in big data, like it can be like asked as 2 marks, and the question would be like asking these 5 V's. All right. So the 5 like V's of like big data are its velocity, volume, variety, veracity, and value. Okay. So in the exam question, like out of the 4, 1 will not be there. So like for that some other like word will be given and you will be required to like pick that wrong answer or something. And the like other is that providing the advantages and disadvantages of big data. All right. So the like advantages of like big data would be like it provide like timely information, a huge data can be processed and all. And the disadvantage would be the storage. The main disadvantage of big data would be the storage associated and the information overload. These are the two main disadvantages that should be considered on big data. And exam also that can like this can be asked. All right. So this is with the PM actually. We had completed our syllabus. So I hope you got a like quick revision on what we had covered actually. So the next thing I want to say is that the about the exams. Okay. So so next we can discuss about the exam thing, right? So in exam, as you know that we have a 100 marks exam and the time we have is 3 hours. So 3 hours into 60 would be, we will be having 180 minutes. All right. So the time that we have for per mark. So the time we'll be having for each mark would be 1.8 minute. Okay. So the basic thing to keep in mind is that while attending each answer, like this minute should be on your mind. All right. So it is mainly advisable to start with section A actually. Like section A and section B can be completed at this time. Okay, completed at like 1.8 for each time, right? So we can complete that. And for section C, so for section C, that like the thing to consider is that you'll be having two questions, right? So while reading the question also you should be more careful. Okay, so like as I said earlier, try to input the answer while reading the question, not after reading the question. So that will help you to save time on framing the answer. All right, or try to note some point on each of the sentence that you have reading from the scenario. And the first thing to like read on like section C would be the requirement. All right, the requirement should be the first thing to read on looking at the section C, not the scenario. The scenario should be like read after that. First you should see read like all the requirement of the question. So then you will know that how you should read the like read the scenario or what is like what are things that is asked. So like that you should start the exam. Already you should write the exam so that you can make a effective time control. And always think that losing 2 marks won't make you lose the exam. All right. So if in section A and B where you got stuck, all right. So whether you got like stuck in some like section A or B question, try to flag it off. Right. Try to flag off the question and come back after completing all the other questions. Okay. So the main thing in performance measurement paper is that the reading of the question. All right. Because like as you know that the topic is like the concept is very less in PM actually, but the main challenge where lies is the time management and also the way the question is asked. Because in performance measurement, as you know that, so there is not a perfect structure, so they can ask in any ways. So the main time killing thing is the time, like the time like that you need to like read and understand the question. So like in some situation like you may be required to need like one question once or twice to get the point that they are asking. So that's what the main thing you like you may find challenging. And for like some question it will be more, so try to flag off such question and try to come back after that. So that's all I want to say about this PM session, and all the best for all PM students attending the exam. Thank you.
Hello guys, I'm back with FM. So we have finished more than half the portions already. We just have a little bit of foreign exchange remaining. This is, I'm telling you, it's a for sure section B question. We cannot skip out on this, okay? Okay, so let's start then. We finish for purchasing power parity theory, PPPT, right? And here we saw that it is S1 divided by S0. Okay, but now what is S0? Current spot rate. That's fine, no confusion. But S1 is a future spot rate, which according to expectations theory, which we will look into next, it says that expected future spot rate is nothing but the forward rate. Okay, this is what expectation theory says. But then the thing is, guys, like in real life, it is not how it happens. Obviously we cannot predict for the future right now, right? So there could be certain uncertainties, inconsistencies, leading to which forward rate will not be equal to future spot rate. Okay, so then expectations theory is a little delusional at that time. 1 second. Yeah, so then that's all about purchasing power parity theory. For interest rate parity theory, IRPT. So this one explains the relationship between interest rates and exchange rate between two countries. So I'll tell you with this example. Let's say you live in India and you're deciding where to invest your money for 1 year. Now there are two options that you have. One, India is giving you 6% interest rate, but US is giving you 2% interest rate. Where will you invest? Obviously India, because it's giving you more interest, right? But don't you think people in US or any other place would think of the same thing and then come and invest in India? They could do it, right? You're not the only genius around here, so they will also try to get their interest highest by investing in a place where you get high interest rate, right? But that is not fair to other people, because everybody in all the countries will come and invest in your country, and then you know what will happen, right? So here, high interest in one particular country means that interest rate of that particular country is gonna fall. That is what interest rate parity theory says. For example, here, India, everybody is running and coming and putting their money into India. But then, guys, when that happens, India's interest rate is gonna fall. Okay, they are telling there is a relationship between interest and between the interest rate and the interest of the country. Okay, so see here, naturally you'd want to invest in India because you earn more returns and all. But what if someone in US thinks the same thing? People from all over the world start converting their dollars into rupees and invest in India to get that 6% return. Okay, what's the problem? If there is no cash, then everybody would be moving to that country, right? So they'll be getting their high interest and making free profit, etc. Now this is an example of arbitrage. Okay, here what they do is they take the difference in profit. For example, like I said, in India you're getting 6%, in US you're getting 2%. You're making this free money of 4% here. Okay, that is arbitrage, looking at the differences in amounts and then making your profit. That happens a lot in stock market as well. Okay, so this is not sustainable. It is not fair as well for people. Okay, if one country has higher interest rate, its currency is expected to fall in the future. So later, now if India has high interest, its currency value is gonna fall, is what IRPT says. Got it? This is the difference between PPPT and IRPT. Okay, now here again with an example. If country A has higher interest rate, in our example it was India giving us 6%, then country B, this is US, giving us 2%. IRPT says that country A's currency, which is India's currency, will fall in value in the forward market. What is forward market? Just S1, which is nothing but F0, forwards. Okay, right, remember I told you here, forward rate, that one. Okay, now forward rate adjusts so that the total returns in both countries are the same. Forward rate is making this adjustment where even if India is giving you 6%, it will still look like you're earning this 2% return. So they are going to make the interest rate in both the countries same. This is what it means. Okay, right, fine. So this is the formula for interest rate parity theory. This one is forward rate, spot rate. IC is interest in the counter currency, which is the other currency, foreign currency. Interest in base currency is IB. Okay, Expectations theory, like I was telling you guys, this is the part where forward exchange rate is an unbiased predictor of future spot rate, is what expectation theory says. Okay, but then this does not happen. Real world is not fair. Okay, so what happens is it's often inaccurate due to market volatility, sentiments, unpredictable events, etc. There are multiple things which could change this. That's why it is not often very advised to say this. Okay, it works under conditions of perfect market efficiency. We do not live in such a perfect market. We do not live in a fairyland. It exists very rarely. Okay, I just added that word there. Instead, it doesn't exist. I don't think there is a perfect market anywhere. Okay, managing foreign exchange risk. Now we've spoken about IRPT and PPPT, right? We need to manage this foreign exchange risk now. When you are dealing with another country, country A, country B, okay, this is your country, you're dealing with foreign country. Okay, when you're doing this, guys, obviously there'll be certain exchange differences coming between your country and the other country. How will you deal with the losses that you make here? Sometimes you might make profit also. One thing is just do nothing. When you have losses, take the losses. When you have profit, take the profit. That's the second step. That's the second option. Basically, do nothing, accept gains, accept loss. Over time you will just compensate for it. But the first one is deal in home currency. They are like, don't go, if you cannot bother with managing the risk, then don't go outside and trade. Just do it in your own currency, is what they're telling. Okay, this is very risky. Which one? Doing nothing. If the exposure is large, if 90%, 80% of your revenue is coming from the foreign country, and if you're doing nothing about it, you're going to lose a lot of money. Okay, in such a scenario, you have to do something, so probably like hedging, use derivatives, etc. But if it's a very tiny portion of your revenue, portion of your assets, etc., just forget about it. Leading, receiving payments early if foreign currency may depreciate. Now, again, country A and B, right? Now, what we are planning to do is we are gonna sell something in country B. So obviously we'll have to get money for it. We sold it on credit and we have to get money for it, right? If we have to get money for it, we have to get the money in a way where our profits increases, right? We do not want to make loss. Okay, so that's why they are telling, if foreign currency may depreciate, which is country B here, then take the profit right now. If you're expecting for it to depreciate, take the money right now. Okay, it also encourages early payment. No problem, we get the discounts as well. Lagging is just the opposite of it. If foreign currency may depreciate and if you have to pay here, if you have to pay, then you will lag. Okay, you will wait for the foreign currency to fall, and then when it is very little, that's when you send the money, so that you make a little less loss. Okay, so that is lagging, just the opposite of leading. Leading is when you're making when you have to get the payments. Here you are making the payments and you're delaying it for the foreign currency to fall. You're waiting for it to fall. Okay, right. Next is matching receipts and payments. For example, if we need to pay someone in country B and they need to pay someone in country A, then we can just match it. So if receipts are going out, no problem. So if receipts are 100 and payments are also 100, it's going to be perfect matching. But if receipts are 1000, if receipts are 1000 and payments are 900, we'll have to get just we'll have to hedge for just 100. Do you see that? Like that, right? This is just the net exposure we'll need to hedge off. Remember that 100 that I just did. Okay, netting. Offset intercompany balances before payment. So what we are doing is, before making any payment itself, if there's any intercompany balance, we are netting it off, and only the remaining part of the payment we are making it. Okay, so this is usually used in MNCs because MNCs have branches everywhere, all around the world, right? So if they have any branch there, easy, just net it off with them, and then the remaining you can send it. Foreign currency bank account, here they're telling, if you have like really like huge foreign exchange amount, huge exposure to risk, etc., what do? Is you have a bank account in the country that you're trading. Okay, so then you can just pay and then give pay or receive whatever you want to pay. Okay, that's how it works. Matching assets and liabilities similar to matching normal payments, but here you're looking at both assets and liabilities side. That's it. Forward exchange rate. Now we've come to looking at the derivatives, the hedging methods. Foreign exchange rate. So whenever we are doing sums, guys, you need to understand that you will be worst off in that scenario. Bank will always buy low and sell high. Bank wants profit in all the scenarios. You, on the other hand, should always get a loss. Okay, that's how it works in hedging. Nobody is complaining, so we cannot complain either. That's how it works, right? Bank will always trade at a rate that is more favorable to itself. This means that if you're selling foreign currency, the bank buys at a lower rate. Lower rate is called the bid rate. Okay. If you're buying foreign currency, you need to buy from the bank. Okay. Bank is always the intermediary. If you're selling foreign currency, you have to sell it to the bank. Bank will buy it. Bank will buy it at the cheapest rate. Okay. They do not want to spend more because you are the one who needs it. Okay. You will have to adjust. At the same time, if you want to buy foreign currency, bank will sell it at the highest possible rate to make the most profit out of it. Okay, that's how you should understand. Highest rate, ask rate, lowest rate, bid rate. Okay, selling foreign currency, bank will buy it at lowest rate, bid rate. If you're buying foreign currency, bank will sell it at the highest rate, which is the ask rate. Okay, next, forward exchange contract. That is what we'll be learning now. Okay, so what we are doing in forward exchange contract is very simple. You will tell, see, you will tell after 10 days I will come and make 10 million payment to you. Okay, you've already decided the amount, you've already decided the rate. Okay, let's say rupees, that time $1 is 86 rupees. You'll say this already. So in the future, if this rate goes down to being 82, then it's going to be a loss for you. Okay, but if it goes up to be 90 or something, it's going to be a profit for you. But you have fixed your rate. Now you are certain about how much you need to pay. You have a certainty to your company. Okay, so if it's going high or low, you do not care. Got it? That is forward exchange rate contract, and you can be asked to solve questions regarding this. It's just one step procedure. You will have a forward exchange rate given, or you will have to figure it out through PPPT or IRPT according to the given condition. Okay, using that, you will just find what is the forward exchange rate, and you will see that. Okay, it's one step calculation, very simple. Okay, advantage of this is also, remember guys, whenever we're talking about this, you'll have to learn two things. Okay, one is over the counter derivatives and exchange traded derivatives. Okay, over the counter derivatives are like tailor made for you. It's like when you get your materials and then go stitch your dresses. That is OTC derivatives. Exchange traded derivatives is just go to the shop and then get it. Got it? So this is traded on the stock. Okay, this is not traded. Okay, OTC derivatives is done between two parties. Okay, there's a table and the person. Okay, this person is giving you a derivative. He is telling, okay, we'll give you the assurance for it. It's something like forwards. Forward is an example of OTC derivative. Got it? But coming to this one, here what happens is you trade on the stock exchange. Okay, it's similar to selling and buying stocks. What happens is, if you're buying stocks, you can buy it. If you're selling stocks, you can sell it. People are always there to sell or buy, right? Similar to that, here also, if you have a contract or something related to foreign exchange, you can sell it, you can buy it. It's like trading that goes on. Okay, and this is obviously safer because there's a market for it. Here, if the person you're trading with is shady, it's over for you. It's as good as you losing your money. But why do people still opt for this? Because here you can just buy for whatever amount you want. Okay, whatever currency you want. There is no standard contract here. But here, if they tell one derivative is for $100, you have to pay $100. You cannot tell, I'm gonna buy only for $50, give me how much ever is possible. It is not possible. Okay, according to the contract size only you can buy. But here you can tell, I have only 50, I will give 50. Okay, works. Do you see it? And for currency also, only certain currency which is very used in the world, for example, the dollar, the euro, the pounds, the yen, Japanese yen, all these currencies, the major currencies, only that works in exchange traded. So if you want to do it in any other currency, you have to come back to OTC derivatives. Okay, now this forward exchange contract that we just learned is an example of OTC derivative. Got it? Okay. Eliminates exchange rate risk. Company knows the exact amount to be paid. What are they telling here? They are telling we've already fixed the rate. Okay, so in the future, if it increases or decreases, we do not care. We know how much we're paying, right? We are okay with it. That is eliminating the risk for us. Simple to arrange through banks. So banks always have this forward contract with them available. It's flexible in coverage amount. This is what I was talking about. Any amount you want. You want to buy for 50? Done. That's okay, no problem. Disadvantages, however, is a binding contract. It's just between you and this other person. You have to do it on the agreed rate. But what about exchange traded contracts? This can be done, traded anytime. You have a settlement date. Okay, I'm not going to say no. You have a settlement date. But you can just go sell and buy before that. Nobody is going to care. It's not going to make a big difference for it. Okay. No benefit from favorable rate movements. Yeah, because we have an amount fixed there. If you have an amount fixed there, there's not going to be any benefit because you fixed an amount. Okay, if the economy goes favorable, don't care, don't know. If it goes bad for you, bad for the economy, don't care, don't know. Okay, right. Next, timing mismatch issues. If the payment is delayed, a new contract must be needed. Now this is not a very relevant point for you, so we can like skip it. Okay, that's not needed. Okay. Money market hedge. Now this is something that you can expect. It can come for section A, B or C, any one of these. Okay, a C, just a small part of it maybe, but A and B for sure. Okay, right. So money market hedge is a method of hedging using borrowing and lending in money market to lock in the home currency value and future currency. Now this is done in a 3 steps process. Okay, first what you do is you divide foreign payment by 1 plus foreign deposit rate. Now here how they'll play with you is they will tell you the foreign deposit rate is 2%. This is always gonna be per annum. What you need to do is, let's say divide foreign payment, I'm gonna tell 10,000. So you should do it like this, 10,000 divided by 1 plus 2% into how many other months this contract is for. Let's say 3 months. I'm just gonna assume 3 by 12. This is how you need to do it. You cannot just write 2%. 2% is for 1 year. Money market is never for 1 year. Okay. It's a short-term thing. So that's why it can minimum be for 3 months or 6 months. One of these 2 months you will get it. Okay. Right. So what you do is first we are talking about the payment here. Payment and receipts have 2 different processes. So if it is payment, what you do is first you borrow in the home currency. You need to pay. So you borrow in the home currency, you convert it to foreign currency at the given spot rate, which they will give in the exam. Okay. And then after you convert it, that particular foreign currency, you invest it. Okay. So then that deposit amount will become the actual amount that you need, and then you can pay it immediately. So you don't have to worry about the future differences. Right now, whatever it is, you will take the money. Let's say I'm taking 10 rupees. Okay, I'm converting it to dollars. I don't know how much it is, 0. whatever. And then this particular converted amount, I will invest it. Okay, and after I invest it, I will get some returns, obviously, right? So together, all of that investment, I can pay it to whoever I need to pay. These are the process that we're following. So first, I divided this and I got some foreign by 1 plus this thing. And then what I'll do is I'll convert this at the spot rate to get the amount. Okay. And then I will borrow home currency and compute repayment. How will I do that? The same amount which I found in step 2, I'll multiply by 1 plus the borrowing rate. And a rate should be in months. So in this particular scenario, 3 by 12, you'll multiply. Okay. Similarly, if it is hedging a receipt. Okay. So here what we'll do is, again, you'll borrow at foreign currency right now. Okay, you will convert it to home currency, and whatever you have converted, you will invest it back to the home currency. So when someone is repaying you from the foreign exchange, you can get it immediately. You can pay back the money exchange. Similar processes. Okay, it's going to be easy. Here you will do foreign deposit rate, foreign borrowing rate, home currency. You will use the home currency itself. But here deposit rate, here borrowing rate. That's the difference. That's it. Nothing much. Okay, money market, I'm telling you, go through the questions, solve the questions. It's gonna come for sure in an MCQ, guys. So learn how to do it properly. Okay. Currency futures. What is currency futures? Futures is another instrument. First, we learned about forwards. Okay. Forwards is an OTC, by the way, over the counter. Now we are learning futures. Futures is an exchange traded derivative. It is standardized. It has a fixed amount. Only certain currencies can work here. Okay, got it? And it is traded on the exchange. See, it is standardized. Okay. You will get so many questions about the OTC and exchange traded. Just learn it very properly. Okay. So standardized, it's traded on exchange. It has standard contract size, fixed settlement dates. It has, but then you can trade before that. No problem. Okay, how does it work? You enter into a position opposite to the underlying transaction. See, this is important. If you are receiving foreign currency, you sell the futures. If you are paying the foreign currency, you buy the futures. It's the opposite. If you're receiving, you sell. If you're paying, you buy. You are going in an opposite position. This is how it works for futures. Understand that. Okay. If there's any gain or loss, that will be offset. Okay, yeah. Okay, here it doesn't obviously perfectly hedge because it has standard sizes. See, sometimes your contract is not going to be of standard size, but you can still hedge it. But still, for example, let's say I have 10,000. Okay, but my amount is only 9,000. It's not hedging properly. I want only 9,000, but the standard size is 10,000. What am I going to do about the remaining 1,000? Either I can over hedge or under hedge. And this again, I should hedge it using a forward. That's never going to be a perfect hedge until and unless it is exactly 10K. Okay. If it was 11K, I would have had to do one of the under hedge or over hedge options. Got it? Now, similar to that, there is something called options. What is options? Options is you will have the right, but not the obligation to buy or sell in the future according to how the market is behaving. If the market is favorable for you, you execute the transaction. Okay. If the market is not favorable for you, you do not execute the transaction. So you always have that option with you. Got it? If it is favorable, let the option lapse. That means exercise the contract, let the option lapse. Okay. If it is unfavorable moment, no problem. Option is there to protect you. Exercise the option. Got it? Options can be of two types: put option and call option. Put option is when you're selling it, like you just say you're putting it somewhere else, you're selling it. Okay. Call option is when you buy the option, you're just calling it. You're like, yeah, I want it, like that. Okay. Put option, call option. Got it? That is, option can be of two types. Right. Here is the difference between OTC and exchange traded derivatives. I cannot signify how important this particular topic is. Okay. Now, trading platform, does it have? No. This is only over the counter private negotiations. Here it has regulated exchanges, NYSE, BSEs, whatever. Okay. Customization. It's fully customizable. It is tailor-made exactly for you, but this is standardized. Okay. Counterparty risk. What is counterparty risk? That the other party is going to default. Okay. Here in OTC, only two people are trading. The other party is going to default. The risk is very high because there are only two people. But here, there is no risk like that because the clearing house, for example, whoever we are investing through in that exchange, that takes the guarantee. Okay. So the risk is very low here. Regulation, light regulation because only two people are here, and strictly regulated, that's why they take guarantees and all. Transparency, low, details are not given to public, but here it is traded. It doesn't make sense if they don't give the details to public. Okay. Liquidity, lower liquidity, high liquidity. Contract examples, you need to remember this. Okay, they will ask you which one is OTC, which one is exchange traded, and you need to be very sure about what's happening. Forward, swaps, custom options are OTC derivatives. Futures, exchange traded options are exchange traded derivatives. Option can be of both the types. Okay, OTC and exchange traded. They will mention in the question if it is any of this. Okay, now just to understand what are the different types that we learned. Forward contracts, agreement to buy or sell, known payment or receipt, customizable. Why? Because it is an OTC. Okay. Money market, borrow or deposit in respective currency and lock in equivalent value. When you can access borrowing and deposit rate, here involves cash flow today, uses interest rates. Okay. Currency futures are standardized. This is a exchange traded one, don't forget. Currency options, option contract, good. There are of two types, call and put option. Okay. Here you'll have to pay a premium because you have an option, right? You'll obviously have to pay a little more to compensate for it. Okay. Currency swaps. Swaps is the longest term of a derivative available. Everything else is for a few months. Swaps can last for years together. Okay. So understand that one main part about swaps. And this is unstructured. Okay. Natural hedges, just let it be, basically, is what they are telling. When you receive, you receive. When you pay, you pay. That's it. If there is loss, deal with it. That is what natural hedge means. Okay, coming to interest rate risk. Interest rate risk is when you are borrowing money. Okay, when you're borrowing money, what happens is you'll have to repay later, correct? When you're repaying late, okay, let's say you're borrowing money, you'll have to pay interest in between, right? So when you are paying interest, what do you want? Do you want the interest to fall or rise? When you are paying interest, you will obviously want to pay less interest. So you want interest rate to go down, right? But when you're lending and someone is paying you interest, you'll obviously want the interest to go higher, right? That's the difference between borrowing and lending. That is interest rate risk. If you have any of these risks, that is interest rate risk. Got it? Interest rate risk refers to the uncertainty in cash flows caused by fluctuations in interest rates. They can both affect the timing and amount of cash flows. Okay. Now, if they're borrowing in floating rates, remember we went through floating, fixed, and the other rate for smoothing, where there's a mixture of both floating and this one. So if they borrow at floating rates, they're exposed to rising interest rate. If they are borrowing, we are telling. Okay, if we are borrowing, there's a risk that interest rate can rise and we have to pay more interest if we are using floating rate. But if we are using fixed rate, we'll have to pay the fixed amount, right? There is no way in which we are bothered about rising interest rate. But at the same time, what if the rates fall? Then you're missing out on an opportunity to pay less. Okay, that's a lost opportunity cost, basically. Okay. If they lend or invest at a rate that may change over time, that's how the risk is created, is what they are mentioning here. Now, what are the type of interest rate exposures? First is gap exposure. These three types can be asked in section A. Understand it properly. Okay. Gap exposure classifies assets and liabilities based on when their interest rate resets. Okay. What is the meaning of that? So we have 10,000 in assets, 10,000 in liabilities. Okay. Assets, let's say we have we lent money to someone, we are lending it. Okay, we are lending money to someone. For liabilities, we are borrowing money, we are borrowing the same 10,000 from someone. Okay, now the amount that we lend in and the amount that we borrow in will be different, correct? Maybe same, but most of the time is different, right? So the same 10,000's value after, let's say, 3-4 months is gonna change. Maybe this one with higher interest, this one after paying the interest, but still it's different, right? So as an asset and as a liability, how much gap is there between? So for example, for an asset, you have given it to someone and you're getting 6% interest, but same for the liability, let's say you're paying 8%. Can you see this 2%? That's still going under loss for you. That is the gap exposure. Got it? Now, gap exposure, like I said, can be positive or negative. In this scenario, it is negative gap exposure because you're borrowing more, your liability is increasing more. Okay. If this was the other way around, for example, 8% here, 6% here, then this would be 2% positive gap. Got it? Okay, next is basis risk. Basis risk is when two rates do not move in line. Okay, so for example, this mainly happens in forwards. Okay, right now you will assume that the spot rate right now is SO. In the future, spot rate will become S1, but it is that will also become forward rate, correct? You're just assuming that future spot rate and forward rate is the same. This is expectations theory. I'm going to repeat again. Okay, expectations theory, that's what they're telling, right? But this doesn't always happen, correct? When this doesn't happen and this doesn't move in line with each other, that creates basis risk. Okay, it does not move in line because of different benchmarks, so there could be certain gains or loss that could happen. Now basis risk is not that tested for FM, but for AFM it is. So for now you can forget about it. Okay, this is what you will need to focus on: gap exposure. And transaction timing risk is basically what I explained here. When you're borrowing and lending, this risk is transaction risk. Okay, next is yield curve. We'll be learning about 3 types of yield curve. There is more than that, but we'll only be focused on 3 types. Okay, this is how a yield curve looks. Basically, they are telling that interest rate for short-term securities will be less. You will receive less interest rate for short-term securities, but at the same time, for longer-term securities, you will have to pay more interest. Got it? This is what they are telling basically. Right. So this is how a normal yield curve looks like. Long-term rates are more than short-term rates. Okay, because during long-term, investors will want to compensate for the risk that they're keeping their money for away from them for a longer term. In a long term, if anything can happen, right? Even a second is sufficient for something to happen. But you are trusting the other person and giving your money to them. So obviously you will want some compensation for it, correct? So that is what normal yield curve shows. But inverted yield curve is the other way around. So this is how normal goes. Inverted is like this. So in this scenario, short term will give you more interest, whereas long term will give you less interest. Okay, this is called downward sloping curve. Normal is upward sloping curve. Got it? Now, flat or humped is just like both short and long term are more or less giving the same returns. That is flat or humped yield curve. Got it? You need to know what each yield curve signifies. Understood? Right. Next one. Theories explaining yield curve. First is liquidity preference theory. So what is liquidity preference theory? They are telling that investors prefer short-term securities for long-term, prefer short-term securities and demand higher yields for long-term securities. So they are telling for short-term, they prefer the normal rate, but for long-term, they expect higher yield. Yield is nothing but the return that you get. Okay, this is what liquidity preference theory means. So see, even if long-term will give you higher returns, they will want to invest their money for short term because they want money in their hands. They don't want to like keep money aside from a long time. It's going to be like a lock-in period, and they do not want that. They just want to have liquidity. That's their preference, is what they're telling. Got it? Expectations theory is yield curve reflects expected changes in future interest rate. So they are telling this curve, both any type of yield curve, it is reflecting what kind of changes they are expecting in the future. Got it? That is what expectation theory means. Coming to the last one, market segmentation theory, that shows that different investors have different preference. Okay, some go for long term, some opt for short term. It is nothing good or bad. Okay, it is based on their preference totally, right? So that is market segmentation theory. Everybody has their small groups, is what they are telling. Got it? So why do we need to look at this yield curve in decision making? If in short term they're getting good returns, good, invest in short term, right? So managers can choose between fixed and variable rate. Normal yield curve may suggest choosing fixed rates to avoid rising costs. Many things. Okay, you can make so many decisions based out of these yield curves. Used for forecasting, this is the most important one. Okay. Now, hedging techniques. This is for hedging for interest rate. Okay, interest rate hedging has multiple types. Okay, FRAs. Okay, I'll tell you how it works. So FRA is like this. Let's say you have to borrow money after 3 months. After 3 months, you're investing in a project that requires money for, let's say, 6 months, and you choose to go through FRA for it. Okay, FRA is nothing but forward rate agreement. Whatever right now you are making an agreement, so that you tell after 3 months I want money, I will pay only so much. Okay, you're already making that agreement. So basically this is 3v6, 3v9. Did you understand what I did? 3v9 type of FRA you need to take for 3 months, after 3 months, for 6 months. So when are we going to get back? 6 plus 3, 9. That's how FRA works. Now you can write it as 3-9, 3v9, whatever. Okay, same thing. Let me give you another example. Let's say after 2 months, I need money for 5 months. So then what is the FRA going to look like? 2-7. Got it? Or 2v7 FRA. This is how FRAs work. Okay, and obviously during that time, the intermediary, financial intermediary, could incur a profit or loss. Now let's say for after 3 months we agreed to pay 3%. Okay, but in the after 3 months that rate went up to 4%. That 1% will be paid by that person, the intermediary, whoever is dealing with us. But same thing, if we decided we'll pay 3%, but after 3 months it goes down to 1%, the remaining 2%, it's a lost opportunity cost for us. Yes, but at the same time that 2% is going to be a benefit for the financial intermediary. They are going to treat it like the commission, like the profit. Got it? Okay, next one, interest rate futures. This is like normal currency futures but in interest rate. Okay, this is again standardized, which means exchange traded derivative, used to hedge against future change in interest rate. There it was used to hedge in future currency. Okay, here remember this, for borrowing you will sell, for deposit you will buy. Got it? Subject to basis risk, again interest rate. Hedge may not fully offset the thing. Fine, basis risk, never mind. Options also are available in interest rate, but here it is of 3 types: caps, floors and collars. So cap is you set the maximum rate. Okay, so if we are borrowers, we are borrowing money. Okay, and right now the rate is what, 2-3 something. Okay, but then in the future we know that it can go up to 5-6-7, whatever the rate is. Okay, but then we are going to set a cap on the head. Remember that the higher level we are going to set a cap. I will try my best, Kaushiki. Okay, we will try. If there is time remaining, we will do it. But otherwise also there, I've done sums in the past 4 days. 4 revision classes are there. You can have a look at it. There I've covered most of the topics. Okay, fine. Caps is on the head. Like I said, look at the upper value there. Okay, so now let's say right now it's 2%, but then we are going to set a cap for 4%. If it is going to go over 4%, we are not going to pay. Okay, that's the option that we take for caps. Same thing for floors. If we are taking for floors, then what happens? Floor is down, right? Look at the lower value. Here, if we are lending, when we are lending, let's say the rate is 2% right now. Anything below 1%, we will not take. 1% is the maximum we can go down to. Okay, that's going to be the floor basically for lenders. So if it goes less than 1, we don't care. We need the 1% is what we'll see in floors. Coming to collars, collar where here, right? So this is something that combines both cap and floor. Okay, so it cannot go over the cap, it cannot go under the floor. That's going to be that range there, cap and floor. The range in between, that is collar. Okay, understood? You will not get many sums from it, but you just need to understand the meaning of it. Okay, interest rate swaps is just when let's say your country or whoever you're borrowing from only gives fixed rates, but you want it in flexible. Someone else's country is giving flexible rates to them. Okay, so when they get the flexible and you get fixed, you swap with each other. Now you have flexible and they have fixed. Okay, that's it. This is interest rate swaps. So for long term, very helpful. Okay, next is risk management. Risk management approaches. Here, remember we already went through smoothing. Smoothing is just maintaining a mix of fixed and floating rate of debt. Okay, this reduces the sensitivity to rate fluctuations. There will still be changes, but it will not be as sharp as it would have been otherwise. Okay. Assets and liability matching. Match interest rate reset dates and maturities between assets and liabilities. So like I said, if you're getting assets and if you're getting liabilities and it is almost, you can match the reset dates, then it's fine. The exposure is minimum. We are talking about foreign exchange. Okay, so assets are of 100,000, let's say, liabilities are of 200,000. If you can match it, finally we'll be left with liabilities of 100,000 and we just have to pay that. Okay, so you're minimizing the mismatch exposure. Otherwise you had to hedge for this, you had to hedge for this also, it would have been a headache. Similarly, like assets and liability, there is cash flow matching also. Okay, now here is a short summary. FRA is good for short-term interest rate when borrowing or investing soon. Okay, interest rate futures are for exchange traded short to medium term. Okay, this is when timing is flexible. Interest rate options, flexible hedging with protection. Remember that. Okay, when uncertain about rate movements. Interest rate swaps, long-term interest profile restructuring, and when managing large structured debt, swaps is what happens. Now guys, if I'm being honest, just focus on this one and this one. Interest rate options, they can only hardly ask you what is caps, what is floors, this, that, and they can ask you in MCQs asking, does it give you a right and obligation, or right, no obligation, no right, only obligation, that kind of question. Okay, easy, simple questions. Okay, now that we are done with foreign exchange, we're done with working capital, and we're done with investment appraisal, we have just two more topics left. One is finance, source of finance, and one is dividend policy, and remaining the last chapter of business valuation, where only 3 topics are important. We'll go through that. And again, obviously there is ratios as one whole chapter, but ratios I'm not going to go in that much depth. We're just going to like skim through it, because ratios is not going to be that much of an important topic in FM as it was in FR. So if you would have written FR already, you would know how important ratios is, and that is not how important it is in FM. Okay, it can be asked in section A or B, FM. Okay, now why do we need finance? Obviously to manage working capital, to invest in non-current asset, to support any development, R&D, whatnot. Okay, now primary internal source is retained earnings, but external finance is often needed because retained earnings is never sufficient for us to go through whatever we are doing. Will this be class? Yes, this class will be available on YouTube later. It is recorded, you can go through that. It is possible to share. Okay, if you're a student here, you will get the notes most probably, but I will have to check. I am not that sure about it. Just give me some time. When I'm ending the session, I will get the information about it and we will let you know. Okay, I will ask that later. Okay, fine. Cost. Debt is usually cheaper due to tax deductibility of interest. Whenever we are choosing a source of finance, right, when we are raising equity, we will have to pay tax on that whole of equity. Welcome. Okay, when we are choosing debt, right, we will not have to pay that interest. Equity raising will lead to paying tax on whatever we have raised. Okay, whereas debt borrowing, it will not be. You will be safe from the interest expenses. Okay, got it? That's one main benefit of borrowing through debt. But too much debt is gonna increase your gearing, which will increase your cost, etc. We'll look at that. Okay, duration. You need to match the finance term to asset life. For example, if you're investing in a short-term project, you will focus on getting some short-term debt, short-term borrowing, whatever. Okay, similarly, if it is long-term project, we'll go look for long-term. Term structure, it reflects relationship between loan duration and interest rate. That how much is the interest rate basically they're asking. Gearing. Using more debt increases risk. Too much equity dilutes control. So everything has its own pros and cons. We cannot tell like this is good, this is bad until we know which type of company we are operating in. Okay. Accessibility. Now, sometimes if there is too much debt already, banks will not be willing to lend money to you. Okay. Similarly, equity, you cannot raise money through equity until and unless you follow certain criterias, you get listed and all that, right? So whatever is accessible to you, only that you can choose. Okay. Next, risk versus returns. Investors expect high returns to take higher risk. Okay. For example, bonds and shares. Bonds have lower risk but a fixed income. Investors have higher risk but a variable return. Got it? Now, this is a word that you need to remember. These little words are where section A and B are totally focused on. Okay. You will look at a word and you will be like, I've never seen this ever. Where is this from? Okay. That type of questions they'll ask you. So remember these little words that we are focusing on. Okay. Reverse yield gap occurs when bond yield exceeds equity yields during inflation. Now, usually bond, which is debt, should give you less returns as compared to equity, right? Equity should give you more returns. But in times of high inflation, and maybe let's say economy is not doing fine, this, that, could be multiple reasons. What happens is bond will perform much better than equity. That will come across as a shock for everyone, right? So that becomes reverse yield gap. Got it? The total return demanded by investors is dependent on two main factors. One is the risk-free rate, other is reward. So basically, the return that an investor asks for is a component of two things. One is the risk-free rate, which is nothing but the rate at which government borrowings is happening. So usually government borrowings are the ones with least risk. Okay, that's not risk-free completely, but that is the one with least risk. So risk-free whatever plus premium that they ask to invest in your company. Okay, looking at the risk. Got it. That is the demand that investor has. Coming to long-term finance, types of share capital. There's ordinary and preference share capital. Okay. Now, sources of equity. How can you get equity? Firstly, let's start with retained earnings. One of the most cheapest source. It is internally generated, no transaction cost, nothing to miss out on. Okay. But if it is new external share issue, you need to comply, you need to incur high cost. For example, what? There are issue costs, there is cost for underwriting, there is cost that people will not buy your product. There's multiple costs here associated with new share, compliance cost for this regulatory, etc. Multiple costs. Okay, but right issue is something like this. You have existing shareholders in your company. Okay, what you do is you offer certain shares to these existing shareholders based on the ratio that they already have. Okay, so you give them a right to buy these shares, but in a discounted price. Got it? See here. So discounted shares for existing shareholders. A right issue is an offer to existing shareholders to subscribe for new shares at discount to current market value in proportion to their existing holdings. For example, if I own 10% of the company is not going to give me an option to buy 100%. Only the 10% rate will still be there. I will still own the 10%. Based on that, they will give me an option to buy. The new share price after the issue is known as TERP, theoretical X rights price. What's the formula for it? This one. Market value of shares already in issue plus proceeds from new issue divided by number of shares in issue. Okay, that is what it is. You will be asked to calculate sums for TERP. I've seen just one or two of it, but if you are asked, then it's good for you to remember it, right? Okay. Long-term finance through debt. Bonds are also known as debentures, loan notes, loan stocks. Okay, they are denominated in block of 100. So, example, we have market value of 5 million, let's say, and the value of it right now is 103.5, whatever. Okay, nominal value is always going to be 100. It is going to be denominated in 100. What is the meaning of being denominated in 100? For finding the total value, you will do 5 million into 103.5 and you will divide by 100. Okay, so it will eventually be 5 million into 3.5 itself, but That's how you get the market value of it. When you solve sums for WACC, you need to know the market value of both equity and debt. Okay, so during that scenario, you will have to calculate the market value of debt like this. Different types of debts, we have loan notes, we have bank loan, etc. This, that. Okay, so we'll learn a little more about debts later. Hybrid instruments are the ones that can be converted. Right now it will be debt, and later you can convert it to shares, convert it to equity basically. Not a very big topic in FM, you can skip it for now. It was a huge topic in FR though, if you gave the exam and if you remember. Right. Lease, one second, what is this pen? Are classified as debt finance. So lease is another way in which, another one of debt finance itself. Okay, now this could be a short-term thing, it could be a long-term thing also. Okay, this is mainly dealing with buying, getting assets on lease without buying it. Now there should be an important decision made as to whether you're going to lease whatever you want or you're going to buy it. Okay, so now there are two types of lease that you need to be focused on. One is finance and one is operating. Finance is a long-term one, operating is a short-term one. If you are opting for finance lease, lessee is responsible for the asset. Who's lessee? You. The borrower is the lessee. Lessor is the owner of the asset, so they will have the responsibility, because it's a short-term thing. For just 2-3 months, we cannot give the responsibility to someone else and run around. Correct? Coming to Islamic finance now, that's another source of finance which deals with obviously the money that you need for the projects, but it is operating under this Sharia board, which is the Islamic law. Now under Islamic law, we have many prohibitions. For example, riba, which is interest, is banned. Okay, you cannot speculate. Speculate means you cannot assume that in the future this could happen, like that. You cannot. Okay, you cannot invest in these unethical businesses, for example, like tobacco, maybe wines, spirits, whatever. You cannot invest in gambling, all these businesses under Islamic finance. If you're borrowing money from there, you cannot invest in all these things. Got it? Now let's look at how it generates revenue. For example, conventional finance is the normal traditional finance. Islamic finance is an alternative to us. Let's see. So conventional usually makes money by lending with interest. So they get the interest and that's where they're getting their money from. But Islamic does not. See, interest is banned here. So how are they going to make the money? They invest whatever they are having to generate profit. Basically, that's it. They do not get interest. No riba at all. Interest income, fixed, they get it. But here, we get money through profit sharing, lease income, or any trade markup that we have. Okay, here there are penalties. No penalties for extra late payment days. If you're paying late, it's okay, deal with it. You cannot take in more penalties for it according to Islamic finance. Now let's see the types of instruments available. This will be learned by you in more depth if you choose AFM in the future. Okay, Murabaha is nothing but fixed income. Okay, so here what they do is bank, they buy an asset. Okay, so if they want to, if the company wants to sell something, okay, bank buys it for them and then they resell it to the customer at profit. Obviously, when that happens, bank should get the ownership first. Bank is nothing but the Islamic bank here that we're talking about. No interest is going to be charged. Okay, and that's how they make their profit. Ijara is lease finance. This is basically leasing. Okay, so what happens here is bank leases the asset to customer for fixed rent. Ownership remains with the bank and bank handles major maintenance. So if there is any major maintenance, similar to lease finance, all of it, guys. So basically bank purchases it first. Okay, and then they lease it to that particular customer, whoever it is, and then whatever ownership is there, that is still with the bank. But at the same time, if there is any problem in the asset, bank will handle it, all the major ones. These little ones the customer can be able to deal with, will be able to deal with it. Sukuk is debt instrument, that is like bonds, debt, right? So Islamic bonds, this relates to ownership of the asset. Sukuk holders share in profit and losses of asset performance. Again, interest is not allowed. Okay, but whatever debt is there, right, the bank and the sukuk holders both will get a profit or loss of that particular debt. Mudaraba equity finance. What happens here is one party provides the capital. One party in the sense could be bank, could be the borrower. Okay, the other provides expertise. So basically they work together, and if there is any profit, they will share it. But if there is loss, that is only borne by the capital provider, whoever is giving the capital. For example, if bank is giving the capital, they are gonna be solely responsible for all the losses, whereas all the profits, they'll have a fixed share. Got it? Final one, musharaka, which is venture capital partnership. This is, so here again, bank and the borrowers become partners. Okay, profit is shared in agreed ratio, loss is also shared in agreed ratio. Got it? This is how it works. So Islamic finance is just this much. They cannot ask you much more than this. Okay, I hope you were fine with Islamic finance now. Now let's go to dividend decision, sources of finance. We are fine with it, but we'll have to learn a little bit about the calculation. Okay, how do we know the cost of whatever debt we are borrowing, whatever equity we are borrowing? Retained earnings are one of the most important internal sources of finance. They are available without issuance cost. It do not dilute shareholders' control and provide a flexible funding source. However, using retained earnings to fund projects means that profits are not distributed as dividends. So now we can use retained earnings. Okay, I'm not telling we cannot use it. But then if you give in retained earnings for your projects, what are you going to do about the dividends that the shareholders will be expecting? They will have some expectations, right? Okay, so the main question in dividend decision is, should the company pay dividend or should they reinvest it back to the business like retained earnings? Okay, so there are three theories of dividend policy. Okay, three ways in which we can deal with this particular question. It sounds very simple, but let's look at the three ways. First, dividend irrelevancy theory. Now I'll tell you how it goes and then we will read it. Okay, so M&M, most of the theories are made by these two people. Okay, so now what they are telling is, a company, whether it provides dividend or does not provide dividend and takes it back as retained earnings, is not going to make a big difference. Now, why did they tell something like this? Let's see. If they provide dividends and if shareholders do not like dividends, they do not want dividends, they want to have the share in the company itself. So what they will do is, with the dividend that the company have provided, they can go back and purchase more shares. Understood? They can go back and purchase more shares. Got it? That way, dividend is gone. Now the money money that they got through dividend, they took that and they went and purchased more shares in the same company. Okay, this is equal to having retained earnings itself. Got it? But now let's say the company is not giving dividends. Then let's say shareholders wants dividends. What are they going to do about it? They can sell a share or two of whatever they own in the company. That way they can manufacture their own dividends, they are telling. They will sell it, they will get money, treat it like dividends is what they are telling. Okay, whether the company gives this or invests back in retained earnings, it is not going to make a difference, is what M&M told. Got it? If you didn't understand, you can ask again, but this is how it works. Okay, let's read through it now. In a perfect capital market, that's the main assumption. Don't forget. Let's look at the assumptions. Here, there are no taxes, no transaction cost. It's a perfect market. Investors are rational. Many things. Okay. In reality, capital markets are not perfect. Transaction cost, taxes and all will affect the investor behavior, is what they're telling. Now see here. Shareholder wealth is determined by firm's ability to invest in profitable projects. Now, shareholders' wealth can only be increased if the firm is making profit, if they're investing in profitable projects, correct? Now, not by the method of financing or how profits are distributed. Whether the company pays dividends or reinvests the earnings, as long as it maximizes the value of investment, shareholders' wealth remains unchanged, is what they're telling. So, let's say they're giving dividends or they're not giving dividends and they're investing in retained earnings. As long as the long-term value is high, shareholders' wealth is gonna remain unchanged. That's what they are telling. Investors who need income can sell a portion of their shares to generate homemade dividends, also known as manufactured dividends. We can ask this in your section A questions. Next one is residual theory. What is this? They are telling dividends are a residual. They are paid only after the firm has funded all the acceptable investment opportunities. So they are telling, like, how? Let's say we have money. Okay, we'll be like, I will use how much ever I want to. Whatever is remaining, I'll donate it to charity. Something like this. Okay, so whatever positive NPV projects are there, all the investment appraisals that would increase the profit, invest in everything. And only if there is something remaining, you give it to the shareholders as dividends. Got it? That is what residual theory means. Finally, we have dividend relevance theory, which challenges this M&M's first theory. Okay, they are telling that, see, I don't know what you're thinking, M&M, Modi, Glani and Miller. This is not how it works. Real life has taxes, has transaction cost, has many things, and dividend matters. Okay, real world people want dividend. Got it? If they're investing only for short term, why will they sit and wait for like the long term capital increase? They want dividend. Okay, and they are telling you can manufacture your own dividend is what they told, right? But then that is affected by the taxes and by transaction cost and whatnot. There are multiple things you need to consider. You cannot just live in your fairyland is what they told. Okay, so they are telling there are different reasons why dividend matters. One, dividend signaling hypothesis. What is the meaning of this? They are telling that if a company is not giving dividends, the shareholders are going to assume that this company is not performing well. We need to take out the money immediately. There's going to be a panic amongst the shareholders. Okay, they're going to think this company could probably be saving money because it's going to go bankrupt. They're just overthinkers, investors. Okay, because they've given them money. I mean, rightfully so. Okay, so this is what happens. So shareholders are going to be so stressed and so anxious about why they're not giving me the dividend. Okay, that is dividend signaling hypothesis. That's why you need to give them dividends. If it's not a big amount, no problem, but still give them a constant rate at least. Preference for current income. Certain investors, okay, for example, people who are retired, like it's written here, okay, they prefer regular income because they don't have any other source of income right now. We're just going to assume that. Okay, so they want a way in which they can regularly get money, right? So dividend, what better than dividend in such a scenario, right? So some people will have a preference to get this current income. For them, dividend is a need, it's a must. Okay, yeah, see what they are telling. M&M's idea of homemade dividends is not practical due to transaction cost and taxes. Finally, we have tax-based consideration. What is tax-based consideration? It is like, see, different investors face different tax treatments, correct? For example, people who are working, people who are retired, for dividends, there's a different tax treatment. For capital gains, there's a different tax treatment, correct? So people want to, like, for example, these rich people, what they do is they've invested in companies, right? So they hold shares in the companies. But what they do is they do not have to pay any tax on that because they haven't realized it yet. They haven't sold their shares. They don't have cash in their account yet. So they want to continue doing this. They just want to keep deferring the tax. Okay, but instead, if they get dividends, they have to pay the tax immediately on this, and this is not what they desire. Okay, there must be a reason why they are doing it, and this is definitely not that. So they do not want to pay tax right now. They want to defer it, and that's why they choose to like get capital gains and not dividends. Got it? So investors' preferences are different at times. We can't help it. The final one is clientele effect. This is companies attract investors who align with their dividend policy. So what they're telling is, you do you, company, you just do whatever is right for you. If investors like your policy, they will join. They will put in the money. They will invest. If investors don't like it, it's okay. There are multiple other companies that they can invest in, is what clientele theory means. Got it? These are the three methods. One is the residual dividend irrelevancy theory, residual theory, and dividend relevancy theory. Okay, now Okay, fine, you're not paying dividends, cash dividends, no problem. At least give something else, give an alternative to that. If they tell something like that, then what we can do is we can repurchase the company shares. The company is buying back their own shares. Like what difference does it make is what you're thinking, right? So when I tell that they are buying their own shares, that means, now see, there could be, how do you calculate EPS? Earnings, that is the profit basically, you divide by the number of shares, right? Now, for now, the earnings is gonna be 100. I'm just gonna take a little number. Okay, number of shares is also 100. So earnings per share is $1, right? Now let's say company repurchase their shares. Okay, now the number of shares that exists, they repurchased half of their shares, so like 50 remaining. Okay, earnings is still gonna be 100, but the number of shares is going to reduce to 50. EPS is going to be 2. Do you see what happened? As soon as the number of shares reduced, the EPS has increased. Got it? Now, if anybody wants to sell the shares, it's okay. EPS is higher. The value of the shares is higher. You can sell it. Got it? So this way, it sends a signal of confidence to the market. Company is making the investors know that they believe in themselves. They believe in the company as a whole, and they will get a better return. So that will make investors very happy and confident. Got it? Next, scrip dividends. Scrip dividends is that shareholders are given an option to receive their dividends in form of extra shares and not cash. So no cash, more shares they're going to give them. Okay, here, no transaction cost, company retains cash. Obviously, see, good for company because they don't have to pay any cash. Good for investors because they are not incurring any transaction cost in getting the more shares here. Okay, that way. Got what is scrip dividends? Bonus issue. Bonus issue converts reserves into shares. So what we are doing through bonus issue is no extra money is coming in, but they are changing reserves to share capital by increasing the number of shares in the proportion that they have. If shareholder has 1 share, okay, and if it is a 1-for-1 share issue, and after this happens, shareholder will have 2. So in the proportion that they have the shares, they will issue more shares. Okay, but this way, no cash comes into the business, no cash leaves the business. Okay, now coming to required rate of return. When I was teaching you IRR, remember I told you the return that shareholders want is going to be the cost for the company, right? So the cost of the company is the return expected by the investor. How do you calculate how much return that they want? How much is the cost to the company? That we will learn now. This can be done by learning how to calculate the cost of equity. Okay, cost of equity can be calculated in 2 ways. One is DVM, dividend valuation model, and one is CAPM, capital asset pricing model. Okay, now for DVM, there are different formulas, one for constant dividends, one for growing dividends, and one for, okay, we'll learn that. Fine. So now, cost of equity is the return required by equity investors. It represents the minimum rate that the company must offer to compensate the shareholders for risk of investing in the share. Okay, what is the compensation? Always I told you, risk-free rate plus the premium that they request for. Okay, now there are 2 ways, DVM and CAPM. Let's start with DVM. Dividend valuation model is commonly used method to estimate the cost of equity. Right now we are dealing with cost of equity. We haven't gone to cost of debt yet. Okay, just cost of equity. First, if constant dividends are being paid, we are going to assume that forever annually dividends are going to be constant. Okay, then this is the formula that you use. PO is the current share price, D is the dividend, annual dividend, and RE is the shareholders return, which is also nothing but the cost of equity. That's how you write KE. Okay, KERE, same thing. Now, let me give you an example. Let's say the share price right now is $4. Dividend that they've been paying is $8. Okay, so what is that is not going to be possible because the share price is only 4 and whatever. So let me just reduce it to maybe 2 to make it a little better. This is the formula, REK, whatever. Share price is given 4, dividend is given 2 KE. We need to find out how much is the cost of equity here. Very simple, 2 divided by 4, which is nothing but 0.5, right? Yeah, 0.5, which is nothing but 50% is our cost of equity here. Got it? This is how you calculate constant dividend, DVM, dividend valuation model. Here, what are the assumptions? Assumptions are very important. It can be tested in section E. I cannot signify how important this is. Okay, now, perfect capital market. No transaction cost, no taxes, nothing. Right? Okay, dividend represents the full return. All investors have identical expectations. Impossible. How can all the investors have identical expectations? Not possible, right? That's what we are dealing with. Now, when can we use DVM, the constant one? If the dividends are stable, if they are predictable, that's it. Okay. Let's say dividend is growing at a fixed rate. Okay. Then what happens? Constant growth rate in perpetuity. This is going to be the formula for it. Okay. D1 is nothing but DO into 1 plus G. Now, what is the meaning of this? Let's say the growth rate is 2%. Dividend, the recent dividend that we paid was 5. Okay. Then what is D1? This is going to be D0. D1 is going to be D0 into 1 plus G. D0 is 5 into 1 plus 2%. So that will be 5 into 1.02. I don't know how much it is. Let's calculate. Calculator 1.02 into 5, which is 5.1 is going to be our D1, dividend for next year. We're just incorporating the growth rate. Okay, so this is how you calculate it. Yeah, D1 is the dividend to be received in 1 year's time. D0 is the current dividend. G is the growth rate. Now, guys, the problem with growth rate is that growth rate is not always given in the question. So you need to calculate the growth rate at times. How will you calculate the growth rate? Yeah, so sometimes before I go to growth rate, let me tell you this. Come dividend price is the share price including the rights to receive dividend. X dividend share price is the share price without dividend. So that's why come dividend minus dividend will become X share. So X share is come dividend minus dividends due. So they can ask you questions. Understand this formula. There are two ways to estimate the growth rate of dividend. One is extrapolation model and one is Gordon's growth rate model. So extrapolation is like this. Let's say year 1, year 2, year 3, year 4. So when you started, your dividend was 2 and then it went to 4, 6, 8. Let me just stick to the easy ones. Okay. So how will you calculate it using the extrapolation model? Is growth rate is equals to dividend of year 0. That is the most like recent one. Okay. Most recent one 8 divided by dividend n years ago. So the first dividend that we know of and it will be 1 divided by how many years ago was this? 3 years ago. 1 divided by 3 minus 1. So when you calculate it, you will get the growth rate. So it will be 4 raised to the power 0.33 minus 1. Let me calculate. Scientific. So it will be 4, or let me just do 4 raised to the power. Where is that option? 4 raised to the power, I'll open the bracket, 1 divided by 3. You'll get 1.58 something minus 1, that is 58.7. Almost 59% is the growth rate here. Got it? That's how we deal with it. Right. So now this is what the extrapolation model is. If you know the recent dividend, if you know the first dividend, then you can calculate the growth rate. Coming to Gordon's growth model, this is also known as earning retention model. So basically, we'll look at the profit that we make. From the profit that we make, certain percentage will go as retained earnings, certain percentage will go as dividends, right? We are bothered with this retained earnings part. Okay. So this is B is the retention rate, which is nothing but the retained earnings. RE is nothing but the accounting rate of return, or any rate for that matter. Okay. So growth will be retained earnings into the rate of the company. That's the formula for Gordon's growth rate. Once you know the growth rate, you can easily incorporate it into the DVM formula of fixed growth or constant growth, or you could also incorporate it in CAPM. Okay, there also you will, I'll tell you how it works. Capital asset pricing model, an investor can reduce the risk by diversifying. So now guys, there are two types of risks: systematic and unsystematic. Okay, systematic risk is the risk of the market as a whole. You cannot do anything about it, you have to take that risk. Okay, unsystematic risk is, however, your own risk. So if you can diversify your portfolio and reduce the risk, good for you. Unsystematic risk, gone. Okay, but systematic risk cannot be reduced. For example, this is systematic risk, this river. Okay, unsystematic risk is this part which you can reduce by buying many securities. Okay, but unsystematic risk is the part where which can be reduced. Systematic cannot be reduced. Got it? Now use CAPM when the project's risk is different from company. So now guys, let's say the company's risk right now is different. Okay, you are going into an extremely different project which makes the company's risk look very different from what you're doing. So what you will do is you will have to find a new rate to match with the project's risk. That's when you will use CAPM, capital asset pricing model. Okay, now this is the formula to calculate the RE is nothing but KE, cost of equity. RF is the risk-free rate. Okay, B is equity beta, and RM minus RF is market return minus risk-free rate, which is nothing but the premium that you will expect. Got it? Now, systematic risk, market-wide, unsystematic, we went through this. Now, you need to understand the difference between asset beta and equity beta. Here we are using equity beta, I told you, right, in this particular formula. But now, what is asset beta? What is equity beta is the question. Asset beta, equity beta. Equity beta reflects the systematic risk of business. Okay, beta in general reflects risk. Okay, but equity beta reflects the systematic risk of business and finance. So the company's business risk and the company's finance risk, both of it is taken into consideration. However, with asset beta, only the business risk is taken into consideration. Okay, for that financing part, we are talking about how much equity, how much debt will the company have to understand what is a gearing ratio. Okay, got it? Understand the difference between asset beta and equity beta. When we are solving WACC sums, weighted average cost of capital, where we need to take the weight of all the capital that we have, could be equity, could be debt, could be preference shares, anything, we need to know what is equity beta and what is asset beta. Okay, right. So what are the assumptions that CAPM assumes? It's a well diversified investor. So basically we are assuming that systematic risk is only there. Unsystematic risk has been diversified away is what we'll be assuming. Got it? Perfect capital market. That's another of our, fairyland assumption, which is not true, guys. Unrestricted borrowing or lending at risk-free rate. Again, it's a very funny concept to understand. Right, now this is very, very important. WACC, to calculate, you need both cost of equity, cost of debt, or whatever funds you have, right? Now, sometimes to calculate cost of equity, you need beta, correct? To get this beta, you need to solve this equation. So now what happens is we have an asset beta, which can be similar for multiple companies. Okay, for your competitors and you will have the same asset beta. This only deals with the business that we do. Okay, first we'll have the asset beta of a competitor. We'll have the equity beta, asset beta of a competitor, using which we'll have to find the equity beta, and that's when we can find the CAPM. So it's a 2-3 steps procedure here. Got it? So usually it's like this. Let me give you an example. Asset beta of a competitor, let's say, is 1.4. Okay, value of equity is 70, value of debt is 30. Okay, I'm just going to make it very easy. So using this formula, asset beta is given 1.4 is equals to equity beta is what we need to calculate into value of equity is 70 divided by 70 plus 30 into 1 minus, I'm going to assume 30% tax. Okay, this is how you will do. After you solve it, I don't know what's the answer, so I need to sit and solve just a second. Okay, so first we'll do 30 into 0.7 plus plus 70, 91, so 70 or just to 1.4 into 91 divided by 70. So equity beta is giving 1.82. Okay, this 1.82 is gonna be our equity beta. What are we gonna do with equity beta? We can directly incorporate that into the formula, adjust the asset beta to reflect the gearing. So now what we're gonna do is whatever asset beta is there, we will reflect it, we will use that and reflect the right betas. Okay, for example, we'll get the asset beta first. Okay, after you get the asset beta, then you will calculate the equity beta using the company's debt and equity. Only after you get the equity beta, you can go to this particular formula of CAPM and get the cost of equity. Got it? Step 1, find the asset beta. Step 2, find the equity beta. Step 3, CAPMKE, this one. Got it? That's it. So this is probably going to be a 20 marker for you. WACC calculation, cost of equity. This is how you calculate. Then you'll need to calculate the cost of debt or whatever it is. Okay. That's it with cost of equity. Two methods, DVM, CAPM. Okay. Calculating the growth, again two methods, extrapolation and Gordon's growth model. That's it. Okay. And obviously calculating the betas. Right? Now, cost of preference is not as big as equity. Obviously, this is the formula. KP is nothing but the cost of preference shares. D is the constant preference dividend. PO is the ex-dividend market value. Ex-dividend we're talking about here. Okay. Now, coming to cost of debt. Cost of debt, there are two types of debt. One is traded debt, one is non-traded debt. Non-traded debt is like bank loan. This is the interest rate for it. Okay. Coming to traded debt. Traded debt are of three types. One is convertible debt, one is irredeemable debt, one is redeemable debt. Okay. Now, debt is always quoted in $100 nominal value, which I've already told you. Okay. Now, interest paid on debt is coupon rate. Understand what is coupon rate? Just like how we learned cum dividend and ex dividend, similarly, we have ex interest and cum interest. Got it? And whenever we are using the cost of debt, we'll always use post-tax cost of debt. So that will be KD 1 minus T after the tax. For irredeemable debt, this is the formula. Okay. I is the interest. Okay. 1 minus T, tax, normal thing. But the only difference is we are dividing by market value, which is the market price. Easy, simple. Okay. Now, redeemable debt is when you need to repay the principal plus keep paying the interest. Okay, so here it's very simple to understand redeemable debt. It is just the IRR, that is the cost. Okay, cost of redeemable debt, IRR. Understood? IRR, what's the formula? Use a spreadsheet always. Don't waste your time using something else. Okay, don't sit and solve it. WACC. Okay, WACC is weighted average cost of capital. A company cannot be fully funded via equity or via debt, right? So we need to know the cost of each source of finance that we are funding with. Equity, market value of share into number of shares in issue. Debt, like I said, current market value, nominal value will be different, and $100 is always being denominated. So first you'll estimate cost of each source of finance. I taught you how to do KE, KP and KD. Right? So one of it will come. You need to know what is the cost. You need to know the weightage of it, and you need to solve this particular sum. This is gonna be the formula that we'll be using to calculate the WACC. Got it? Or you could use this spreadsheet formula, right? The source of finance here could be equity, debt, preference shares, whatever. Cost of each, let's say 100, 120, 150. Weights, value for weighting. What will you write value for weighting here? Cost is value for weighting is this one. Okay, cost is the percentages. So here maybe I'm spending 6% to get this, maybe 8%, 2%, anything. So then you'll multiply each of his 6% into 100, 6, 8 into 1. I don't know, guys. So whatever, here cost plus weighting, you'll take the total of this and then you'll take the total of this. Okay, this is, let's say, A, this is B. So WACC will be A divided by B. That's it. Okay, that's another way you can do. You can either use this particular formula or you can use this particular way that I told. When are you going to use the WACC? Only if the project is small, if the finance is not project specific. Okay, if you get source of finance, that should not be just for that particular project, it should be for the company as a whole, then you can use it. Okay, that's it. Now the difference between operating gearing and financial gearing. Okay, we are almost going to be done with the portions now. Operating gearing is how much of the firm's costs are fixed as compared to variable cost. Got it? That's it. Okay, now this, if the firms have more fixed cost as compared to variable cost, then they'll be known as high operated gearing firms. Now this can be calculated in multiple ways. Okay, just look at the formula and put it there. That's it. Nothing much to do here. Financial gearing, however, will be, financial gearing is a measure of extent to which debt is still used in the capital structure. So this one was fixed cost versus variable cost. Okay, this one is debt and equity. How much more debt compared to equity? How much more fixed cost as compared to variable cost? Got it? Again, this can be calculated in multiple ways. Got it? Equity gearing is going to be debt by equity. Total gearing is going to be debt by debt plus equity. Interest gearing is going to be debt interest by profit before interest and tax. That's the interest debt. Now, usually traditional view of capital structure. Okay, so initially, traditional view, like people before they had multiple theories, they said that if you have a very little gearing, that means less debt, then what will happen is your WACC falls. Okay, see here, I'll show you. So equity investors perceive little additional risk from modest level of debt. So now they are telling that if you had little debt, no problem, equity holders would be very happy with little debt only. That's why the cost of equity would increase very little. Okay, debt is less, that's why cost of equity will be very little. And because debt is cheaper than equity, it increases, debt is cheaper than equity, correct? That's why if you increase debt, it lowers the WACC, is what they are telling. Okay, so as debt increases, WACC falls, weighted average cost of capital will fall if you increase debt, is what they told at low level of gearing. But at high level of gearing, what did they tell? They said higher debt levels will increase the financial risk to equity holders, because equity holders will be like, the gearing risk is the higher fixed, the higher debt is gonna reduce our money. Okay, because most of their profit is gonna go in paying the debt holders. What will the equity holders get in the end is what they'll be stressed about. Okay, so equity investors will require more returns now because of that, because of high debt levels. Although cost of debt remains low, the rising cost of equity will be offsetting the benefit. Okay, now WACC will start to increase, is what they told. Got it? Now, at very high level of gearing, what happens is company faces bankruptcy risk. Why? Lenders will demand higher returns. Shareholders will also demand higher returns. Now, because of that, KE also increases, KD also increases. WACC rises steeply like this. It just skyrocket. Got it? That is what traditional view of capital structure was. But then, using this theory, they are telling that there is this one exact point X where WACC is the lowest, and the company should sit and search for which point that X is where the WACC is lowest. Okay, obviously it sounds very simple, but it's very hard to sit and go find something so invisible. How can you find out where WACC is lowest? It was a very difficult thing to look at. It cannot be precisely calculated. But then our M&M, Mr. Modigliani and Miller, they come up with something called no tax theory. Then they come up with something called with tax theory. Okay, so we'll be looking at those two. So first, Modigliani and Miller did not know that there could be something like tax, because like I said, they were living in a fairy world, correct? So that's why what did they do? They told that, see, cost of equity increases with debt. So if debt is increasing, they're telling cost of equity increases. Why? Shareholders will feel at risk and they'll be like, no, now we want more cost. That's why KE increases, similar to traditional view a little. Right now, that's why this increase in KE is balanced by benefit of cheaper debt. Now they are telling debt is cheaper than equity. Okay, but equity KE is increasing, but still it is, compensating for the cheaper debt is what they told. So they are telling that WACC is going to be the same regardless. Okay, yeah, like I said, I don't know what kind of thoughts they are having, but they told WACC is going to remain same even if debt increases. Okay, cost of equity will increase with debt, but then it will compensate for the cheaper debt is what they told. Okay, right. So now, what does this mean for companies? It doesn't matter how much debt or equity a company issues. Any mix of it is gonna give you the same WACC is what they told. Obviously, which is very wrong. That's why they only came up with a counter theory called M&M with tax theory. Okay, here also they assume no tax, no fees, no perfect market, everything. But in this new theory, the only thing they added was tax. They got the realization, oh, there is something called tax, and that's why they added that. Okay, so after adding that, now they told that debt is very, very good. Why? Because debt is giving us interest savings, tax savings on interest basically. Okay, so they are telling, take the highest level of debt possible, you will get the cheapest source of finance. Obviously, a very funny concept again, because if you increase debt in that level, your bankruptcy risk is going to go higher. Right? So see here, they are telling interest on debt is tax deductible. I agree. Okay, it is tax deductible, and shareholders' dividends are not tax deductible. This gives tax advantage to using debt. The same assumptions like I said in the previous one, but now only tax they have added. Okay. Companies don't pay tax on interest. This makes debt cheaper, and this is the real cost of debt, right? That is what they came up with. But they're telling KE still increases with debt. See, debt is increasing, cost of equity again increasing because equity becomes riskier. KE will go up, they are telling. But then debt benefit of debt is so much higher that KE can't reach in that level only, is what M&M told again. Okay, so the benefit that debt is given is on that level, but the increase in KE is just on this level. So still they are telling WACC is falling because debt is helping them in that level. Got it? So they are telling that best capital structure is taking 100% debt. Very, very funny, guys. So, but still they told the theory, we need to learn it now. Okay. And finally, this is probably the most sensible theory. Pecking order theory tells that the cheapest source of finance is retained earnings. Always start with that. Then you go to using debt because that has tax benefits. Agreed. Okay. And finally, you go to equity is what they are telling. That's it. There's nothing much in this. Okay. So debt, for retained earnings, you don't need to convince anyone. You can just use it. It's your company. Use it. Okay. No issue cost. It's quick and easy. But debt, it's cheaper than equity. Correct. Right. Less public scrutiny. Why? Because in equity, people are trading here and there, and public scrutiny is always going to be there. In debt also, but less than what is there in equity. And issue cost is also moderate. Only bank fees and interest is going to be here. But in new equity share issue, there's going to be legal cost, underwriting cost, compliance cost, regulatory cost, whatnot. They are just adding on new English words to increase our cost. Okay. Most expensive option. Why? Equity. Okay, it does not have any tax savings, it does not have anything, instead it's just increasing our cost. Only thing we can say is maybe you don't have to pay interest for it. Can be seen as bad signal by investors. They might think that company is desperate. More public scrutiny. Okay, so this is the summary of just the 4 theories: traditional model, M&M no tax, M&M with tax, and pecking order. You can just click a picture of this and then you can look this. Okay. This is sufficient to understand the theories. No tax, with tax, pecking order theory, the most beautiful one that is. Okay, right. Okay, ratios, I'm not going to go through it because it's a very simple topic. Okay, so you just need to remember these ratios. If they ask in section A or B, you need to be able to put the formula there. And I've also mentioned why it rises or falls. So I can go through this, right? So these are the only ratios that we care about, along with maybe working capital ratios. Okay. Okay, now coming to the last part of the subject, we have something called efficient market hypothesis. Okay, this comes in the last syllabus. Okay, what is efficient market hypothesis? They are telling that share prices will reflect everything, all the information available till today in the market. Everything is being considered while you are assigning the share price. Okay, obviously impossible, because otherwise there would be nothing like insider trading or anything possible, right? So they are telling this again, they are assuming that we live in a perfect capital market, but it's okay, right? Because they told there are three forms of market efficiency. One is weak form, one is strong, semi strong, and one is strong form. So what does each one mean? Weak form means share price reflects past performance and trading volumes. So now what they are telling is just the past price performance it will reflect. True, share prices reflects that, along with how much was it bought and sold. That's it. That is weak form. Nothing else. No extra information, no current scenario, nothing is given in weak form. Efficient market hypothesis. But here this technical analysis is useless. Okay, because who will care about the previous news? Right now whatever is up and running, that is what people will look at while purchasing the shares. Okay, coming to semi strong, here prices reflect all publicly available information. Semi strong, all publicly available information. Here this is neither technical nor fundamental analysis can give consistent excess returns. Okay, we know about all this, but what are we going to do about it? Nothing, right? Finally, strong form is price reflects all information. What is the meaning of all information? Here, it was only publicly available information. Here, it is public plus insider, private information. Okay, all the information is available, and that is what is reflecting the changes in share price, is what strong form efficiency says. But it is practically impossible, guys, because there's so much information. No, everybody cannot know all this information to reflect in the share price. Okay, no investors can consistently outperform, not even with insider information. So see, even if you have insider information, still it's going to be very difficult, because the insider information can change any moment, and you cannot be sure about whether that's true or false. Got it? That is efficient market hypothesis. This is all you need to know. Next, behavioral finance. Efficient market hypothesis told that only this one affects the price of share. But that is not true, because after all, we are only human, right? So we deal a lot with sentiments. For example, during 1990s and 2000s, there was this time where people were so obsessed with .com. So like anything with .com, anything with internet, they will want to invest in that. So because of that, the shares of these .com bubble went down very rapidly. Okay, because everybody started investing in that. So they thought, oh, this is going to be the next big thing, we have to invest, and nothing happened. Got it? So first trait is overconfidence. Investors will be like, I know everything, I'm gonna rock the world, rock the market. So when I started trading, this is what I also thought, and then I came back to my level very quickly. Okay, so that is overconfidence. That is one thing that obviously humans have. Second, herd behavior. If people are going to do something, a group of people, then you along with them will be like, they all are doing it, I think I should also do it. That is herd behavior. Got it? Anchoring. Now see, first when you started thinking about something, you would have this biased judgment about it, right? So later, if people try to change that judgment of yours also, that's a good question, Sharon. For now, I think for ACCA that is not relevant. So first we'll finish this part and then we'll come back to it. Okay. Right. So anchoring, relying too heavily on first piece of information. Initially, the thought that you would have had about somebody will not change even after you spend some time with them, because the first impression is always the best impression, right? So that is what is anchoring. The first piece of information that you get from something, you will be so stuck with that. That's going to be your anchor. Okay. So that is anchoring behavior. Coming to loss aversion, fear of losses lead to poor decision making. Now, you will be like, you would have made a decision, you would have chosen a stock to invest in, right? But then you know it is not a good stock, and still you just chose to, like, be over smart and choose that particular stock. But later, even though the stock is performing bad, you will not want to accept that you're wrong, and that's why what you will do is stick on to that stock and be like, no, it will increase, it will increase. You're just gaslighting yourself into thinking that the loss is gonna go back and you're gonna make a profit because you made a good decision. Got it? Mental accounting is treating money differently depending on the source or purpose. Now, this is not that very important, but I would suggest focus on 1, 2, 3, and 4. Okay. The final part is business valuation methods. There are 3 business valuation methods. Okay. One is asset based valuation, one is income based valuation, and one is cash flow based valuation. Okay. Asset based valuation, just use this formula. The net assets of a company, if you want to purchase a new company, will be the total assets that they have minus total liabilities. Okay, that's the net assets that they have, and you will only pay so much for acquiring that particular company, right? But this is very vague type of valuing a company, because it ignores all the future probability. Right now we have assets, right now we have liabilities, but what about the future possibilities? That nothing is being included there. But in cash flow based valuation, that is being included, because that takes us to discounted cash flows, where we look at the present value of all the future cash flows that could come from that particular company, and according to that we pay an amount to that. Okay, similar to what we do in NPV. Coming to the next one, income based valuation. Here the value of the share, value of the company, will be based on PE ratio. This chapter is going to be very important in AFM if you opt for it. But for now, you cannot get too many marks from this. Okay, they are not going to take you into so much depth. Okay, to value a company, there are 3 models: asset based, income based, and cash flow based. You need to know that, right? So value of a company will be the earnings that you can make and the PE ratio, price per share, earnings per share. Okay, you'll find that out. So again, discounted cash flow considers time value of money, forward looking, ideal for profit generating firms like startup and all. You can use this particular valuation best way. Okay, difficult to estimate future cash flows. Yes, because it's going to be so inconsistent and it's going to be hard to understand that. Highly sensitive to WACC and growth assumptions. Yes, we need to get the proper WACC and growth rate to understand whether DCF, which is cash flow based valuation, is accurate or not. Got it? So this is all you need to understand to pass AFM, that pass FM, that is. Okay, I've covered all the possible topics that could come, right? So obviously this calculation sums, I don't think we have enough time for it because we are done with it. But if you would want to, like, look at the solving sums, which I've done for 4 days revision class, I've already done it. You can look at the recorded lectures for that. Okay. Methods: asset based, income based, cash flow based. Just in short, this is a summary of it. Okay, asset based you'll use if a company has a lot of tangible assets. Okay, income based you'll use if it is a stable profit making business. Cash flow based you'll use if it is a growing company. In the future it's going to give returns. For long term, if you want to look at it, you will go for it. Okay, right. So here what you need to do is, for investment appraisal methods, advantages, disadvantages, very, very important. Okay, look at it with its calculations and see be able to explain which method is superior to which method and why. Okay, that's one thing. When calculating ROC, they'll give you cash flows. When calculating payback, they'll give you profits. Okay, it's the other way around, right? But what you need to do is just adjust for depreciation and you're good to go. Mention time saving tips for exam. Okay, so I've made some YouTube shorts about it. You can go through it. Or for example, like 1.8-minute rule. And if you like leave one question, Adil would have already mentioned all that, right? If you leave one question, it's okay. It's just 2 marks out of the 100 marks, right? You cannot be crying over these 2 marks and then miss out on the remaining 98. Stick with 1.8-minute rule. Okay. Also, use spreadsheet function, guys. Use this NPV, IRR, all this. You need to use it with spreadsheet functions. Otherwise, you're not going to complete the exam. Okay. It's a very lengthy paper. I want you guys to complete. So use these little shortcuts. Take your calculators. Just be fine with it. Ratios, do not bother a lot with it. But otherwise, you're good to go. Okay. Understand why CAPM or DVM is used one over the other. Okay. Got it? With this, we are done with FM. I hope you were able to understand everything, right? So this is all the theory that you need to know, along with the calculations for NPV, for WACC, which we went through, beta calculations, growth calculations using Gordon's model, extrapolation model. All this you need to be aware of. Okay, if you go through whatever we've gone right now, I think that's sufficient. You will pass the exam. Okay, but solve a lot of questions for it, guys. Okay, so I think with this we can stop our marathon. Thank you very much for joining. It was very nice teaching you the whole thing. Okay, all the best, guys.